Yes, guys. So when I talk about a fast track batch, what can you expect from a fast track batch? Number one, that this is not going to be fast. It will be very much in detail. Okay. Number two, I will be covering, if I talk about an ABC aspect, okay, like you have your ABC costing, I will try to cover both A and B segments. That is the very important segment and also the important segment. The least important segment is what I am not going to cover as part of this FTR batches concern. So if you look at probably your inventory valuation, probably your cash flow statement, these happen to be a lesser, more important chapters. So those lesser important chapters are not the ones which we are going to talk about here. So we are talking about certain chapters which are very much expected to appear as far as your exam is concerned. So our attempt is predominantly to cover all those topics where you have a certain problems in, where you have a certain complicated concepts which are embedded into, and where you have a certain exam questions which have been repeatedly appearing. So that is fundamentally the aspect. Will we be covering illustrations here? Yes, we will be covering illustrations here, but those illustrations will be limited. We are not going to cover all the illustrations regarding each particular standard. Our illustrations to be covered here are certainly limited because of the limited time that we'll be having. If you want to cover further more problems, then you can definitely subscribe to the full videos or even take out your own study materials or practice manuals or any other reference book and start solving for a better clarity. Fast track reference batch alone is sufficient for you to appear in the exam? Absolutely no. You need to have an effort put in from your side as well. Now, listening to the class directly, I'll jump into the exam is a concept which is absolutely bullshit. Here, very bullshit concept. You need to understand that the student is the primary. A faculty only provides sufficient explanation of a concept to the student. But it is the concept, it is a student who has to absorb the concept, understand it, read it once again, remember it, go into the exam, reproduce it. Now, there is so much of activity which a student is expected to do. Therefore, I cannot really say that fast track reference batch alone is sufficient for you to go and jump into the exam. There is a significant amount of effort that you as a student has to put in compulsory, which you cannot substitute by any faculty, even if it is a 200-hour session. Be that, make it very, very clear in your head. Clear? Now, so we will basically deal with concepts based on their categorizations here. So we will start with the asset related standard, but before we go into the asset related standards, it is very important for us to cover what is the importance of this Ind AS, how did the entire transition into Ind AS start occurring, and how many enterprises have already come into Ind AS, and what is its significance. So these are some things that we have to start looking into. So let us start this session, but please make sure that if any person has any doubts, you people keep messaging me. Throughout the session, you can keep messaging me whenever you want, even after the session closes. However it is, please make sure that you people are messaging me, keeping a communication intact so that you get your doubts clarified. At the same time, you give us sufficient feedback regarding our session. So yes, guys. So let's start our session. First thing, importance of Indies. Why all of a sudden? Because when I qualified in 2011, 2012, we heard about this concept of IFRS being embedded into our accounting standard, but we did not have Indies back then. But if you look at today, I think the entire CA final paper is only based on your Indies. Now, what made them come across with this particular change? Let me tell you. If you remember, we study about economics and we talk about 91 reforms. 1991 Indian reforms on economy, where there was a globalization and privatization which was encouraged, which was long overdue, but happened in 1991 under the regime of Manmohan Singh as a finance minister and Narasimha Rao as the prime minister. Now, that was a much wanted reform at that point of time, where we said we are open to global entities coming and establishing their enterprise and conducting businesses in India. Very good. We have recently got Facebook, Google, so many companies which are multinational companies incorporated outside India, coming and performing businesses or doing businesses in India. You talk about motors, other than Tata Motors, Ashok Leyland and Mahindra, I think all the motor companies, vehicles that we use on today's date have been an international companies. Now, when they come down to India, start performing their businesses in India, they have to make sure that they're reporting their financial statements according to India. So what used to happen was, let's say the entity of, let's say I'll take Toyota, a Japanese enterprise, a Japanese entity, Toyota, has come down and set up its business establishment in India, started manufacturing vehicles and making sure that basically they report their financial statements according to India. So what used to happen? The Indian entity of Toyota used to make sure that the financial statements are in compliance to our accounting standards, which we had earlier, 1 to 29, right? We had accounting standard 1 to 29. Yes, 30, 31, 32 were given for a brief period of time, but later withdrawn. But 1 to 29 standards, they have been complying. Make sure that they present a set of financial statements as an Indian entity. But the unfortunate part was the main parent entity with which the consolidation should occur is somewhere in Japan. Now, how do I consolidate an enterprise which has been presented as per your accounting standard, consolidate with another enterprise in Japan which is performing or which is preparing its financial statements in a complete different accounting principles? They had a complete different standard altogether. So it was so difficult. How can I even come across this kind of situation? So that is fundamentally the point which I wanted to drive. You need to understand that there should be a harmony. That means uniformity of accounting policies applied by the Indian enterprise and also by the Japanese enterprise, so that the consolidation can occur. That is the first reason. Second reason, I happen to look at Reliance Industries. Okay, I have a fancy of reading your financial statements, and I looked at Reliance Industries and I saw that their turnover, that is sales in number, was 4.5 lakh crores. Crore is about seven zeros, I guess, and lakh crores is about 12 or 12 zeros, I guess. Imagine the number. Imagine the number. I looked at that number and I said, no enterprise in this world can ever come across or come up to this particular kind of a number. I was astonished. I was surprised. And if you frankly ask me, I was not feeling great. I was definitely not feeling great, because I felt that is too much for someone to achieve. That is frankly what really happened. But the very next day, I hope everyone has this particular app in their phone called as InShots. InShots keep sending you certain trivia or certain news which keeps on occurring. And there was one such InShot which was sent saying that Apple, the company Apple Inc. from the US, had sufficient cash reserve. Sufficient cash. I'm talking about pure cash. Cash reserve to purchase Reliance, Tata and Wipro put together. Reliance, Tata and Wipro put together, Apple could have acquired only with the help of their cash reserve. Imagine now. If I would have limited myself to understanding that Reliance is the biggest company which we come across, then this particular trivia which was sent saying that Apple has so much of cash reserve wouldn't have really make some sense. That means comparability is important. So until then, comparability is only between two Indian enterprises. But when the globalization era has occurred, now the comparability is between an Indian enterprise and an enterprise which is operating outside India as well. I'll have to increase the ambit of benchmarking. I'll have to increase the ambit of comparison, competitiveness, because it's a global world. There's no borders, there's no barriers in this global world. So that means for comparability, you need to make sure that they're on the same metric. If both are not on the same metric, I'll tell you what happens. I think most of us have at least 80 to 90% in our 10th. Let's say a student or your parents walk in and say you were comfortably scoring the 80s and 90s in 10th class. Why not the same 80 or 90 can happen in your CA final? What will be your answer? My answer would be a wild smile. I'll wild smile and I'll say thank you for your amazing observation, but definitely it is not possible. So that means my comparability of my 10th marks and my comparability of CA final marks, they don't have the same metric. Please don't compare both of them. So that is fundamentally what I'm trying to talk. So therefore, I am here to say that basically for me to compare two enterprises which are in two different parts of the world, the first thing that they need to have is the same measurement, the same set of accounting policies, the same classification, the same reporting. Therefore, it was important for the entire globe to come on one page and adopt one single set of standards. And such single set of standards which they have accepted globally is your IFRS, International Financial Reporting Standards. Now, in that particular context or in making effort to adopt the IFRS, ICAI has come up with basically setting up an accounting standards board and making sure that these IFRS are adopted into India by Indianizing it. What is Indianizing it? Like, let's say you have spicy paneer pizza. Spicy paneer pizza won't happen outside India. It is an Indian version of pizza. That's it. It's a pure Indian version of pizza. So there is nowhere else in the world. If I go to US and I ask them where is spicy paneer pizza, he'll look at me and he'll say, from where did you even come from? So you need to understand that they have Indianized the same dish, right? Pizza is the same dish. It's a bun, it's baked, and just the toppings change. The same way, it's the same IFRS which I bought into India, made it a little more Indian because I wanted it to suit to my Indian enterprises, and I have released it again in the form of your Ind AS. So that is the reason why your Ind AS is called as a convergence with IFRS. It's called as convergence with IFRS. So this is fundamentally the requirement, the most important part of why IFRS has to be brought into picture. IFRS happens to be the most important aspect to be brought into picture at this point of time because we need global competition. We need global comparison. We need global benchmarking. We need to make sure that enterprises which are having a parent organization outside India have an ease in reporting in India. They should not be new to the reporting in India. So that is fundamentally the idea, and we have bought in our Ind AS, which is a convergence of IFRS. Now, if you remember GST adoption, how it happened, 2017, they took one particular day, 1st July, and they said GST applicable, excise, service tax, VAT, CST, everything abolished. That is called as a blanket adoption. Blanket adoption means you identify one particular date and say that from this day, this particular act shall apply and the previous one shall not apply. But however, when it came to reporting, India was not in a position to do that. Number one, we need to look at whether the enterprises are ready or not. The readiness of the enterprise to adopt IFRS is the first thing. Second thing, do we have sufficient resources? That means sufficient people who have a knowledge on how IFRS should be adopted in India. This is the second most important thing that we need. Without these two, then there is no possibility of adoption of your Ind AS or IFRS into India. Considering these two facts, the readiness of the enterprise to adopt and the resources available to adopt, India thought it is better for us to implement Ind AS instead of a blanket manner in a phased wise manner. So first I'll include certain amount of companies, subsequently I'll include more companies, and like that this goes on. In this process, we have come across total 4 phases of adoption. We have come across 4 phases of adoption. What are the 4 phases of adoption that we come across? Now, these phases of adoption have been given as per companies Ind AS rules 2015. That is Companies Accounting Standard Amendment Rules 2015, which had an applicability starting from 1st April 2016 onwards. So this particular act which has been rolled out started with phase 1, and he said under phase 1 I'll only try to include certain set companies which I feel the enterprises have sufficient resources and they are very much ready to adopt. These enterprises are listed and unlisted enterprises, be it listed, be it unlisted. I'm not bothered. If they have a net worth of at least 500 crores, at least means greater than or equal to 500 crores. So any listed enterprise or an unlisted enterprise which has a net worth of at least 500 crores shall start adopting Ind AS under the category of phase 1. What is your phase 1 category? According to the phase 1 category, the companies falling under this particular category should present their financial statements under Ind AS for the financial year 2016-17. First financial year of 2016-17, you need to present Ind AS financial statements. Unfortunately, if you remember, your financial statements according to your Ind AS 1 presentation of financial statements should always be on comparative basis. So if I am presenting Ind AS financial statements for 2016-17, that is the first year, then the comparative previous year is 2015-16. For the year 15-16, I was adopting or I presented the financial statements as per ICAI, the previous set of standards. For 2016-17, I am adopting Ind AS. Now, how can these two be comparable to each other? So you cannot compare the current year to the corresponding previous year. So to overcome this, what he said was, though you are presenting your first Ind AS financial statements for the year 2016-17, I would expect you to restate the financial statements of the preceding financial year, that is 15-16, to provide comparatives to the current year. To provide comparatives to 2016-17, even your 15-16 has to be restated. Earlier, I have already presented your financial year 15-16 as per ICAI. Now has to be revised as per Ind AS. This effort is only to make sure that comparative information is available. So current year 16-17, previous year 15-16 should be reworked. But there should be one particular day on which the entire changes of Ind AS, ICAI to Ind AS have to be reworked upon. Because the measurement basis change, their classifications change, their recognitions change. There are so many changes, I cannot perform over the year. Because the enterprise is a going concern. It has been in operation since past. So on one particular day, I'll have to embed all the changes and make sure that henceforth I will start adopting Ind AS. Now that one particular day is the beginning of the preceding year. The beginning of the immediately preceding year. First year for phase 1 enterprises is 2016-17, for which Ind AS has to be presented. The comparative previous year, that is 2015-16, should be restated. So the first date of the previous year, that is 1st April 2015, should be considered as a date on which I will completely transit from your previous ICAI into Ind AS. This date, 1st April 2015, is called as date of transition. On this particular date of 1st April 2015, which is the date of transition, we apply a particular standard called as Ind AS 101. First time adoption of Ind AS. There are certain things which are peculiar in that standard, gives options to the enterprise, gives certain exemptions to the enterprise in transitioning into the Ind AS. Clear? So I'm saying, according to the phase 1, it covers enterprises whether listed or unlisted having a net worth of 500 crores. Net worth, not turnover. Turnover 500 crores, many companies will have. But net worth of 500 crores, that means I am indicating towards a very sizable company. A very, very sizable company. Such kind of companies have to adopt Ind AS and present their financial statements as per Ind AS for the first time for the financial year 16-17. Since they are presenting the financial statements for the first time for the financial year 16-17, and the financial statement should be presented on a comparative basis, so even the previous year 15-16, which was earlier reported as per ICAI, has to be reworked, has to be revised as per the Ind AS. To make sure that the transition happens, I will identify one date on which I will start adopting Ind AS 101, which is the first time adoption of Ind AS. And that date on which the transition occurs, that is the date of transition, is the beginning of the preceding year. That is, in the phase 1 case, 1st April 2015. This is fundamentally how the implementation started. Fundamentally how implementation start. Guys, net worth more than at least 500 crores. I am talking about large enterprises which generally have best chartered accountants as their auditors, or those auditors who have sufficient resources available to them. You talk about probably big fours, they might have already worked on IFRS assignments, or they have sufficient resources to IFRS. Therefore, it would be easier for them to basically adopt Ind AS for them. Clear? That is the reason why I started phase 1 from there. They gave 1 year gap and they came back to phase 2. Under phase 2, they said, I will increase the ambit now. Because under phase 1, not even 0.01% of the companies, total companies, have come into the ambit of Ind AS. Because you're not just talking about listed or unlisted enterprises, you put a restriction of at least 500 crores of net worth. Where not even 0.1% of companies. Then came in the second part. This is a significant step. The phase 2 included all listed enterprises. All listed enterprises, irrespective of their turnover, irrespective of their net worth, any listed enterprise shall be adopting Ind AS starting from the financial year 2017-18. Now that is a significant change. What about unlisted entities then? Any unlisted enterprise which has a net worth of at least 250 crores. Listed enterprises, no restriction on net worth. Some listed enterprises have negative net worth also, because they might have incurred losses in the past in such a way that the entire reserves and surplus became negative. So even the net worth also can become negative. So therefore, such kind of enterprises, even if they have a negative net worth, if they have their equity or debt securities listed under stock exchanges, then they should be covered under phase 2. If equity or debt securities are not listed, then such unlisted enterprise should have at least a net worth of 250 crores. They shall form part of my phase 2 category. Under my phase 2 category, I will apply Ind AS starting for the financial year 2017-18 onwards. If my first Ind AS financial statements are presented for 2017-18, then the comparative previous year should be 16-17. 16-17, which was already presented as per ICAI, should be reworked upon. And the date of transition on which we will apply Ind AS 101 is your 1st April 2016. Now, after I cover phase 1 and phase 2, I come up with one simple understanding of that the net worth word has become very important, because your entire applicability is revolving around this word net worth. So what is net worth and what should be included in net worth, we will start covering in the next slide. But keep that word aside, because I will have to explain you what net worth is. Clear? Then I have phase 3 and phase 4. Phase 3 and phase 4 is only for banks, NBFCs and insurance companies. There is no other entity which will be included in this. It's only banks, NBFCs, it is NBFC guys, not NGFC. I'm sorry for the typo, and insurance companies. Guys, when I talk about banks, NBFCs, and insurance companies, they could either be, having a net worth of at least, they could either be listed or unlisted. I'm not talking about listing category here. My category of including them under phase 3 and phase 4 is particularly based on their net worth. Net worth at least 500 crores, I will cover them under phase 3. Net worth at least 250 crores, then I'll cover them under phase 4. Phase 3, my first Ind AS financial statement should be prepared for the year 18-19. Comparative previous year is 17-18. Date of transition is 1st April 2017, on which I will apply the provisions of Ind AS 101. Phase 4, banks, NBFCs and insurance companies having a net worth of at least 250 crores. Then the 1st April 2000, sorry, my first financial statements to be prepared under Ind AS is for the financial year 1920. Perfectly our COVID year starting, right? Exactly our towards the end of 1920 was your COVID, the entire havoc created by COVID. So 1920 was the first financial statements to be drafted as per Ind AS. Comparative previous year is 18-19, and my date of transition on which I will apply the provisions of Ind AS 101 is your 1st April 2018. Question comes up. What is net worth first of all? Should the net worth be calculated as per IGAP or net worth as per Ind AS? These are very important questions. Let's look at them. Net worth, net worth, net worth. What is net worth? Net worth is paid up share capital plus securities premium plus any reserve created out of profit. Paid up share capital plus securities premium plus any reserve created out of profit. What are reserves created out of profits? Generally, you can have general reserve, P&L. So all these are retained earnings. These are generally reserves created out of profits. I earn certain profit, I appropriate them into a particular reserve. Remember guys, when I say reserves created out of profits, revaluation reserve is never created out of profits. It is created by increasing or upward revaluing your land, clear, or any other asset. So therefore, it should particularly exclude revaluation reserve. It is not a reserve created out of profit. However, these additions, paid up share capital, securities premium and reserves created out of profits should be reduced by, that means deducted by, accumulated losses, which is a P&L shown in debit balance. Happens. A lot of companies which have a P&L with debit balance. Miscellaneous expenses not written off, underwriting commission, preliminary expenses, amalgamation adjustment account. All these are miscellaneous expenses which should be written off to P&L, but according to our principles, we will write them off over the years. Therefore, to the extent they are not written off, also should be reduced in computation of net worth. Paid up share capital plus securities premium plus reserves created out of profits reduced by accumulated losses, P&L shown in debit balance, and your miscellaneous expenses not written off. This net worth should be calculated based on IGAP financials, because you will not know what is Ind AS net worth unless and until you apply Ind AS. I am not applying Ind AS. I am seeing whether the enterprise should apply Ind AS or not. When I am assessing this, the financial statements which are presented to me is purely IGAP financials. So in my IGAP financials, if the net worth presented is calculated according to this formula, if it exceeds that 500 crores or 250 crore criteria, then I will apply Ind AS. Net worth should be calculated based on the most recent annual audited financial statements after the date of, before the date of Ind AS adoption, guys. Please make sure that there is a correction. It is before the date of adopting Ind AS. Most recent annual financial statements before adopting the Ind AS, whatever is the net worth, that should be considered for the computation of your categories under phase 1 or phase 2. Clear? Remember guys, for the first enterprise, phase 1, the immediate preceding year before the Ind AS adoption was 1560. However, he says net worth computation should be made on 31st of March 2014 or afterwards. That means based on your IGAP financials prepared or drafted up to 31st March 2014 or later, if the enterprise has exceeded the threshold limit of 500 or 250 crores, then Ind AS shall apply. Net worth should be computed as on 31st March 2014 or at a later date. If you look at phase 2, all listed enterprises are covered. All listed enterprises means what? Where either the debt securities or equity securities are listed on stock exchange, which is recognized by SEBI. But here they say that certain entities which were particularly listed on small and medium exchange, SME index as they call it, they are excluded from application of Ind AS. Any enterprise which is listed on an SME index, small and medium enterprise index, should be excluded from adopting Ind AS if they fall under the phase 2 category. Clear? If an enterprise falls under the implementation of Ind AS or adoption of Ind AS in their financial statements, then the group companies to which this company is a part of should also adopt Ind AS. My subsidiary is adopting Ind AS. The holding company cannot present under IGAP because they have to present on a consolidated basis. If the subsidiary is adopting Ind AS, then the holding company has to adopt Ind AS. Otherwise, consolidation is not proper or is not possible. Same way, if the holding enterprise is preparing Ind AS or preparing financial statements as per Ind AS, then automatically my subsidiaries, my associates, my joint ventures, or even my holding company should adopt Ind AS. I'll put it like this. If an enterprise adopts Ind AS, then all enterprises where this enterprise is a part of the group companies should also adopt Ind AS. If an enterprise is adopting Ind AS, then all enterprises in that same group, that means holding, their subsidiaries, joint ventures, and associates, should also adopt Ind AS. This is to ensure your consolidation. To ensure that the consolidation occurs, this is very, very important here. And that will bring us to the end of the discussion on roadmap for Ind AS or the adoption of Ind AS or transition into Ind AS. This is the first transition into Ind AS, which started with phase 1 enterprises presenting Ind AS financial statements for the year 2016-17. We are still going on and we have completed the phase 4 right now, where we had adoption of phase 4 banks, NBFCs and insurance companies which had a net worth of at least 250 crores. Now phase 5 should start, but COVID, it will get delayed, but definitely they will have a phase 5 and subsequent adoptions as well. Clear? Yes, guys. So let's start out. We will start with the concepts of asset related standards which deal with Ind AS 16, 38 and 40. These are three fixed asset related standards which earlier was covered under the standard of AS 10 and AS 26. So these were the two standards which we had earlier called as tangible assets and intangible asset. Now have got revised. Now you have under Ind AS three standards: 16 talking about property, plant and equipment, 38 talking about intangible asset, 40 talking about investment property. A question will come, sir, why not 16 separate, 38 separate, 40 separate? Reason is very simple. Your recognition and measurement as per these three standards are more or less similar. They are more or less similar. So wherever there is a difference, I'll give you the difference. But let me tell you that these standards are primarily very similar in nature as far as the recognition and measurement is concerned. I know they talk about complete different things. They have a significant difference as far as the definition is concerned. But the crux of the standard in recognition and measurement is significantly same. That is the reason why I combined these three standards. So let's see. Let us start first with the definitions part. Regarding the definition, when I look at AS 16 definition regarding your property, plant and equipment, he says these are assets which are tangible. Tangible means which you can touch, feel, see. Those are called as tangible assets. They are held for three purposes which are given as per the standard: use in the process of production or for provision of services, use for rental to others, and for administrative purposes. If a property, plant and equipment is a tangible asset, then it should be held for either of these three purposes. Number one, use in the process of production or for providing a service. Number two, for rental to others. That means I'm offering it on rent to someone else, or for administrative purpose. And they are expected to be used by the enterprise for more than one financial year. If the life of the asset is for more than one financial year, then you can call them or you can classify them under the head of Ind AS 16. It is a tangible asset held for the purpose of held for the process of production or for provision of services, or for rental to others, or for administrative purposes. While it comes to intangible definition, they kept it very simple. I'll tell you why they kept it very simple. It is an identifiable non-monetary asset without physical substance. It is an identifiable non-monetary asset without physical substance. That's it. Full stop. Over. Story khatam. We have significant different definition which was earlier given under AS 26. Because according to AS 26, I'm talking about the previous accounting standard, which is not applicable for you, but I'm just giving you a reference to that. An extract of AS 26 dealing with definition of intangible assets would go like this. It is an identifiable non-monetary asset without physical substance, held for use in the process of production or provision of services, used for rental to others, used for administration purpose. The purposes for which the intangible asset can be used have been specifically given under the standard AS 26. However, when we came down to Ind AS 38, he stopped it. He did not have those purposes. He simply said it is non-monetary asset without physical substance. Question will come, why? Logic simple. Underwriting commission, miscellaneous expenses not written off. Is there any particular standard regarding that? Is there any particular standard which was talking about preliminary expenses? You never had a standard regarding them. But these items were very much there in your financial statements for which no standard was applicable. So what he started doing now was, I will try to include them or embed them into Ind AS 30. So that I will try to give an amortization for even such kind of expenses as per Ind AS 38. That is the idea. That is why he said Ind AS 38 stops the definition by identifiable non-monetary asset without physical substance. Identifiability is a very, very important aspect that we'll have to discuss further. What do you mean by identify? What is a monetary and non-monetary asset? Monetary asset means anything which can be collected in cash, debtors, bank balances, bills receivable. All these can be collected, advances. All these can be collected in cash. They are called as monetary assets. Those assets which are not collected in cash are called as non-monetary assets, and there is no physical substance, then they will be covered under intangible asset. What about investment property then? This is particularly a new standard. There is no comparative previous accounting standard which was there under IGAP. What is this standard talking about? This standard is talking about property. What kind of property? A property either held in the form of a land or a building or a part of a building or a combination of both land and building. Guys, if I say building, then there is a land which is attached to it. Okay, there is no separate building as such. There is always some part of land which is attached to it. So a property which is held as land, building, or a combination of both, either by the owner, that means I own that particular piece of land, or I have acquired that piece of land on lease. I have acquired that piece of land on lease. In such cases, if I hold them, and for what purpose do I hold them? Number one, I am expecting capital appreciation on the property. Today I buy it for 100. I am expecting that this prices of real estate will go up and I would be able to dispose it off at 1500 or 1600 in 3 years time. That is capital appreciation. Number two, or to derive lease rentals from operating lease. Or my intention is to derive lease rentals from operating lease. And lastly, both. That means I want to derive lease rentals initially, but subsequently whenever I get a capital profit or capital appreciation, I will dispose it. So what am I saying? An investment property is a property held as land, building, or a combination of both. By whom? Either I own it or I acquired it on finance lease. For what purpose am I holding those land and building? Either to have capital appreciation or to derive lease rentals from operating lease, or a combination of both to derive lease rentals and also for capital appreciation. These kind of assets shall be categorized separately as investment property. Question comes up, why sir? Why? Why? Earlier it was covered under property, plant and equipment. Now also you put it there only, no? Why separate standard? I'll tell you. There's a very important ratio if you remember. Return on fixed assets. Remember? Return on fixed assets, which is operating profit divided by operating asset. But when I talk about assets which are held for the purpose of capital appreciation or deriving rental income, they are not operating assets. They're definitely not operating assets. Therefore, when I take the ratio of operating profits to assets, then in such cases, I'll have to leave out these assets which are categorized as Ind AS 40 investment property. And I will calculate my return on fixed assets only on Ind AS 16 assets and Ind AS 38 assets. I will not include Ind AS 40 assets. They have a different perspective. The objective of the enterprise is different and the purpose for which I hold them is different. Therefore, they have to be recognized, measured, and also presented separately. They should be recognized separately, measured separately, and presented separately. They do not have a similar characteristics of an asset under Ind AS 16 and Ind AS 38. Ind AS 16 and 38 are held for the purpose of operations of the business, to make sure that the business is conducted. Clear? I'll first touch the recognition criteria, guys. Look at the recognition criteria. According to Ind AS 16, I will recognize a property, plant and equipment if the future economic benefits from the use of the asset is probable to arise. I'm saying future economic benefits are probable to arise from the use of the asset. Now, if I look at the very important term here is future economic benefits. What do you mean by future economic benefit? Economic benefit could be increase in sales, decrease in cost, or ease and efficiency of use. Either my sale increased, cost reduced, or my use has become more effective or efficient, or has become very easy. Either of these things can be called as economic benefit. He never said economic benefit shall arise from use. That's a different statement. Here he said is probable to arise. The word probable is very important. I have given my exam, I am probable to pass. Whether I will pass or not, I will get to know only when the result is declared. On the day of the result, I can pass, I can also not pass. That's what, let us pass. But still, that is called as probable. That means it is expected. I have written my exam very well, so I expect to pass. Certain? 100% sure? No, I'm not 100% sure. I'm saying it's probable to pass. That means what? When I say probability of future economic benefits, then I'm saying I expect economic benefits to arise. But I don't know when I will get the benefit, how much benefit I will derive, I may not be able to tell you. When, that is the timing. How much, that is the quantity of benefit is unknown. I cannot quantify. I cannot quantify that this much benefit I will get on this year. It is not possible for me to measure with certainty. That is why he uses the word future economic benefits are probable to arise. First part. Second recognition criteria. The asset is within the control of the enterprise. When do you say asset is within the control of enterprise? If an enterprise has a right to grant access and has a right to restrict access. If I want, I can give you the access. If I don't want, I can restrict the access. This particular video that you're watching, I have granted you access to watch this video. That means I control this content. I control this content, or the particular service provider controls the content if he can grant access or restrict access to a particular asset. My vehicle is my fixed asset. If I want to give it, then I will hand over the keys to someone. If I don't want to give it, I'll put the keys back into my pocket. I exercise control. My house is my property, plant and equipment. I will lock the house and I'll go away. That is restricting access to someone unauthorized. If I want someone to go into my house, I'll give him the keys or hand him over the keys. I have granted access. So for me to establish control, the enterprise should have the ability to grant access and restrict access to its asset. Clear? Third one. The cost of the asset can be measured reliably. If the cost cannot be measured reliably, you can never identify the asset or recognize an asset. I don't know what is the cost, then you cannot recognize a particular asset. Because for us, money measurement is a very, very important aspect of accounting. If you cannot recognize it, if you cannot measure it, you cannot recognize it. Clear? If you look at the recognition criteria of Ind AS 38, it is more or less similar, except for one simple addition. That is the concept of identifiability. If you remember, even when I was looking at the definition, I told you it is an identifiable non-monetary asset without physical substance. What do you mean by identifiability? That is the first thing. But if you look at Ind AS 40 recognition criteria, perfectly the same as Ind AS 16. There is no difference as far as the recognition criteria is concerned. It will still stick to those three. Future economic benefits are probable to arise. The asset is within the control of the enterprise, and the cost of the asset can be measured reliably. The only one addition which I have under Ind AS 38 is identifiability. Now, why is it so important that under Ind AS 38 regarding intangible asset, he included this part of identifiability? Logic very simple. Intangible asset does not have a physical substance. If I ask you to show where is your watch, I'll show it. If I'll ask you to show where is the intangible asset, that is a skill that you gain from this particular lecture. Show where is it? You chop off your head and then also I can't see. The skill which you have gained is your intangible asset. That intangible asset here should be identifiable. If you cannot identify, you cannot recognize. If you cannot identify, you cannot recognize. What do you mean by identification? I'll tell you. For us to identify it, identifiability is the only difference between Ind AS 16 and Ind AS 38. Look at what identifiability is. Identifiability is something related to separability. When do you say separability? Separability means that intangible asset has been acquired separately through a legal right. I purchased a Tally software for 3 years by paying 54,000. I paid 54,000 to acquire the Tally license. That is called as a separate legal right. Clear? First one. Second one. Even though I did not buy it separately, but it is capable of being separated, sold, transferred, licensed, rented, or exchanged. I did not buy it separately. It came along with a particular asset. Let's say, for example, he said, you buy the laptop, I will give you Windows or Microsoft Office 365 license free of cost. You buy a laptop, I give you Microsoft Office 365 free of cost. I will still call it as separable if the Microsoft Office 365 license, it can be separated. That means I already own a license. Why do I need this license? This license, I can separate it from the asset that is a laptop which I bought. I can sell it or I can transfer it. I can license it to someone else or I can rent it or exchange it. Then you can say that the intangible asset is identifiable because it can be separated. So I'm saying identifiability means it is separability. If I have acquired a if I have acquired an intangible asset through separate legal rights. Number two, it is capable of being separated, sold, transferred, licensed, exchanged, or rented. Clear? Sometimes it may not be separable. It may not be possible to separate the intangible asset and tangible asset. Tell me examples. I purchased a PlayStation CD. I think guys can relate to this. 3,000 rupees FIFA game CD which I purchased from Amazon. The CD which was delivered to me was in the form of a physical tangible asset. But what is the purchase which I have done? I did not buy the CD. I bought the contents of the CD. What is the content of the CD? The game. I purchased an A.R. Rahman CD otherwise. Let's take an easier case. A.R. Rahman classical hits, 999 rupees, I bought it. Now, the CD is of a physical substance, but the contents of the CD are intangible in nature. I purchased a mobile phone which was Android. An Android OS came along with it. Then in such cases, can I separate the mobile phone and the OS and still use it? Not possible. Can I separate them and license it, exchange it, rent it, transfer it? Is it possible? No, not possible yet. If you remove the Android software from that particular mobile phone, neither the mobile will work nor the software shall work. Therefore, it is inseparable. If it is inseparable, then in such case, classify based on predominant nature. The music CD of A.R. Rahman hits which I bought, empty CD 10 rupees. Why did I pay 999 rupees? Because of the contents of that CD. The content of the CD is the predominant nature of that purchase. Therefore, such song CD even has a tangible portion of the CD, It is insignificant. Since it is insignificant, the more significant or predominant nature is the contents of the CD. Therefore, it should be classified under Ind AS 38 as an intangible asset. If the tangible component is predominant, then I will classify it as Ind AS 16. Guys, it should be yes and no. If tangible component is predominant, yes, classify under Ind AS 16. If your answer is no, then classify under Ind AS 38. Clear? Very clear there. So we have completed the recognition criteria where I am saying I will recognize an asset under Ind AS 16 only if it satisfies three criteria. First one, future economic benefits are probable to arise. The word probable is very important. Probable means I do not know what is the quantity of benefit and what is the timing of the benefit. The asset is within the control of the enterprise. Cost of the asset can be measured reliably. The same three recognition criteria are applicable even for Ind AS 38 intangible asset and Ind AS 40 investment property. However, regarding Ind AS 38, since it is a non-monetary asset without a physical substance, an additional recognition criteria should be met, which is regarding identifiability. According to identifiability, he says, it is an intangible asset is identifiable if it can be separable. What do you mean by separable? It is acquired through a separate legal right, or it is capable of being separated, sold, transferred, exchanged, licensed, and rented. If it is inseparable, that means you cannot separate the tangible and intangible parts, then in such case, classify based on predominant nature. Tangible part is more predominant, Ind AS 16 property, plant and equipment. Intangible part is more predominant than Ind AS 38. This is the aspect of recognition and measurement, guys. I'll come back to this concept. There is a difference between Ind AS 16 and Ind AS 40. There's always a difference. Ind AS 16 talks about property, plant and equipment. It also talks about providing on rental to others, right? Three purposes, right? What are the three purposes? It is for the use in the process of production, provision of services, rental to others. Rental to others is also there. If a property, plant and equipment is available for rental to others, the same concept of Ind AS 40 is also getting triggered, because Ind AS 40 investment property is also held for capital appreciation or to derive lease rental and operating lease. There is a conflict. If I have a building, then where should I classify it? I'll tell you. A building, if it is occupied by the enterprise themselves, I have occupied it myself for the purpose of, let's say, my office premises. It shall be classified as Ind AS 16 property, plant and equipment. Due to increase in the size of my workforce, my building in which I own and where I operate is no longer sufficient. So I shifted from this business premises to another business premises. But this business premises which I own, which I left, what do I do with it? So I started leasing it out to someone else. I gave it on operating lease and started deriving lease rental every month. Then that asset, that building, which was until then used for my office purposes, was classified as Ind AS 16. Now, once I moved out of the premises and have given out the premise on rent, then I will have to now classify it under Ind AS 40 as investment property. Here, so you need to understand the concept of Ind AS 40 and the distinguishment with Ind AS 16. Any other asset other than land and building which is given on rent should always be considered as Ind AS 16, because Ind AS 40 is only limited to land or a building or a combination of both. That is why we come across this situation of Ind AS 16 versus Ind AS 40. If a property is held for more than one purpose, that means I have a building First floor I occupied. Second floor I gave it on lease. Then in such situation, that building is basically used for more than one purpose. Then you have to see whether I can separate it or not. How do I know whether it is separable or not? The property can be considered as separable if the property can be sold or let out under finance lease separately. That means I can lease out one floor while keep occupying one floor. Then you can say that if it can be sold separately or leased out separately, then to the extent of owner occupied premises where I am using it for my own office, I will classify it as Ind AS 16 property, plant and equipment. To the extent it has been sent out or it has been leased out on operating lease to derive lease rentals, I will classify that part as investment property. However, if it cannot be separated, I am running a co-working space. Okay, I'm running a co-working space. I occupied one chair. All rest of the chairs have been leased out. Can you separate? Not separable. In such case, which is more significant? If leased out space is more significant, classify it as Ind AS 40. If owner occupied space is more significant, then I will classify it as Ind AS 16. Here, this happens to be a situation where an asset has been used for more than one single purpose. Sometimes happens that I provide auxiliary services. What is auxiliary services? Co-working space. I provided you space, furniture, plug and play, direct. You can come down, put your laptop, all services are provided. Office boy is there, reception is there, conference room is there, cafeteria is there, everything provided along with that particular set. In such case, if I am providing such kind of services, those are auxiliary services. I'm providing you washrooms, I'm providing you housekeeping, I'm providing you a clerk, I'm providing you reception, I'm providing you your cafeteria facilities, conference room facilities, air conditioning, everything being provided. So these are auxiliary services provided along with the lease of that space. Correct? If the auxiliary services are significant, when do you say they are significant? I will call them as significant if they can influence the price at which the property is let out. Each seat in a co-working space costs between 8 to 10,000 rupees. Each seat is costing me 8 to 10,000 rupees, which is significantly high. No one will charge you 8 to 10,000 rupees without all these facilities. Furniture, your air conditioning, beautiful premises, cafeteria, all facilities provided. That's why it is that pricey. So ancillary services provided with the property rent have significantly affected that particular property. So let out the lease rental is significantly influenced by ancillary services. Therefore, it should be classified as Ind AS 16, not as Ind AS 40. Because it is not just a lease, it is a lease with ancillary services being provided. However, if ancillary services are insignificant, I have a flat which I have leased it out. While giving the flat on rent, I told the tenant that watchman will be there, water facility is there, electricity facility is there, and those are things which are always there. If those facilities are not provided, I won't even take your property on lease. So therefore, the auxiliary services provided along with the rent of your flat is insignificant. It does not influence the price at which the flat has been let out. Therefore, since its auxiliary service is insignificant, I'll classify it as investment property under Ind AS 40. These are the two situations where auxiliary services and properties held for more than one purpose are having a distinction or a diverse classification between Ind AS 16 and Ind AS 40. And that will bring us to the end of discussion on recognition of your Ind AS 16, Ind AS 38 and Ind AS 40. Here. Yes, guys, so let's bring in recognition and measurement now. Guys, when I start about recognition and measurement, you need to understand that except for Ind AS 40, the recognition and measurement is significantly similar in other two topics. Under Ind AS 16 and 38, it is very similar. Look at Ind AS 16 and 38. Initial recognition and subsequent recognition, if I talk about, my initial recognition of Ind AS 16 and 38 should always be on the date of acquisition at cost. There is no moving away from cost. Even for Ind AS 40 also, if I look at the initial recognition on the date of acquiring that particular asset, it should always be at cost. However, the difference between Ind AS 16, 38 and 40 appears under subsequent recognition. On each balance sheet date, when I subsequently recognize an asset, then for Ind AS 16 and 38, I can either adopt a cost approach or I can adopt a revaluation approach. What is your cost approach? Cost approach basically means the original cost reduced by accumulated depreciation to get the written down value to be presented in your financial statements, which we are very much aware of. Then what is this revaluation approach? Revaluation approach means where I will start making sure that the assets should be measured at their fair value. I will make sure that the assets are measured at their fair value. So to identify the value of an asset, let's say a particular vehicle. On 1st April 2020, the vehicle value was 100. On 31st March 2021, towards the end of the year, it was 95. I will charge 5 rupees as depreciation and 95 rupees will become the written down value of the asset under revaluation model. Can't there be upward revaluation? There can always be upward revaluation also. I took the easier example of downward revaluation. We will see what will happen in the case of upward and downward revaluation at the later part. What about Ind AS 40? According to Ind AS 40, my subsequent recognition on balance sheet date should only be as per cost model. We cannot have another revaluation model as far as Ind AS 40 is concerned. Clear? That means your investment property on a subsequent date of balance sheet date should always be measured on cost approach. You cannot apply revaluation approach, which is possible in the case of Ind AS 16 as well as Ind AS 38. Clear? This is regarding your recognition. Now, first thing, when I say initial measurement should be at cost on the date of acquisition, how do I identify the initial cost? That should be the concept. Let's see. Initial measurement, when I have a separate acquisition, that means I acquired this asset separately. Then in the case of such kind of acquisition, cost to be included for recognizing an asset should be cost of purchase of the asset minus the trade discount, all other direct costs incurred to bring the asset to its current location and condition in which the management intends to use this. Let's say I purchased an air conditioner. The air conditioner was purchased at a price of 25,000. Air conditioner got delivered into the house. He said delivery charges 500 rupees. I paid him 25,000. I paid for the air conditioner. 500 rupees I paid for the delivery. Now the air conditioner is in my premises. So what is the total cost? 25,500. Is it sufficient? No. That air conditioner has to be mounted onto a particular wall, and on that wall I'll have to make sure that it is connected to the electricity. So there is a significant installation cost. So I bought in one more person who has installed that particular asset, who has installed that AC onto a particular place, and he gave me the remote and he said, sir, switch on the AC. Now it is working. I said, yes, it is working. He charged me 1,500 rupees as installation charge. Even such installation cost should also be included in the cost of the asset. Therefore, cost of purchase plus the delivery charges, that is cost incurred to bring the asset to the current location and to install it, that is to bring it in a particular condition in which I intend to use it. All such costs should be included in the cost of asset. Apart from this, an additional cost should be included is called as estimated cost of dismantling, removal and site restoration. Now, what am I saying? This air conditioner has a useful life of 5 years. After 5 years, I will have to dismantle the asset and have to sell it as scrap. The cost of dismantling the asset, that is removing the asset from there and putting it down, will cost 2000 rupees at the end of 5th year. Guys, 2000 rupees at the end of year 5. What is the discounted present value now? That is called as estimated cost of dismantling, removal and site restoration discounted to its present value should be included into the cost now itself. This part, last part, that is the present value of estimated future cost of dismantling, removal and site restoration is called as a constructive obligation. This concept of constructive obligation appears under Ind AS 37. What is constructive obligation? The obligation for removing the air conditioner, I have got the obligation when I installed the AC. When I installed the AC, I had taken up a liability to dismantle it at a later point of time. These are called as constructive obligations. These constructive obligation for present value of estimated future dismantling cost should also be included, and they have to be depreciated over the useful life of the asset. That means instead of charging it to P&L in the year in which I incurred the dismantling cost, I am including it on cost today and I am charging depreciation over the useful life of the asset. These are the three inclusions in the cost of the asset when you have acquired the asset separately: cost of purchase, other direct cost to bring the asset to the current location and condition in which the management intends to use the asset. Third one, present value of future cost of dismantling the asset, removing the asset and restoration of the site. Second type, where multiple assets are acquired in a single transaction. I acquired the asset separately, but it was not one single asset. There are 3 or 4 assets put together which I acquired by paying one simple price. Slump sale, this is slump purchase. That means not one asset, group of assets put together are bought. In such cases, I will have to allocate the purchase price to each asset acquired in the proportion of their fair value. I'll have to allocate the purchase price to each asset acquired in the proportion of their fair value, provided sum of all fair values of the asset acquired is less than the purchase price. A, B, C, D, 4 assets together were purchased. A's cost was 40, B's cost was 30, C's cost was 20, D's cost was 10 fair values. I acquired it by paying 80 rupees. What is the sum of fair values? A 40 plus B 30 70 plus C 20 90 plus D 10 100. Sum of fair values of the asset is greater than the transaction price or purchase price of 80. In such case, 80 will be allocated to A, B, C, D in the ratio of 4:3:2:1. But if my purchase price is not 80 and instead it is 105, then what should I do? Then recognize A, B, C, D not in the proportion of fair values, but it should be recognized at fair value. A should be recognized at 40, B should be recognized at 30, C should be recognized at 20 and D should be recognized at 10. Sir, but I paid 105, 5 rupees extra I paid. That 5 rupees excess payment should be recognized as goodwill because your purchase price is more than the sum of fair value of the assets acquired. Clear? This is the concept of multiple assets being acquired in a single transaction. When I acquired multiple assets in single transaction, then the purchase price should be allocated to each asset in the ratio of their fair value, provided the sum of fair values is greater than the purchase price. If the transaction price or purchase price is more than sum of fair value, then the difference between the sum of fair value and the transaction price should be recognized as goodwill, and each asset acquired should be recognized at their fair value. Clear? What about self-constructed asset? I made my own asset. Let's say, for example, I was supposed to construct a building. So what I did, instead of buying a building as such, I purchased building material like cement, sand, concrete, steel separately. I engaged labor and I made sure the construction is complete. This is what normally everyone does. This is called as self-constructed asset. I did not buy the building as such, but I constructed the asset myself. In such cases, all costs incurred to bring the asset to the location and condition in which the management intends to use it should be included in the cost of the asset. So that means cost of material like sand, cement, steel, metal purchased, plus cost of labor, that is wages paid to those workers, everything included should be the cost incurred by the management to bring the asset to its location and condition in which the management intends to use that particular asset. However, whenever I have such kind of self-constructed asset, I should do a testing. The testing means commissioning. That means let's say a machinery was made. I purchased metal, I assembled the metal in such a way that there is a machinery which is produced. I put in some raw material and I got the output. Output is my desired output, the way I want to see the output. Then I will say testing is successful. Then even the testing cost should be included in the cost of the asset. But if the testing is failed, I put in some raw material, I got an output, but this output is not the desired output. That means my commissioning or testing failed. In such cases, the cost of the failed testing should not be included in the cost of the asset. Clear? Only successful testing cost should be included in the cost of the asset. Failed testing cost should be charged to P&L. Clear? What about exchange of assets? I purchased this asset with the help of exchanging already owned asset. I already own a particular asset. I gave up that asset and I acquired a new asset. In such cases, the asset acquired should always be measured at either the fair value of the asset acquired or the fair value of the asset given up, whichever is more clearly evident. I'll have to recognize the asset acquired at the fair value of the asset given up or the fair value of the asset acquired, whichever is more clearly evident. How do you know which is more clearly evident? Generally I'm talking about the asset acquired is more clearly evident. Let's say I purchased a new car by giving up my old car. New car price is 15 lakhs. I went to Maruti True Value or Cars 24 and I asked him to take off this car as an exchange. Said, sir, for this car, I can give you 2 lakh rupees. I purchased a new car by paying 10 lakhs, but out of which 2 lakhs was reduced. So there is an exchange of asset. Which fair value is more clear? The new car fair value is more clear. The old car fair value is not reliable only. Because if I exchange it, he'll give me 2.5 lakh. If I would have sold it, I would have only got 2 lakhs. If I would have given it to my friend or my brother, then I would have charged even less. So fair value becomes very subjective. That is the reason why he said whichever is more clearly evident. However, the asset acquired by exchange of another asset should not be measured at fair value in two situations. Number one, the transaction lacks commercial nature. My friend liked my phone. He gave me his phone and took my phone. He swapped the SIM. Exchange of asset. Does it have a commercial transaction? Absolutely no. Such kind of transactions which lack commercial nature should not be recognized at all. That is the first exception. Second one, I don't know the fair value of the asset acquired, neither I know the fair value of the asset given. Both I don't know. I gave up one asset, I acquired another asset. I don't know what is the fair value of the asset which I acquired, neither I know the fair value of the asset which I gave. In such cases, if the fair value of either the asset given up or the asset acquired cannot be identified reliably, then you cannot measure them at fair value. In such cases, I will measure them at the carrying value of asset given up. Asset given up is my own asset. It is already existing in my books of accounts. So the carrying value of the asset given up should be considered as the value at which I will recognize the asset acquired. This is only possible in cases where the fair value cannot be measured reliably. Next one, measurement through Garmin Grant. If there is a Garmin Grant which is received against which I acquired the asset, I purchased a recycling plant. Government has given me a grant of 2 lakhs against the asset of 10 lakhs. To set up an industrial unit, government has given me land at a price of just 50,000 rupees. These are acquisition through Garmin Grant. Whenever I acquire through Garmin Grant, then I can have two different types of treatment as given under Ind AS 20. According to Ind AS 20, two types of treatment. Number one, measure the asset at fair value, and the Garmin Grant received should be credited to an account called as Deferred Garmin Grant account. I received a land worth 1 crore rupees just by paying 1 lakh as grant. So I'll record land account debit 1 crore, to bank 1 lakh, to Deferred Garmin Grant 99 lakhs. This Deferred Garmin Grant should be credited to P&L over the useful life of the asset, over the period for which the conditions attached to the grant are expected to be satisfied. Clear? Or alternative treatment suggested by Ind AS 20 is recognize the land only at 1 lakh. Reduce the Garmin Grant from the cost of the asset. 10 lakhs asset, 2 lakh grant, recognize the asset only at 8 lakhs. This way I can recognize it as per Ind AS 20. This is regarding acquisition of an asset from Garmin Grant. Two new aspects which will come under Ind AS 38 and one new aspect which comes under Ind AS 40. What are these aspects? Under Ind AS 38, there is an acquisition through business combination. What is this? I acquired intangible assets on, I acquired tangible along with intangible asset on business combination. I am a acquirer. He is the transferor. The transferor recognized a particular intangible asset. I will recognize as an acquirer that intangible asset in my books of accounts after the business combination only if the recognition criteria is met in my books. Let's say recognition criteria is not met in your books, man. It was an intangible asset recognized by the transferor, but the acquirer recognition criteria not met. What will happen? I won't recognize the asset. What happens in that case? Goodwill arising on business combination will increase. How? Because goodwill is equal to purchase consideration minus fair value of assets and liabilities recognized. Automatically the fair value of the assets and liabilities will come down because one such asset is not recognized. Therefore, automatically the value of goodwill arising on business combination as per Ind AS 103 increases. Contra using. What if the intangible asset was not recognized by the transferor, but it met the recognition criteria in the books of transfer, in the books of acquirer? I recognize the asset. Automatically goodwill will fall or come down. Clear? Regarding intangible asset, there are a very important concepts relating to internally generated intangible asset. What is this concept of internally generated intangible asset? Let's say, for example, the enterprise was earlier following Tally software. Size of the business grew. I adopted SAP now. So my existing staff has to be trained on SAP. So I gave them SAP training. My SAP training cost was 50 lakhs. My SAP training cost was 50 lakhs to my employees. Can I recognize the training cost as an intangible asset? Think about it. Future economic benefit is probable. Yes. How? First of all, is it an identifiable asset? Yes. What did you develop? Skill of my employee. Future economic benefit is probable. Yes. Can you control the asset? What is the asset? Skill of the employee. How will you control? Will you tie the employee to the chair and you say that you are not supposed to move because I trained you? Not possible. So that means a skill of an employee which the employer or which the enterprise cannot monitor or cannot exercise control, you cannot recognize them as intangible asset. I'll give you one more example. Let's say every student who is appearing in my class, I have collected his mobile number and his email ID. In this way, I've generated a list. Over last 10 years I've been teaching, I've generated a huge list. The total list came out to about 10,000. Okay. This 10,000 has people who have qualified the exam and also people who are pursuing the exam even now. This huge list, someone wanted for me to share it. I said, this is my list. I generated this list. This is an internally generated intangible asset. I cannot give you an access. So, is it identifiable? Yes. Can you control it? Yes, it is within my control. Future economic benefits are probable? Yes, because I will send a message saying that my videos are up for sale or my classes are up for sale. Economic benefits will generally flow in. It is probable. Cost can be measured reliably. Yes or no? No. How can you measure a cost? What is the cost which you have spent in generating that customer list, in generating that student list? Since you cannot generate the cost, I cannot recognize this. Technical know-how. Sir, my enterprise can do this particular job in the fastest time possible. Because we have been doing it since long time. We have certain techniques, sir. Certain techniques are there. Fantastic techniques that they will speed up the process. High efficiency is what we do. Recognize. Your technical know-how, can you recognize it as an asset? Sir, this man who is sitting right beside me can write at what speed, sir? 100 marks of paper he can finish in 2.5 hours. Ask him to recognize the intangible asset. Writing speed, intangible asset. Future economic benefit, probable, yes, I can complete entire 100 marks within 3 hours itself. But can I measure them at cost? Cannot be measured at cost. Because the cost cannot be reliably measured, therefore such internally generated assets cannot be recognized. I can recognize an internally generated asset only to the extent of research and development cost, which I will discuss later on. Clear? As far as Ind AS 40 is concerned, if a person has acquired an asset under a finance lease, then I will recognize as per Ind AS 116 now. It is no longer Ind AS 17. Ind AS 17 got replaced but Ind AS 116. So according to Ind AS 116, I will recognize the asset acquired either at its fair value or the present value of lease payments, whichever is lower. I will recognize the asset acquired at lower of fair value of the asset or present value of lease payments. Clear? This is the fundamental concepts regarding your measurement, initial measurement, which we discuss as a part of Ind AS 16, 38 as well as 40. We have seen 5 things: separate acquisition, multiple assets in single transaction, self-constructed asset, Garmin Grant, and exchange of asset. Apart from that, we have seen two peculiar cases of Ind AS 38 regarding business combination and internally generated asset, and one case in the case of Ind AS 40 where the asset was acquired under finance lease. So this will bring us to the end of the concept regarding measurement, initial measurement. I'm not talking about subsequent measurement yet. If you remember, we have seen initial measurement as at cost. So we are even now talking about how do I initially measure the asset. But when it comes to subsequent measurement, cost approach and revaluation approach have to be picked up. So here I will pause or we will stop. And we will look at the concept of subsequent measurement on a balance sheet date after this. Yes, guys, so let's continue with the other part of Ind AS 16, 40, and 38, where we deal with depreciation and amortization. Guys, depreciation and amortization are integral part of the standards itself. Earlier, if you remember, AS6 was there, which was dealing specifically with depreciation. But now there's no AS6 related standard. It has been merged into your Ind AS 16 itself. So 16 and 40 will deal with depreciation. 38 deals with amortization. Guys, when I talk about this concept of depreciation and amortization, I will have to include another topic as well into it. That is Schedule 2 of Companies Act 2013. Schedule 2 deals with depreciation. So I'll have to embed all the three together. Then only we will be able to identify what exactly is the depreciation. Because you need to understand that it is the company which is getting Ind AS adoption. So companies are also governed by your Companies Act 2013. So Schedule 2 depreciation becomes very important and an integral part of the discussion regarding depreciation and amortization. So we'll have to combine and check, guys. Both of them are very equally significant. So let's see. If you remember, under recognition and measurement, I just said under Ind AS 16 and 38, there's a cost approach. Even under 40, I said there's no revaluation approach possible, but only cost approach is possible. However, where property, plant and equipment and your intangible assets are involved, you can either have a cost approach or a revaluation approach at the option of the enterprise. So your depreciation and amortization is parked into your cost approach. What is your cost approach saying? Your cost approach, that is on balance sheet date, every asset has to be measured at cost minus accumulated depreciation or accumulated amortization. That is your cost approach. Now, under this cost approach, how do we measure depreciation and amortization is the concept. But let's keep it aside and let's get into the concept of what is cost and what is revaluation. Cost approach says that cost less accumulated depreciation less accumulated impairment is the written down value of the asset to be presented on each balance sheet date. While under revaluation approach, it is the revalued amount of the asset reduced by the subsequent depreciation and subsequent impairment. It is not necessary for us to impair the asset every year. The frequency of revaluation will also be discussed, where you will understand that revaluation need not be done every year. You can do it once in 3 to 5 years as well. Therefore, if I'm doing only one revaluation every 3 years, the remaining 2 years after the revaluation, I'll have to calculate depreciation or impairment. Therefore, it should be given as revalued amount or the earliest revalued amount or the latest revalued amount reduced by the subsequent depreciation and subsequent impairment. That is your measurement on balance sheet date if I am applying revaluation approach for property, plant and equipment as well as your intangible asset. What is your revaluation approach? Like I told you, frequency of revaluation, look at it. If the fair value of the property, plant and equipment changes frequently, that means you experience that this particular equipment or this particular property, plant and equipment has a change in fair value very frequently. Best example, mobile phone. iPhone 10, iPhone 11, iPhone 12. Samsung, I don't know where the S series is. S11, S10, S9. You have gone up to S13 also. Now you look at OnePlus. OnePlus 1's start, and today we are already at OnePlus 8 or OnePlus X or something like that. So if you look at the developments happen to the asset on a very frequent basis. So technologically, there is a redundance of technology which requires you to charge a depreciation on these goods, or which requires you to have a fair valuation of these assets on a frequent basis. Whenever the fair value of such assets keep on changing every year, then you will have to at least revalue them once in every year, each balance sheet date. At least once in each year, you will have to measure the fair value. But there could always be certain assets like your vehicle. A vehicle's fair value may not change every year on year because there is no significant change in the technology. The diesel vehicle stays a diesel vehicle, a petrol vehicle stays a petrol vehicle. There's no significant change in the technology which happens every year. Therefore, in case of other property, plant and equipment, where the fair value is not expected to change frequently, I will measure the fair value at least once in 3 to 5 years. At least once in the gap of 3 to 5 years. That is at the discretion of the management. Management decides when they have to do the fair value depending on what is the asset and what is the nature of that particular asset. Clear? Even your laptops change very frequently. i7, i5, i5 8th generation, i5 9th generation, i7 11th generation is also gone. So you need to understand that technological changes is requiring you to have a change in fair values frequently. Your property value regarding your land and building, significant change in fair value occurs every year. In such cases, I will do the fair valuation each year. Whenever I do fair value, two things can happen. Either there is an increase in the value of land, increase in the value of an asset, or decrease in the value of an asset. What is the treatment whenever there is an increase or a decrease in the value of an asset under revaluation approach? Under revaluation approach, at the first time when I revalue the asset, and now the revaluation of the asset is upwards. In such case, the increase in the value of an asset should be credited to revaluation surplus. It should be credited to revaluation surplus. Therefore, the entry which I pass is asset account debit to revaluation surplus account. But let's say first revaluation itself is downward. That means you are reducing the value of the asset, or I would say that the fair value of the asset under revaluation approach is less than the carrying value of the asset. In such case, where the revalued amount is less than the carrying value, I have to charge it to P&L. So in straight sense, I will write the entry as P&L account debit to asset. Clear? This is the end treatment when you are initially, first time, revaluing the asset. But asset has a useful life of a long period of time. So revaluation happens subsequently as well. So whenever there is a subsequent revaluation for a particular asset, which was initially upward revalued. Initially, the asset was revalued upwards. Subsequently, again, the asset is again upward revalued. What you will do? Furthermore, increase, again credited to revaluation surplus. Entry will stay the same. Asset account debit to revaluation surplus. But an asset which was earlier upward revalued, where I credited it to revaluation surplus, now is going for a downward revaluation. That means the fair value or under revaluation approach is less than the carrying value. In such case, to the extent of downward revaluation, I will cancel it out from the revaluation surplus available because the asset was earlier upward revalued and I parked the increase in the value of the asset to revaluation surplus. Now when I subsequently revalue the asset downwards, to the extent of downward revaluation, I will cancel it out from revaluation surplus. You will say, sir, let's say upward revaluation earlier was 5. Now downward revaluation is 20. Then what you will do? To the extent of 5, I will debit revaluation surplus. To the balance excess 15 downward revalued, I will debit the P&L. So what is the entry? Revaluation surplus account debit, P&L account debit to asset. This entry will come in if the asset is now downward revalued but was upward revalued initially. Second part of subsequent revaluation. Subsequent revaluation for an asset which was earlier downward revalued. Earlier, the asset was downward revalued. Now, I am increasing the value of the asset or the fair valuation is more than the carrying value. Earlier, when I downward revalued the asset, what did you do? I've charged it to P&L. Now, you are increasing the value of an asset. Then what you will do? Credit the P&L to the extent it was debited earlier. Balance, I will transfer it to revaluation surplus. Let's say, for example, asset of 100 rupees was initially downward revalued to 95. Entry P&L to asset 5. Subsequently, the asset increased from 95 to 102. Then what you'll do? To the extent of 5, which was earlier debited to P&L, now I'll credit the P&L. So asset account debit 7, to P&L 5, to revaluation surplus 2. So to the extent it was debited earlier, now you credit the P&L. Balance if any or excess if any, I will credit it to revaluation surplus. Clear? If an asset was initially downward revalued, subsequently also downward revalued, then I will straightforward transfer the downward revaluation to P&L. 100 rupee asset earlier downward revalued to 95. Entry P&L to asset 5. Now it became 92. Entry P&L account debit to asset 3. So subsequently again I'll debit P&L to the extent of further downward revaluation. So this is particularly my table which I give for treatment of revaluation surplus. When it is upward revalued and subsequently downward revalued, or where it is downward revalued, subsequently upward revalued. So this is the table. Have a good look at the table because this table gives you ample clarity on what is the treatment each time you revalue the asset either upwards or you revalue the asset downwards. Now question comes up. Every reserve has a purpose. Yes or no? Every reserve has a purpose. P&L or general reserve can be distributed as dividends or can be used to write off losses or can be distributed as bonus. Your capital redemption reserve can be utilized for issue of fully paid bonus share. Your capital reserve can be utilized for writing off of capital losses. So every reserve has a purpose. Even securities premium had a purpose. Securities premium can write off preliminary expenses, can write off underwriting commission, can write off premium on redemption of preference shares or debentures, can issue fully paid bonus shares. So many purposes you had. So that means every reserve has a purpose. That means revaluation surplus should also have a purpose. What is the purpose for which revaluation surplus can be used? There are 3 guidance notes which he gave. First one, utilization of revaluation surplus for declaring dividend. Dividend is declared out of distributable profits computed as per Companies Act. And according to the definition of distributable profits, your revaluation surplus cannot be included. Therefore, you cannot declare dividend out of revaluation surplus. First one. Number 2. Utilization of revaluation surplus for issue of bonus shares. Bonus, according to Companies Act, can be only issued out of cash reserves. Reserves created out of profits. Reserves earned in cash. But revaluation surplus is not earned in cash. pure non-cash reserve. Since it is a non-cash reserve, it cannot be utilized for issue of bonus shares. Two guidance notes I discussed. In both guidance notes, I'm saying not possible to declare dividend, not possible to issue bonus. Then what can it be used for? He says revaluation surplus has only one use. Either you reduce it from, either you utilize it when you further downward revalue the asset, or such amount of revaluation surplus can be credited to P&L to the extent of excess depreciation charged in P&L due to upward revaluation of the asset. For example, let's say an asset had an original cost of 100. It was upward revalued to 105. Let's say the useful life of the asset is 5. On original cost, the depreciation to be charged would have been 20. But since you have upward revalued the asset, 105 rupees, 5 rupees transferred to revaluation surplus. Now the depreciation is not 20, but it should be 21. So he's saying 1 rupee of excess depreciation which you debited to P&L, to the extent of 1 rupee, you credit the P&L from revaluation surplus. That means you will recognize the entry of revaluation surplus to P&L 1 rupee. So debit side depreciation 21, credit side revaluation surplus 1 rupee. Ultimately, the net effect on P&L should be only to the extent of depreciation on original cost. That is the only possible utilization of revaluation surplus which is allowed as per the guidance note issued by ICAI. Clear? Revaluation surplus is a non-cash reserve which is ineligible to pay in the form of dividend or bonus shares to shareholder. It can be credited to OCI in the statement of profitability to the extent of excess depreciation charged on upward revaluation of asset. Here. Now, park the depreciation aside, revaluation aside. Let's get back to your depreciation and amortization, where we'll also look into schedule 2 as well. Depreciation. How do you charge depreciation or define depreciation? The cost of an asset, that is a property, plant and equipment or investment property or intangible asset, the cost of an asset should be charged to P&L. Should be charged to P&L as depreciation. How long? Over the useful life of the asset. How much? In the proportion of economic benefits expected to be derived from the use of the asset. I'll repeat. The cost of the property, plant and equipment or intangible asset or investment property should be charged to the debit of P&L as depreciation. How long? Over the expected useful life of the asset. How much? In the proportion of the economic benefits expected to be derived from the use of the asset. Now, what is this economic benefits expected to be derived from the use of the asset? Let's say, for example, you purchased a new machinery, guys. What will happen? Initially, I'll start with 20% production. I will distribute samples to my customers. I will start accepting orders from customers. Slowly, my production capacity increased to 35. Second year, it became 50. Third year, it became 80. Fourth year, it became 100. So what happened? Your utilization of the asset is expected to go up every year. So that is the pattern in which the benefit is expected to be utilized from the use of the asset. Take an example of a new vehicle. You bought a new bike, man. What do? Bike is a fancy. Tell me, what do you do with your new bike? First time when I buy, I first go to every place, make sure that I show off my bike as much as possible, right? Every day I keep cleaning my bike. Or what? Every day. At each traffic signal, I'll get down, I'll clean my bike, I'll see whether it is shining or not. Again, I get back on the bike and I'll go. 1 year later, once in a day, I'll clean my bike. 2 years later, once a week, I'll clean my bike. 3 years later, Every time there is a rain, I will throw my bike outside, automatically it will get washed. Free wash. So after 4th year and 5th year, I don't want to use that bike anymore. I'm not fancy of my bike anymore. So what happened? Your utilization of or the economic benefit that you derived from the vehicle, just at the beginning, slowly started dropping. That is fundamentally the pattern of economic benefit expected to be derived from the use of an asset. So in the case of a vehicle, I will charge higher depreciation at the beginning and lower depreciation towards the end. But in the case of the machinery example which I gave you, I will charge lower depreciation at the beginning since my capacity utilization is less than 50%. As the capacity utilization keeps on going up, I'll keep on charging higher depreciation. That means the depreciation should represent the pattern in which economic benefits are expected to be derived from the use of the asset, for which you use Companies Act Schedule 2. What about amortization? Amortization is exactly similar to depreciation, where the cost of intangible asset is charged to the debit of P&L as amortization over the period for which, over the expected useful life, in the proportion of economic benefit expected to be derived by the enterprise from the use of the intangible asset. However, in case of amortization, he says one small paragraph, extra line. What is that extra line? He says your pattern of economic benefits derived from the use of the asset may not be the same as revenue generated from the use of intangible asset. I'm saying revenue generated from the intangible asset may not be the same pattern in which economic benefits are derived from the use of the asset. Why is that so? Revenues are dependent upon a lot of other factors. It is dependent upon market demand. It is dependent upon customers, capacity to pay. May not only be dependent upon the utilization of that particular asset. That's why he says revenue-based amortization may not be deemed appropriate in most circumstances. He's not ruling out. He's saying most circumstances it is inappropriate. But I shouldn't use is a wrong statement. I'm saying it is inappropriate in most circumstances. That's it. I stopped there. I am not saying in all circumstances. I'm just saying in most circumstances, revenue-based amortization is not appropriate. Why is that so? Because revenue is determinant not only on the basis of utilization of the intangible asset, but is based on multiple other factors. Clear? I have three determinants of depreciation. First one is cost of the asset. Second one is estimated residual value. Third one is estimated useful life. These are the three determinants of depreciation, out of which two are estimates. Your residual value is an estimate. That is nothing but the amount which I expect to collect from the asset at the end of its useful life upon disposal. Expected estimated useful life, the time period for which the enterprise expects to derive benefit from the use of the asset. So estimated useful life and estimated residual value, both are management estimates. Therefore, most of the situations you will find that these two get revised very frequently. What is your Schedule 2 talking about? Your Schedule 2 of Companies Act discusses about depreciation. To talk about depreciation, your Schedule 2 divides your assets into two categories. First category is called as continuous processing plant. Second category is called as other assets. Other assets. And these assets are generally called as extra shift depreciation assets. Your continuous processing plant, there is no shift. Continuously it keeps on working 24/7, 365 days, it keeps on working. Such kind of assets are called as no extra shift depreciation assets. Why is there no extra shift depreciation? Because continuous processing plants, they're designed in a particular way that they are expected to run throughout. There is no shifts in a continuous processing plant. I'll give you an example. I don't know how many of you see, but most of us, we come across metal structures like your telecom towers, which are silver in color. They are particularly silver in color because of a factor called as galvanizing. What is galvanizing? Galvanizing is nothing but a zinc coating on the metal structure. Why do they do it fancier? Because silver looks better? No. Galvanizing is primarily used to avoid corrosion. Because it is outside and it is exposed to extreme temperatures, there is a very, very good reason or very good chance for corrosion to happen on the metal. To avoid this corrosion, they do a particular technique called as zinc galvanizing. What is a galvanizing? Huge swimming pool type of a tub will be there. Huge, massive, much, much bigger than swimming pools. Boiling zinc is actually added to it. Zinc is put at a boil. I'll have a crane which comes in. It will dip the material into the zinc and get it out. Automatically galvanizing process is complete. Now this zinc, to bring it to a boiling temperature, takes 48 hours. To cool down, it takes at least 24 to 30 hours. If I shut down the plant, to restart the plant again, it takes another 48 hours to reheat the entire zinc, to bring them to a boiling temperature where galvanizing is possible. That means, as such, that particular equipment is meant for continuous processing. I don't expect the zinc galvanizing plant to be shut at any point of time unless and until there is an extreme situation. I'll always expect that the zinc galvanizing plant will keep on continuing to be used. That means these assets are designed and are meant to be used on a continuous processing basis. They're designed and are meant to be used on continuous processing basis. In such case, the useful life should be as prescribed by the Schedule 2. Schedule 2 prescribes separately, and I'll have to take the useful life from there. However, other assets which are not specifically designed and meant to be used for entire continuous processing, if I use them for 3 shifts, each shift is 8 hours. If I continuously use them for 3 shifts, 24 hours, I kept on using the asset. Will it become a continuous processing plant? No. Because it is not designed to be used for entire 24 hours. You can shut down the plant, you can reopen the plant again and start producing. They are not designed for continuous processing. These assets are called as other than CPP assets or continuous processing plants, or you can call them as extra shift depreciation assets. Such assets, if they are working on a single shift basis, I will pick up the useful life as given under Schedule 2 of Companies Act. But if such asset, which is not a continuous processing plant, is used for 2 shifts, 16 hours in a day, in such case, Schedule 2 will not give you a separate useful life. Whatever separate useful life they have already given under single shift, that only is applicable. But since you are using on a double shift basis, the depreciation calculated as per single shift should be added by 50%. That means it should be 150% of the depreciation to be charged under single shift basis. Similarly, if I use such an asset where there is an extra shift depreciation and an asset is other than continuous processing plant for all 3 shifts in a day, that means throughout 24 hours in a day, then I will take the single shift depreciation and multiply it by 2 or add it by 100%. That means 2 times the depreciation I would have charged on the asset if it is used for 1 shift basis. Someone will say, sir, double shift should be multiplied by 2. Triple shift should be multiplied by 3. Absolutely not. Double shift should be multiplied by 1.5 and triple shift should be multiplied only by 2. Clear? Now, Schedule 2 has given me a particular useful life. Then he says, should I take a useful life? Can I take a useful life other than the useful life given in Schedule 2? Is it permissible to take a useful life which is shorter than your Schedule 2 useful life, or can I take a useful life longer than scheduled? There he says, initially when Companies Act was introduced, the statement read like this: an enterprise cannot elect for a useful life which is greater than specified under Schedule 2. However, greater than means you can take a useful life which is equal to Schedule 2 or less than Schedule 2 for compliance to this particular Companies Act 2013. However, subsequently in 2014, these words got replaced. Instead of saying the enterprise, saying that the enterprise should take a useful life which is less than or equal to Schedule 2, he put up like this: an enterprise should not elect any useful life other than that specified under Schedule 2, not different from the useful life specified in Schedule 2. Not different from means you cannot take less than that, you cannot take more than that. Okay, fine. That means you have to take exactly whatever is the useful life under Schedule 2. And my question is, don't you think there should be a flexibility? How can you tell me what my useful life is? I can take a useful life which is other than Schedule 2. Who are you to stop me? No one will stop you. If an enterprise elects to apply a useful life other than the useful life specified under Schedule 2, then the enterprise should provide sufficient disclosure. That's it. So non-compliance is never a crime. As long as you are saying that, yes, I am not following Schedule 2, I am taking a different useful life. Why? Because I feel that the useful life of the asset in my enterprise is much longer or much shorter than the Schedule 2 useful life. So that means a crime of non-compliance can be covered by giving disclosure. That means I will kill you, and if I say that I killed you for this is reason, then I am not considered to be non-compliant. I am very much considered to be a compliant. Clear? So that is what Schedule 2 talks about. Yes, guys. When I said there are 3 determinants of depreciation, and I said estimated useful life should be not different from the useful life specified under Schedule 2. One more estimate is there, that is estimated residual value. According to Schedule 2, the estimated residual value should not be exceeding 5% of the original cost. Should not exceed 5% of original cost of this. Again, in 2014, just when your useful life was amended, same amendment applied even to residual value. Because now he says the residual value of an asset should not be different from 5% of the original cost. That means what? Exactly 5% should be the residual value. Non-compliance, again never crime. Sufficient disclosures are required if you take a residual value of less than or greater than 5%. Clear? Any doubts till now in Schedule 2? Please let me know, guys. Like we have seen regarding depreciation, even amortization also there is something to be discussed as far as useful life and residual value is concerned. Schedule 2 said the residual value should not be other than different from 5% of the original cost, and the useful life as described under Schedule 2 of Companies Act should be considered as its useful life. Anything other than that, if you consider either in the case of residual value or useful life, you will have to give sufficient disclosure. Correct? Keep it there. Now come to intangible assets. Regarding amortization, I'm talking about. The residual value of an intangible asset should always be considered as zero. Any intangible asset, I'll always consider that its residual value is zero. Clear? Now, however, I can take a residual value other than zero only in two cases. Only in two situations I can take a residual value of an intangible asset as other than zero. What are those two cases? Case number one, where the enterprise has entered into a binding sale agreement with another enterprise to dispose the asset at the end of its useful life. Let's say, for example, a movie, super hit movie, okay? Let's say Amitabh Bachchan's greatest hit, Don or Sholay, is an intellectual property right or an intangible asset as per India's 38. For example, a particular company, let's say T Series, has acquired the right to make a digital of or a CD of Sholay or Don for a period of 5 years. At the end of 5 years, T Series has granted, at the end of 5 years, I'm saying, I will give you this right to another party X, or let's say it has given to another company, let's say some other company, HMV, let's say. So what happens here? At the beginning itself, I have entered into a binding sale agreement saying that at the end of 5 years of my lease or at the end of the useful life of the asset, I will dispose this asset or I will transfer this asset at a particular value. In such case, where residual value is available right at the beginning itself. What is the residual value? That agreed binding sale agreement price. Therefore, in such cases, residual value cannot be considered as zero. When it cannot be considered as zero? When the enterprise has entered into a binding sale agreement to transfer the intangible asset at the end of its useful life at a particular value under the agreement, then the residual value is not zero, but it should be considered as the agreement price. Another case where residual value is not zero. I cannot take the residual value of an intangible asset as zero if an active market exists. There is an active market which exists for that intangible asset. And I expect that this active market will continue to exist even at the end of the useful life of the asset. Then in such case, residual value is not zero, but residual value should be equal to the estimated fair market value at the end of useful life. Residual value is equal to estimated fair market value at the end of the useful life of the asset. Clear? So generally the residual value of an intangible asset should be considered as zero unless two situations. Number one, the entity entered into a binding sale agreement to dispose the intangible asset at the end of its useful life at an agreed price. In such case, residual value is equal to agreed price or agreement price. Or the intangible asset has an active market and such active market is expected to exist even towards the end of the useful life of the asset. In such case, residual value is not zero, but residual value is the estimated fair value of the asset at the end of the useful life of the asset. Clear? Regarding useful life of the asset, there is a particular restriction under amortization of intangible asset, where he says, generally the useful life of an intangible asset should not exceed its legal right. That means, let's say I acquired the license of a particular software for 10 years then I will continue to take the useful life as less than or equal to 10 years. It cannot exceed by legal rights. Let's say I have purchased a Tally software for 3 years. Then what is the useful life of Tally software? It can be either equal to 3 years or less than 3 years. That's it. Cannot be greater than 3 years. However, it can be greater than 3 years only if I, as an enterprise, have an option to extend the legal right. And it is reasonably certain that I will exercise the option to extend my legal rights. Clear? So I'm saying the useful life should be restricted to a maximum of the legal life of the asset. A useful life can exceed the legal rights only if the option to extend is available to the enterprise and it is reasonably certain that the enterprise will exercise its option to extend the legal rights. Sometimes there could come across a situation where there is an indefinite life. There is no definite life. Let's say Facebook has acquired WhatsApp. The purchase consideration minus the assets acquired, there is a significant amount of goodwill which emerged. Whenever there is a significant amount of goodwill which emerged, the goodwill is created due to the users on WhatsApp. Today also, WhatsApp is probably the only social network which has the highest number of users. The goodwill, what is the useful life? 10 years, 15 years, 50 years, 100 years? I don't know. There can always be a competitor who can come up tomorrow and all the users might shift into that network, like Signal. Signal has come in and so many people have actually started using Signal. Now, unfortunately, we are using both Signal and WhatsApp. That is another issue. But sometime, let's say, maybe we tend to close down our WhatsApp and start our presence on Signal mode. So in such cases, the useful life or the life of the asset for which I expect economic benefits may not be ascertained with certainty. That is called as indefinite life. Indefinite means not infinite. Infinite means for any number of years I will get the benefit. Indefinite means I don't know for how long. But I am getting the benefit, but I don't know for how long I will be able to derive the benefit. It is called as indefinite life. Whenever an intangible asset is said to have an indefinite life, you cannot calculate amortization. How do you calculate amortization? You tell me. Cost minus estimated residual value, which is generally considered as 0, divided by estimated useful life. Let's say your estimated useful life is indefinite. You only don't know. Then divided by I don't know, what will be the answer? I don't know. That is the reason why I'm saying amortization for an asset which has an indefinite useful life cannot be ascertained. That means such kind of assets should not be amortized. Then what should I do? Such assets have to be tested for impairment every year. Every year I will test them for impairment instead of charging amortization on such kind of assets. Clear? So what am I saying? I'm saying that sometimes we can come across an intangible asset where the useful life cannot be defined. I don't know how long that I will be able to use that particular asset. In such cases, I will call that as an intangible asset with indefinite life. Whenever an intangible asset is said to have an indefinite life, then I will not calculate amortization on that asset every year. Instead, I will charge or I will identify impairment on that particular asset at the end of each year. Guys, if you look at Ind AS 36 regarding impairment, I will test an asset for impairment only if there is an indicator of impairment. If there is no indicator of impairment, I won't test it for impairment. However, there are 3 assets which have to be impaired every year, whether there is an indicator or not. Whether you have an indicator, you don't have an indicator, I am least bothered. I will compulsorily test them for impairment. Out of those 3 assets, one of the asset is such intangible asset which is expected to have an indefinite useful life. What are the other 2 assets? I will discuss about that, but in detail we'll take up when we are talking about Ind AS 36. 3 assets have to be impaired every year. Intangible asset with indefinite life, Number two, an intangible asset which is in the process of development. It is not completed. It is still in the process of development. That is number two. Number three, goodwill arising on business combination has to be tested for impairment every year. These are three assets where I don't charge amortization. Instead of charging amortization, I will test them for impairment every year, whether there is an indicator of impairment or not. Clear? Now we have seen three determinants of depreciation, right? What are the three determinants of depreciation that we have covered? First one was cost, estimated useful life, estimated residual value. Now, these three are subjected to change. Why does the cost of an asset change? Can change. Impairment can change the cost of an asset. Revaluation also can change the value of an asset. Estimated useful life can change. My intention, my estimate can change. When I go to the exam hall and when I basically start thinking of preparing for the exam, my estimation that this subject I will get 70. Wrote the exam, I came out of the exam, I said 50. Result came 45. So there is a change in the estimate. So residual values and useful lives are pure estimates which are subjected to change. Whenever there is a change in determinant of depreciation, then it should always be given a prospective effect. What do you mean by prospective effect? That means the depreciation of the future periods should undergo a change. I will only change the depreciation of future periods. Clear? So that means the remaining cost of the asset should be depreciated over the remaining useful life of the asset. It should only be considered as a change in accounting estimate. Change in method of depreciation. Earlier, I followed straight line method. Now, I think sum of digits or written down value or reducing balance method is a much more appropriate method here. Then in such cases also, it is only a change in estimate. What estimate change? Depreciation or amortization should represent the pattern in which economic benefits are expected to be derived by the enterprise. Expected. If you have change in expectation of deriving benefit from a particular asset, then automatically the depreciation also will change. If there is a change in the method of depreciation, it is still a change in estimate. My estimate of deriving economic benefit from the use of the asset has changed, which required me to change the method of depreciation. Therefore, it is a change in accounting estimate only to be given a prospective effect. Clear? With that, we come to the end of discussion on this concept of impairment, depreciation and amortization, guys. We are done with this topic of Ind AS 36, Ind AS 38, 40 and 16, property, plant and equipment, intangible asset and investment property. Clear? Yes, guys, let's get into this concept of impairment of assets now. We have seen property, plant and equipment. We have seen intangible asset. We have seen your investment property as well, where we have discussed about depreciation and amortization. When we are already depreciating the asset, amortizing the asset, what is this impairment now? Impairment also discusses about loss in value of asset. Even depreciation is also loss in value of an asset only. The depreciation arises due to three reasons. Depreciation of an asset arises due to three reasons. First one, wear and tear on use, obsolescence of technology, or lapse of time, passage of time. So, wear and tear on use, lapse of time, obsolescence of technology are particular reasons for which depreciation is charged on a particular asset. If there is a fall in the value of an asset or a loss in the value of an asset arising for reasons other than depreciation, then I have to charge impairment on the asset. Let me put it like this. Let's say, for example, I am transporting a particular, I've asked you to transport a particular bench from the ground floor to the fifth floor. While you're taking it back to the fifth floor, the bench was dropped twice. On the stairs, you dropped the bench twice. Dumb. However, you have brought it to the fifth floor, you put it on the fifth floor. I saw the bench in the fifth floor, slight dents here and there. However, students can sit on that bench and still can use that bench. Straight question. Did the value of the asset reduce or no? Simple word. Did the value of the asset reduce? Yes or no? My phone dropped from here down. There is a compulsory physical damage suffered by the phone, but it was still in a working condition. Still working condition, you tell me, is there a decrease or reduction in the value of an asset? Yes, it is. The loss or fall in the value of an asset is due to wear and tear on use? No. Is it because of lapse of time? No. Did the technology change? No. That means there is a loss in the value of an asset which is not because of reasons arising from depreciation. Such kind of reasons, if there is a loss in the value of an asset, it leads to impairment. Remember, reasons of impairment loss are generally isolated. They are quite abnormal in nature. They are not expected to recur. They are generally not expected to recur. I don't expect the loss or arising due to impairment to occur again and again. Clear? Yes, guys. So that is impairment. Impairment is a fall in value of an asset or a loss in value of an asset arising due to reasons other than depreciation. So reasons of depreciation are wear and tear on use, obsolescence of technology, and lapse of time. Impairment occurs due to reasons which are other than these three. And these reasons are generally isolated and abnormal in nature. Clear? Now, let's move and look into impairment. How do I measure impairment? Impairment is measured by a simple formula: carrying value of an asset minus recoverable amount. What do you mean by carrying value? It is nothing but book value of the asset. What is recoverable amount? I'll tell you. Recoverable amount is the amount which I expect to recover from the asset. I expect to recover such value from the asset. How can I recover value from my asset? Two ways. One, I can use the asset for its useful life, or I can dispose the asset. Either way, it is possible. Either I use the asset over its useful life, or I dispose the asset. I can recover value from that particular asset. Which one will I do? Will I use the asset over the useful life, or will I dispose? Depends. If by disposal I will get 100 rupees, If you use the asset, you will get only 50 rupees. I will dispose the asset. If by using the asset, the value in use is much greater than the value which I derive from selling the asset, then I'll obviously use the asset. Therefore, whichever is higher should be considered as recoverable amount. The amount which I expect to recover either from using the asset or by selling the asset, whichever is higher, is called as recoverable amount. It is simply given as higher of value in use or net selling price. Net selling price is nothing but fair value minus cost to sell the asset. Fair value minus cost to sell the asset. Let's see a little bit of discussion on recoverable amount. What he says regarding recoverable amount is, he says if an enterprise has no reason to believe that economic benefits derived from the sale of an asset is greater than the benefits derived from the use of the asset. If I have no reason to believe that I will get a greater benefit from selling the asset rather than from using the asset, then I will say recoverable value is equal to value in use. I'll completely forget about that concept of net selling price. Here, first one. Why does this occur? You tell me, first situation. Why does this occur first of all? What is a situation where I don't believe that selling the asset will give me greater benefit from using the asset? Let's say I purchased the asset just now. I'm just started using the asset. Let's say you bought a bike. If I tell you, why did you buy a bike? You can happily go in a metro. You can sell the bike immediately. You can get so much of benefit. In such cases, I will not be inclined towards selling the bike because my intention is to basically use that bike. In such cases, I will never believe that selling the asset will give me a greater benefit than using that asset. In such cases, recoverable amount is straightforward value in use. Never even calculate net selling price. Second one, if the fair value of an asset cannot be reliably measured, you cannot reasonably ascertain the fair value of the asset. In such cases, if you cannot measure fair value, you cannot identify net selling price. When you cannot identify net selling price, the only way recoverable value can be calculated is by value in use. So therefore, I'm saying if the fair value of an asset cannot be reasonably estimated, cannot be measured with reasonable certainty, in such case, recoverable amount should be considered as value in use. You cannot calculate your net selling price. Do not say it is zero. I never said net selling price is zero. I just said you cannot measure with reasonable certainty. That's it. If the entity intends to recover the carrying value of the asset from sale rather than from use, that means this asset I've already used it enough. My intention is now to dispose the asset and get some economic benefit. I have no intention to use the asset. In such case, recoverable amount will be considered as value, will be considered as net selling price, guys. Can you change the last third one? After you get your material, please change the last one. It is net selling price, that is fair value minus cost to sell. If an entity is intending to recover the carrying value of an asset from sale of the asset rather than from use of the asset, in such case, recoverable value is equal to net selling price. Clear? How do I calculate this fair value minus cost to sell, which is nothing but net selling price? My net selling price to calculate, I should identify what is the fair value of the asset, and I should also identify what is the cost to sell. How do I measure fair value? I will measure fair value of the asset by applying the paragraphs of the standard Ind AS 113, where there are three approaches to calculate fair value: market approach, income approach, cost approach. These are the three approaches which are stipulated under Ind AS 113 for measurement of fair value. Then what about your cost to sell? How do I identify cost to sell? What are the inclusions in cost to sell? Cost incurred to make the asset marketable. I have an AC which is already fit into my house for 5 years. Now I find that it is not cooling sufficiently enough. I intend to sell the asset. I intend to sell, and I'm looking at like this. That is not possible. What should you do? Dismantle the asset, take a few photographs, put it up on OLX. So dismantling cost to basically put it up on OLX. All these costs should be included as cost to sell. Transaction cost. OLX reduced 1% of the sale proceeds for transaction done through OLX. That is called as cost of the transaction. Fee for transfer of ownership. Let's say I'm supposed to pay 500 rupees for transfer of ownership of a particular asset. Then that 500 rupees is considered to be a cost to sell that asset. In this way, I'll have to estimate what is the cost of sale. Cost to sell the asset will have three inclusions. Transaction cost, cost incurred to bring the asset to a marketable state, fee for transfer of ownership of the property. Clear? These are the three costs to be included in cost to sell the asset. How do I determine fair value? My determination of fair value, first indicator for determination of fair value is a binding sale agreement. If for an intangible asset or for a tangible asset, I have a binding sale agreement to dispose the asset at this particular date at a particular price. If I sell the asset at the end of year 1, I will sell it to you at 150. If I sell the asset at the end of year 2, I'll sell it to you at 125. If I sell it at the end of year 3, I will sell it at 105. If I sell it at the end of year 4, I'll give it to you at 70. If I sell it at the end of 5th year, I'll give it to you at 50. Binding sale agreement exists. In such case, your net selling price should be computed directly based on the agreement price. Whatever price at which you agreed to sell the asset, that should be the price at which I have to estimate your net selling price. Is it possible always to have a binding sale agreement? May not be. Let's say I don't have a binding sale agreement at all. If I don't have a binding sale agreement, then I'll see if there is an active market which exists for that particular asset. If active market exists, then the fair value is equal to the bid price in the active market. I'm saying if an active market exists, then the fair value is equal to bid price in the active market. Whatever is the bid price. What is bid price? Price which I expect from sale of the asset. What is ask price? The price at which I expect to purchase the asset. So which is more relevant here? Because I'm intending for identifying net selling price. Therefore, which is more appropriate? Bid price is more appropriate. An active market, however, does not exist. Bid price is not there, man. First of all, if there is no bid price, then I will take the most recent transaction price and perform certain adjustments. If active market does not exist only for that asset, then I should be identifying the fair value based on market observable inputs. What are market observable inputs? Whatever information is available from the free market. Stock prices of shares freely available in the market. Vehicle value of a brand new vehicle available in the market. However, if I cannot ascertain even by this method to establish a fair value, then I will not identify fair value at all. I will go back to point number 2 and I'll say, look at point number 2. What did he say here? Where the fair value cannot be identified with reasonable certainty, then your recoverable value is equal to value in use. Don't calculate net selling price again. That is exactly what we'll do. Recoverable amount is equal to value in use. So what are the checks that he is doing? Binding sale agreement exists, then the agreed price should be considered as fair value. If I don't have binding sale agreement, but there's an active market which exists, then the bid price in the market should be considered as fair value. If bid price is not available, take the most recent transaction price, perform for some adjustments. If active market also does not exist, then use market observable inputs to determine fair value. Sir, even with the market available observable inputs, I cannot determine fair value. In such cases, don't determine fair value at all. Forget about this concept of net selling price. Your recoverable amount is equal to value in use. Clear? So I put in 3 conditions for this. For recoverable amount, I'm saying I have no reason to believe that the economic benefits from sale of asset will be greater than the benefits derived from use of the asset. In such case, recoverable amount is equal to value in use. If the fair value cannot be reliably established or reasonably measured, then I need not calculate net selling price. Recoverable amount is equal to value in use. The enterprise intends to sell the asset. This asset is held for disposal only. I have no intention to use that asset. My intention is to recover the carrying value of the asset by sale of the asset rather from using the asset. In such case, recoverable amount is equal to net selling price, that is fair value minus cost to sell. Clear? This had to be changed. Point number 3. And this is determination of fair value. Binding sale agreement exists, agreed price. Active market exists, bid price not available, most recent transaction price performs adjustments. Active market also does not exist. Fair value ascertained by market observable inputs. You cannot ascertain fair value even like that. Don't ascertain fair value at all. Recoverable amount is equal to value in use. Clear? Yes, guys. So let's continue to the next topic of value in use. What is this value in use and how do I identify a value in use? Guys, it's very important to discuss about value in use, guys, because value in use is something very critical to analyze to identify your impairment, right? You cannot get impairment unless and until you identify the recoverable amount. Your recoverable amount is higher of value in use or net selling price. Until now, we were only talking about measurement of net selling price, that is fair value minus cost to sell. Now let's get into this concept of value in use because it's a very subjective concept. When I say subjective concept, I'll tell you why. Guys, if you remember the recognition criteria under Ind AS 16 or 38 or 40, we said future economic benefits are probable to arise. Why did we use the word probable to arise? We use the word probable to arise because we said we do not know what is the quantity. We do not know what is the timing for at which we will get the benefit. So therefore, when you cannot quantify the benefit, you cannot determine the timing of the benefit, you simply say that economic benefits are probable to arise. I am probable to get the economic benefit. What is the exact amount of benefit? What is the exact timing of the benefit? That I don't know. This is exactly what we are saying. So now let's look at how do I calculate this value in use. Value in use is equal to present value of future cash flows arising from the use of the asset. What is this present value of future cash flows? As we use the asset, there are certain set of cash flows which are generated from that asset. Such future cash flows generated from the asset should be discounted to their present value. Such present value of future cash flows generated from the use of the asset should be considered as value in use. What cash flows should I consider? My cash flows to be considered for computation of value in use are divided into three parts. First, cash inflows arising from continuing use of the asset minus cash outflows necessary to derive these cash inflows and net cash flows arising from the disposal of the asset at the end of its useful life. For example, I purchased a particular machinery where I input certain raw material of plastic. I get a plastic box out. Input of plastic is costing me about 100 rupees of kg. 100 rupees per kg. My output, each box is 1 kg and can be sold in the market at 125 rupees. So what is the cash inflows generated from or arising from continuing use of the asset? Those boxes, plastic boxes, which can be sold at 125 rupees per kg, is the cash inflow generated from the use of the asset. What is the cash outflow necessary to generate the inflow? The plastic input, which is costing me 100 rupees per kg, which is a cash outflow to purchase the raw material to generate the cash inflows. I will use the asset over a period of 5 years. At the end of 5th year, I intend to sell the asset. When I intend to sell the asset will derive a certain cash flow, net cash flow arising from disposal of the asset. All these three combined is considered as cash flows arising from the use or use of the asset over its estimated useful life and from the sale of the asset at the end of its estimated useful life. Clear? These cash flows should be discounted to present value to identify your value in use. When I say discounted to present value, then the question will be what should be the discount rate? 8%, 10%, 6%, 12%, 15%. What is the discount rate? He says it is a market assessment of time value of money plus risk associated with the asset. What is a market assessment of time value of money? Generally, market assessment of time value of money can be called as a corporate deposit rate or a corporate lending rate in SBI or a government bond rate can be considered as market assessment of time value of money, or in our SFM sense, in your financial management sense, it is called as RF plus risk-free rate plus risk associated with the asset. What is the risk associated with the asset? That there is a continuing demand for the output of the asset itself is a risk. So there should be an element of risk which should be added to the time value of money or market assessment of time value of money, that is RF, plus certain risk, market risk, which is associated with the asset. That will give me what is a discount rate. Using that discount rate on these set of cash flows which are arising over the useful life of the asset will be discounted to identify something called as value in use. Clear? Question first number one. How will you estimate cash inflows, Ray? How will you estimate cash inflows? We only said future economic benefits are probable to arise. That means you don't know when you will get the benefit. You don't know how much benefit you will get. That's why you said probable. Then how do I calculate value in use? For this, you will have to rely on projections, management estimates, which will give you a basis of identifying the cash flows expected to arise from the use of the asset. Current year, the company sells 12,000 units per month. Next year, the management projects to sell 13,500 units per month. That next year, they expect to sell 14,000 units a month. And finally, in the third year, they expect to sell 15,000 units a month. These are management projections. These are management estimates. These management projections and management estimates should form the basis for identifying your value in use. Clear? Cash flows should be determined by management estimates and projections, and these estimates and projections can be made only for a maximum period of 5 years. What is this 5 years logic? He's saying that you cannot estimate for more than 5 years. A reasonable estimate can only be made over a period of 5 years. If I ask you, when you were studying your +1 and +2, if I ask you, what would be your score in CA final? What will be your answer? Keep your mouth shut. Because I did not pass, first of all, +1, +2. Forget about foundation, whether I'll pass or not itself, I don't know. Then you have CA inter, which I'll pass or not, I don't know. Final, you're asking me directly what will be your score in CA final. That is not even reasonable also. If you would have at least asked me, how much do you expect to get in CA foundation, I'll be able to tell you. So beyond that, it is unreasonable to make an estimate. Same way, accounting also has limitations. According to your limitations, he says, you cannot estimate for a period beyond 5 years. A reasonable estimate of management judgment of cash flows can be made for a period of 5 years only. Sir, useful life of asset is 8 years, sir. Useful life is 8 years. You are saying you can make only cash flow estimate for 5 years. What about the remaining 3 years? For the remaining 3 years, I will not take a management estimate. What I will do is, I will take the 5th year estimate and I'll add it with a growth rate. What is this growth rate? This growth rate to be considered beyond 5 years is always a steady growth rate or a declining growth. I expect to grow at the rate of 10% every year steady. I expect to grow at 5% in year 6, 4% in year 7, 3% in year 8, and so on. That is declining growth rate. I expect to grow at the rate of 10% in year 6, 11% in year 7, 12% in year 8 is not possible, because you cannot take an increasing growth rate in performing cash flow estimates in computation of value in use. That's why he says, if the useful life of an asset is beyond 5 years, then the further cash flows beyond 5 years should be estimated using either a steady growth rate or a declining growth rate. Clear? So what did I say? Value in use is nothing but present value of future cash flows arising from the continuing use of the asset, and such cash flows which should be considered in computation of value in use are cash inflows generated from continuing use of the asset minus cash outflows generated from cash outflows which are required to generate the necessary inflows. Third one, net cash flows arising from the disposal of the asset at the end of its useful life. And I said discount rate is RF, that is time value of money, market assessment, plus any risk associated with that particular asset. And I'm saying cash flows cannot be determined. Your cash flow estimate should be based on management estimates and management judgments. However, those management estimates and judgments should not be made beyond 5 years. It is reasonable only for management estimates to be considered for a period of 5 years. Any period which is more than 5 years, if the estimated useful life of the asset is more than 5 years, I will not be basing on management judgments. From year 6 onwards, I'll identify the cash flows applying a steady or a declining growth rate. One really important concept which has been significantly tested in the exam multiple times is your foreign currency cash flows. What is this foreign currency cash flow? Foreign currency cash flow means if an asset generates cash flows in dollars or any other foreign currency, then how do you estimate what should be the value in use of that particular asset? Okay, let me see. For example, let's say an asset is intended, X Limited is having an asset, and this asset which is owned by X Limited is basically selling only produce to outside India. Asset generates some output. That output generated by an asset is sold to customers in US. Therefore, I will get back to the enterprise only amounts in dollars. In such case, when he asked me to identify value in use, I went on like this. Value in use. He wanted me to estimate the value in use. So I wrote it like this. Here, cash flows, discount factors, and discounted cash flow. Let's say this estimated useful life of the asset is only 3 years. Easy purpose, I'm taking it. My cash flows given to me are all in million. Even my discounted cash flows are also in millions. Let's say first year 100 million, second year 125 million, third year 140 million. So when your cash flows generated by the asset are in dollars each year, how do I calculate this part of value in use? Remember guys, I need recoverable amount in rupee to compare it with the carrying value of the asset. I cannot calculate value in use in dollars. Then what do? It is not possible to identify the dollar value because I cannot multiply these directly with a exchange rate. Multiplying with exchange rate is not possible because I don't know what is the exchange rate after the first year, after second year, after third year. I have no idea. So instead what I'll do is I will apply discount factors in dollars and I'll also identify value in use in dollars. So if I get value in use in dollars, I will convert it into value in use in rupee. How will you convert? Value in use in dollars multiplied by spot rate. That is today's exchange rate per dollar. This is only applicable when an asset is generating cash flows in foreign currency. If an asset is expected to generate cash flows in foreign currency, then apply only such foreign currency discount rate to calculate value in use. Such value in use in foreign currency can be converted into value in use in rupee by multiplying it with the spot rate. This is fundamentally what we understand for assets which are generating cash flows in foreign currency. First, value in foreign currency is a sum of future cash flows into foreign currency cash flows into foreign currency discount rate. Value in use in INR is equal to value in use in foreign currency multiplied by spot rate. Clear? Guys, there are multiple times questions which arise on this topic, guys, of value in use in foreign currency. Please be aware of that. Certain cash flows which should not be considered in computation of value in use. What are those cash flows? Cash flows arising from financing activities like interest, tax. You cannot calculate tax. It should always be a pre-tax cash flow. Obligation already recognized as a liability, like your dismantling cost already recognized as a liability. Future restructuring expense not committed for. After 3 years, I expect to incur another 20 million on this particular asset, and immediately after that, the efficiency of the asset increases by 50%. That is a future restructuring cost. Have you committed for it? No, I'm expecting to incur. They should not be considered. Incremental benefits arising from future restructuring of asset. If I incur that cost, in future the capacity utilization can go up by 50%. I cannot consider the extra benefit because I have not committed for that restructuring cost. When I haven't committed for the restructuring cost, benefits arising from such restructuring also cannot be considered in computation of value in use. Interest cash flow, tax cash flows, obligations already recognized as liability, future restructuring cost not committed for, benefits arising from future restructuring cost. These cash flows should not be considered in computation of value in use. Clear? How do I recognize impairment? You calculated value in use, you calculated net selling price. Higher of these two is recoverable amount. If your recoverable amount is less than carrying value of the asset, then the asset is said to be impaired. If your recoverable amount is less than the carrying value of the asset, then the asset is said to be impaired. If your recoverable amount is greater than carrying value of the asset, there is no impairment to be recognized. If there is impairment, that means the recoverable amount is less than value in use. In such case, I'll recognize the entry as impairment account debit to asset. I will write down the asset to the extent of the impairment identified. Such impairment, which is a loss in value of the asset, should be written off to P&L. However, if the asset was upward revalued earlier, that means earlier it was revalued upward, that means I have a revaluation surplus already existing. In such case, instead of debiting P&L, I will debit revaluation surplus to the extent it is available. If an asset was upward revalued earlier, instead of debiting the impairment to P&L, I will debit it to the revaluation surplus available. Clear? That is recognition of impairment on individual asset, and we will go into the next about group of assets as well. Yes, guys. So now let's get into this concept of what is this group of assets. Guys, generally what happens is two or more assets put together will generate some sale. Let's say, for example, I'll give you a best example. I have a simple manufacturing plant. This manufacturing plant, all it does is it takes paper, okay? It goes into the first machine where wax is coated on the paper or wax is applied on that paper, and then it is cut into size in the next machine, and third machine is packing machine. It is packed and it is sold to the customer. That's it. Simple. Machine A deals with waxing, machine B cutting, machine C packing, sale to customer. So that means three machines put together are generating some cash inflow. Correct? Three machines put together are generating cash inflows together. How much is the cash inflow attributable to machine A? How much is the cash inflow attributable to machine B? How much is the cash inflow attributable to machine C? Can you calculate like that? It is not possible. We cannot identify like that. You cannot identify how much of cash inflow can be attributed to each machine in such cases. When you cannot attribute how much should I give to each asset, how will you measure value in use? Tell me what is the value in use of machine A? I don't know. Because all three combined only cash inflow is then generated. What is the cash flow value in use of machine B or machine C? Same problem. You cannot calculate. When you cannot calculate what is the value in use being generated out of each asset, while all the three assets put together are generating some sale, then we call such kind of assets as group of assets. We test for impairment not based on individual asset. In such cases, we will test for impairment based on group of assets, and these group of assets are called as cash generating units. These group of assets are called as cash generating units. Clear? So whenever there is a cash generating unit, what should be classified as a cash generating unit? If I just say cash generating unit is a group of assets which generate cash flows on a combination basis and cannot generate cash flows on an independent basis, then you will say entire enterprise as a whole is one group of asset only. To stop that, what the ICAI has done is they have defined it CGU in a very particular manner. He says a CGU is a smallest group of identifiable asset. Smallest group, very clear, smallest group of identifiable assets which generate cash flows largely independent of other assets or other CGUs. They generate cash flows largely independent. I'm not saying completely independent. I'm just saying largely independent of other assets or other CGU. It is called as a cash generating unit or a group of assets for which an impairment should be tested on a combination. You cannot test them for impairment on individual asset basis. Clear? So if assets are generating cash flows on a combination of assets reasonably allocated to them, then cash generating, if cash flows arising from the above processes cannot be allocated to assets individually, all the assets within the process should be assessed for impairment together, and such a group of assets is called as a CGU. Whenever I have a recognition of an impairment loss of a CGU, how do you recognize impairment loss of a CGU? Same thing. Carrying value minus recoverable amount. What is carrying value? Carrying value of all assets within a CGU. What is the recoverable amount? Net selling price of all the assets and the value in use of all the assets put together. Whichever is higher is called as recoverable amount of the CGU. This way, I'll identify an impairment. This impairment is not for individual asset. It is for all the asset within the CGU. Whenever you have this situation where there is an impairment to a CGU, I will have to allocate the impairment loss of the CGU to each asset. On which basis? I will allocate the impairment loss to each individual asset in the CGU in the proportion of their carrying value. A is to B is to C. I will allocate the impairment loss of the entire CGU. Let's look at reversal. Someone was asking me this. I am talking about now. If in case there is a subsequent increase in recoverable amount, it is not impairment gain, it is reversal of impairment loss. That means for an asset which was already impaired earlier, if now you find that the recoverable amount has increased, in such cases, I'll have to recognize a reversal of impairment loss. How do I recognize this reversal of impairment loss? Let's see. Let's say, for example, there is an asset A. And this is year 0 today. The carrying value of the asset was, let's say, about 100 rupees. On this 100, I charged impairment in year 0 minus I charged impairment in year 0 and my impairment was 20 rupees, which gave me a balance of 80 rupees after impairment loss. Right? Let's say the useful life of the asset was 5 years. Then what should be the depreciation per annum? Depreciation per annum is 16. Correct? Sorry for that. Let's say the depreciation per annum is 16. Okay. Let's say subsequently in year 2, the recoverable amount has increased. And its increase was by 20. How much impairment did I recognize earlier? 20. How much did the recoverable amount increase now? 20. Can I reverse the impairment loss to the entire extent of 20? Answer is no. He gives you like this. He says this happened in year 2 or let's say year 3. Your 100 rupee of an asset, which when reduced by 20 rupees of impairment became 80. My depreciation in year 1 and year 2 have been 16 and 16 after impairment. Had that impairment not been charged, it would have been 20 and 20 each year. 5 years, right? So therefore, what is the written down value? WDV in year 3. Had this impairment loss not been recognized earlier, it would have been 60. Since impairment loss was recognized earlier, it is only 48. He is saying the reversal of impairment loss cannot be 20. Because if I reverse it by 20, then this will be added by 20 and the total will become 68, which is much more than the written down value had that impairment loss been not recognized earlier. So he says the reversal of impairment loss can be only a difference between these two, that is to the extent of 12. So I'm saying reversal of impairment can be maximum 12. 20 is not possible. So what are you saying? Reverse impairment loss in such a way that the carrying value of the asset after the reversal of impairment loss should not exceed the carrying value of the asset had impairment loss not been recognized earlier. You can reverse the impairment loss in this asset at the end of year 3. But even if you increase in such a way that it does not exceed 60. So therefore, reversal of impairment loss cannot be 20, but should be restricted only to 12. This is what he is explaining it to you in the form of a written form, where he says reversal is lower of the recoverable amount minus carrying value, which is 20, or carrying value of the asset if impairment loss was not recognized earlier, 60, minus carrying value of the asset now, that is 48. So reversal of impairment loss is assessed only if the asset is impaired earlier, and the reversal of impairment should be maximum up to the carrying value of the asset had the impairment loss not been recognized earlier. This is a fantastic concept regarding reversal of impairment. Let's get into the last concept regarding this. This is impairment of goodwill. We have one more miscellaneous topic as well. Yes, guys. Goodwill is also an asset. Goodwill should also be impaired. Think about it. Impairment of goodwill is equal to carrying value of goodwill. You know, book value you can identify from the balance sheet minus recoverable amount of goodwill. What is recoverable amount of goodwill? Value in use of goodwill or net selling price of goodwill, whichever is higher. Can you sell goodwill alone? May not be possible. Can I identify value in use only of the goodwill? Goodwill generates cash flows. No. Goodwill is arising because all other assets put together generate cash flows much more than anyone else. That is my goodwill. Clear? Therefore, you cannot measure recoverable amount of goodwill. Since you cannot measure recoverable amount of goodwill, you cannot impair goodwill individually. So what they do, you can transfer goodwill or allocate goodwill to each individual asset or to group of assets on a non-arbitrary basis. What is non-arbitrary? That means total 1 lakh assets, total goodwill 10 lakhs. 10 lakhs divided by 1 lakh, 10 rupees to each asset. No, that is arbitrary. What is non-arbitrary? You need to identify which particular asset is actually generating goodwill. If there are 10 or 15 assets in the organization, of which 6 assets are generating goodwill, then goodwill should only be allocated among those 6 assets. So that is fundamentally what is very important. I am into sale of men garment as well as women garment here. Designated machines are there into men garment, designated machine into women garment. Men garment, there is no significant sale. Women garment, every time sale. Winter sale, summer sale, autumn sale, spring sale, everything sale. Men garment, same t-shirt, same pant, irrespective of climate. So sales were not great. Women garment sales were great. That means my goodwill of the enterprise is being significantly generated due to the women garment and not due to the men garment. Therefore, my goodwill should be allocated only to the assets employed under women garment, under manufacture of women garment. Out of the women garment also, my western garments are being sold amazingly well. So that means my goodwill should be allocated only towards such assets which are generating women garments, especially in the Western wear segment. That is called as non-arbitrary allocation of goodwill to assets. Clear? Therefore, goodwill cannot be impaired individually, but goodwill should be allocated to assets or CGUs or group of CGUs on a non-arbitrary basis. If an asset or a CGU to which goodwill is allocated got impaired, if an asset or a CGU to which goodwill got allocated is impaired, then the impairment should be adjusted first against the value of goodwill and subsequent to the value of the asset. So how much ever impairment is there, first you knock off the goodwill. If more impairment is there, then only you reduce it from the value of the asset. Clear? Reversal of impairment loss on goodwill is not possible. It is completely restricted as per Ind AS 36. You are not supposed to reverse impairment loss on goodwill. Clear? Yes, guys. Now I'll come to the last topic of the standard. Can the impairment loss exceed the carrying value of the asset? You tell me. Can impairment loss be greater than carrying value of the asset? Possible. Impairment is equal to carrying value minus recoverable amount. Correct? So that means it is not possible for me to see that the impairment is greater than the carrying value of this. However, I'll give you one situation. What if recoverable amount itself is negative? What if recoverable amount itself is a negative amount? Then what will happen? If recoverable amount is negative, then minus of minus plus. So recoverable amount is equal to carrying value plus impairment is equal to carrying value plus recoverable amount. Now question comes up, sir, why will that recoverable amount be negative? Why will it be negative? Higher of value in use or net selling price, higher of these two should be 0 or more than 0. Why is it negative? Abnormal situation this can arise. ICAI loves abnormal, man. That's why this question has appeared so many times in the exam. Such an abnormal situation, guys. I'll tell you what abnormality it has. Logic simple. Let's say, I think very recent story I'm talking about. 2019 marked the end of, 2020 actually, marked the end of BS4 four-wheeler vehicles. No more BS4 cars will be sold after 1st April 2020. That is the concept. So what happened? I have a machine which makes engine components. It fits only engine components which are of BS4 variant and not of BS6 variant. Then what will happen? Automatically, I cannot use the asset anymore. The government has particularly issued a notification saying that all those machines which are into making or manufacturing BS4 components should be shut down. They have to be dismantled. He clearly said this. Then what will happen? Value in use. No value in use. Net selling price. Yes. Value in use I don't have, but I have net selling price. What is the net selling price? Fair value from sale of asset 0 minus cost to sell. No cost to sell, but there's a cost to dismantle the asset. So what will happen? That means sometimes it happens to be a situation where a particular asset no longer can be used, no longer can be sold, but the enterprise has an obligation to dismantle the asset. The enterprise obligation to dismantle the asset is a negative recoverable amount. Therefore, the impairment can exceed the carrying value of the asset. Recognize entry. Impairment loss to asset, not possible. Because your impairment is more than carrying value. That's why he writes, impairment account debit, to carrying value of the asset, to liability for dismantling the asset. So whenever we come across this kind of abnormality where the asset cannot be used, cannot be sold, but the enterprise has an obligation to dismantle the asset or basically crack down the asset, in such cases we come across this phenomena. Clear? Read that paragraph. When an asset has a restriction on further use or sale and the enterprise has an obligation to dismantle and remove the asset by incurring certain costs, then the carrying value of the asset plus cost of dismantling is equal to impairment. In such case, the asset should be derecognized, and in addition, a provision is required to be created for the estimated future dismantling cost. Clear? And that will bring us to the end of this topic or discussion under Ind AS 36. There is one more small part regarding corporate assets. Kindly make sure that you go through that concept, but corporate asset concept is very similar to goodwill concept. Clear? Yes, guys. So welcome back to questions, which are very, very important. For an integral part to understand the standard is to assess what are the questions and how do we answer these kind of questions. So it's very important for you to pay attention to the questions as well, guys. So welcome back. So let's start solving the questions from now. I'll take up the first one. H Limited purchased an item of property, plant and equipment costing 100 million, which has a useful life of 10 years. The entity has a contractual decommissioning and site restoration obligation estimated at 5 million to be incurred at the end of 10th year. The current market-based discount rate is 8%. The company follows a straight line method of depreciation. H follows a cost model for accounting the property, plant and equipment. Determine the carrying value of the item of property, plant and equipment and decommissioning liability at the end of each year when there is no change in expected decommissioning liability and expected timings that they incur and the decommissioning expenses and discount rate. At the end of year 4, an entity expects that the estimated cash outflow on account of decommissioning and site restoration to be incurred at the end of useful life is 8 million instead of 5 million. Determine in case B, how should we account for the changes in decommissioning liability? Read the question once again. I'll give you time to read through the question and then we will start solving the answer. Yes, guys, read through the question and tell me how are we supposed to approach this question. Now, if I say that the cost of the asset is 100 million, let's say everything is in millions itself. Okay. The useful life of the asset is 10 years. There is a contractual obligation for decommissioning and site restoration estimated at 5 million to be incurred at the end of 10th year. Market discount rate is 8%. Okay. So I'll have to identify what is the present value of the decommissioning cost, which I will incur at the end of the 10th year, which is 5 million, applying a discount rate of 8%. So 5 million into 8% for 10 years, present value factor you multiply, you will get the answer. The company follows straight line method and a cost model for accounting the PP. Determine the carrying value of property, plant and equipment and decommissioning liability every year when there is no change in the expected decommissioning expense, the timing to be incurred and the discount rate. First part of the question, let's try to solve this. Okay. First, the purchase price. What is the purchase price of the asset? $100 million. Estimated dismantling cost. Dismantling and site restoration cost actually. Estimated cost of dismantling the asset is 5 million. Useful life of the asset is 10 years. Correct? Discount rate is 8%. Applying this, if I have to calculate what is the present value of estimated cost of dismantling, at the end of useful life of the asset, then I'll calculate like this: 5 into present value factor, 8% for 10 years. Calculate. Use your calculator. Get the present value factor. I'll take up to 2 decimals, guys. I don't want to unnecessarily get into too much of percent. 10 years. 0.46 is your answer. 5 into 0.46. 4631 actually it is. 4632. 0.46 into 5 is 2.3. Is the estimated cost of dismantling. This should get added to the cost of the asset. Therefore, cost of asset to be capitalized is equal to 100 million plus 2.3 million, which is 102.3 million. I have to depreciate it for a period of 10 years. So what is the depreciation per annum? On a straight line basis, if I depreciate, depreciation per annum is equal to 10.23. I'll calculate the carrying value of the asset and the decommissioning liability each year. Here, depreciation per annum, WDV, cost model or cost approach, opening decommissioning liability, interest at the rate of 8%, closing liability. Calculate each year, guys. Year 1, what is the depreciation per annum? 10.23. What is the original cost? 102.3 minus 10.23 is 92.07. Year 2, again reduce it by 10.23, 81.84. Year 3, again reduce it by 10.23, you will get an answer of 71.61. Year 4, again reduce it by 10.23, 61.38. I don't want to do it beyond this, but actually he's asking you to do it for the entire 10 years. but ultimately it's the same calculation. I don't want to repeat it. The reason why I'm doing it until year 4 is because in the question, he said at the end of year 4, there's a change in the estimation in part B. In part B, he has given you that there's a change in the estimate at the end of year 4. So taking that into consideration, I am only considering up to year 3. Okay. Let's come back to decommissioning liability then. What is the decommissioning opening liability, guys? Opening liability of decommissioning cost is 2.3 multiplied by 8%, 0.184. So this will be 2.484. 2.484, or we'll take it only up to 2 decimals. I think that is better. Anyways, we are rounding off. Take until only 2 decimals. 2.48 into 8%, 1.99, sorry, 0.19, or actually 0.20. 2.68 is the closing liability. 2.68 opening liability for the third year multiplied by 8%, 0.21. This is 2.89. Calculate it further. 2.89 into 8%. 2.89 and 0.23, which is nothing but 3.12. So guys, I'm trying to calculate like this, and I'll keep on identifying this cost. So what are the 2 entries which I have to pass here? Every year, if you ask me to write the entry, I'll record it like this. Depreciation account debit in year 1 if I'm talking about. Depreciation account debit to asset. I'll also record one more entry. Interest cost, which is notional, to provision for dismantling. Which is the liability which I created. Write the entry. Depreciation each year should be 10.23. First year, interest cost to be recorded by increasing the provision by 0.18. 0.18. Everything is in millions. This is how I record the 2 entries at the end of each year. Entry will remain the same, but interest portion will keep on changing. Second year 0.2, third year 0.21, fourth year 0.23. Like this, I'll keep on calculating up to year 10 and passing each year both these entries. Depreciation entry will remain constant, but your interest entry will keep on changing. Now let's go back to what the question says in part B. In part B, is asking us to do something. Let's see what part B says. In part B is saying at the end of year 4, the entity expects that the estimated cash outflow on account of decommissioning and site restoration to be incurred at the end of the useful life of the asset is 8 million. He's saying the decommissioning liability is right now 8 million. Then how do I calculate? When is it at the end of year 4? So let's try. Part B. Estimated decommissioning cost is equal to 8 million. When is this? At the end of year 4. When are you going to incur the expense? At the end of year 10. So my present value of decommissioning cost is equal to 8 million into present value factors 8% for 6 years. Calculate. Why 6 years? Because 4 years are already done. So I'll have to calculate it for 6 years. So it should be 8 into 0.63. 8 into 0.63 is 5.04. So you want the decommissioning cost to be 5.04 right now. But at the end of year 4, if you look at, the decommissioning liability is only 3.12. So your decommissioning liability should increase to become 5.04. Increase in present value of decommissioning cost. What is the increase in present value of decommissioning cost? It has to become 5.04. It was 3.12 earlier as per previous one, which we calculated. So therefore, the increase should be how much? The increase should be 1.92. How do you recognize this? Entry to be recognized here is I have to increase the value of the asset. Along with that, I'll also have to increase the provision for present value of decommissioning cost or provision for decommissioning cost to provision for decommissioning amount is 1.92. Now, what is the carrying value of the asset now? Carrying value of asset is equal to, at the end of year 4, the carrying value of the asset was 61.38. This 61.38 should be increased by 1.92. 61.38 plus 1.92. Therefore, the carrying value of the asset will be 63.3. So what is your depreciation per annum now? The revised depreciation per annum over the remaining 6 years will be 63.3 divided by 6, which is nothing but 10.55. Earlier, I charged only a depreciation of 10.23, right? Now I'll start charging a depreciation of 10.55 for the remaining 6 years of the useful life of the asset. Clear? Let me know if you have any doubts, guys. Any doubts in solution till here, please make sure that you ask. Look at the solution. I'm giving you the solution here. 2.32 is his cost. 10.23 is the depreciation. He is calculated for all the 10 years. We have done it only up to 4 years, but it is the same calculation ultimately. At the end of 5th year, he got a cost of 5.04. Approximation, it is we got it 3.12. He's getting it 3.15. The change is 1.92 according to us. For him, it was only 1.89. So, according to 1.89, the revised depreciation is 10.55, which even we got. We got the same thing. The depreciation should be calculated at the rate of 10.55 from there on. Any doubts, please let me know. Asset account debit to decommissioning provision 1.92 is the entry to be passed in year 4. Clear? I hope everyone get it. Let's get into question number 2 then. A acquires 80% shares of subsidiary B for 3,200 and the date of acquisition B Limited's identifiable assets are 3,000. A elects to measure NCI at proportionate share of net identifiable assets. Therefore, it identifies purchase consideration 300, NCI 3,000 net identifiable assets into 20%, 600 less total net assets 3,000. So therefore, A's share of goodwill is 800. 800 is not total goodwill. It is A's share of goodwill because there is also NCI share of goodwill which I did not consider. If I would have measured NCI at their fair value, then I will get the total goodwill. I'll show you. At the end of financial year, B's carrying value of the assets reduced to 2,700 excluding goodwill. Recoverable amount is 2,000 in one case and 2,800. Calculate impairment loss allocable to parent or NCI in both cases. Guys, this is a very interesting question, guys. Because whenever I look at this question, the first thing that you need to look at is he is looking at two concepts. One is goodwill, which arised on Ind AS 103, and also the application of measuring NCI at fair value or proportionate cost. But the most important concept embedded into it is impairment of goodwill. Let's see the solution that he has given. We can solve it if you want, but it'll be quicker if we just browse through the solution. Yeah. Now, had this NCI been measured at its fair value, then NCI's proportion of goodwill will be 200. How did I get that NCI's proportion of goodwill being 200? Because 800 is the goodwill of 80%, that is the holding company share. If 800 and 80%, then NCI share is 200. That means the total goodwill is 1000. The total goodwill is 1000. And the total other assets are 2,700 according to the question. That is what he said. Because at the end of the year, the carrying value has come down to 2,700 only. Clear? That means the total value of the asset is 2,700. If the 3,700, if the recoverable value is only 2,000, that means there is a total impairment loss of 1,700 rupees. How will this impairment loss be calculated? Out of this total impairment loss of 1,700, 1,000 goodwill should be adjusted. The balance 700 will be adjusted against other assets. Out of the 1,000 which you adjusted against goodwill, 200 belongs to NCI which you did not recognize. But to the extent of 800 goodwill which was recognized, I will reduce it from goodwill and the balance 700 will be reduced from your other assets. And out of this 700 also, you need to understand that the 700 other assets belong to both NCI as well as the parent enterprise. What is the proportionate holding? 80%, 20%. So 80% parent company will recognize, 20% NCI should recognize. So 80-20 is 560 and 140. Exactly written like that. Parent will recognize 800 rupees loss in goodwill, 560 loss regarding other assets. NCI should have actually recognized goodwill of 200. But since you are not recognizing goodwill in the balance sheet, I'm not showing it. But other assets to the extent of 20% on 700 is 140. What if your recoverable amount is 2,800? Then in such case, your impairment loss is only 900. Out of impairment loss of 900, which is less than the value of goodwill, because goodwill itself is 1,000. So 900 should be only cancelled against goodwill. But you need to understand 80-20, 80% belongs to holding company and 20% belongs to parent. So what is 80% of 900? Only 720 will be recognized as impairment in goodwill for the parent enterprise. Balance 80 rupees of goodwill will keep on continuing. Here the carrying value of the assets 2700 will still be there. So this is how we have to solve this. So if you want me to just give you a better clarity on how to solve this particular question, I can give it to you. Just a second, guys. Okay. There are two parts in this, right? One is goodwill and other assets. How much goodwill did you recognize? I recognize goodwill only to the extent of 800, which is the parent enterprise share. If 800 is parent enterprise share, what is NCI's 20% share? 80% is 800. NCI's 20% is 200. What is the total goodwill? 1,000. What are other assets? 2,700 on balance sheet date. So that means by addition, the total net assets including goodwill in the enterprise is 3,700 pertaining to the subsidiary. Out of 3,700, he is saying that the recoverable amount is only 2,000. Recoverable amount is 2,000. That means I have an impairment of 1,700. What did we learn regarding goodwill impairment? Any impairment loss should be first adjusted against the value of goodwill. So how do you allocate goodwill? Sorry, allocation of impairment. Allocation of impairment. 1,000 should be reduced from the goodwill and the balance 700 should be reduced from the value of asset. Here, the entire goodwill of holding company is written off, entire 800. 800 and 200. 560 and 140. 80-20 ratio. Correct? So this is parent enterprise and this is NCI. Parent enterprise, NCI. This is how we will adjust. If the answer would have been different, that means if the recoverable amount is not 2,000, in the other part of the question he said consider the recoverable amount to be, how much did he say? In part B, 2,800. Then if your answer is 2,800, then how will your answer change? Instead of taking recoverable amount as 2,000, take it as 2,800. Then what will happen? My impairment instead of 1,700 will become only 900. How will you allocate 900? If I have to allocate 900, then I'll allocate only directly to my goodwill, 900. Out of 900 allocated to goodwill, parent will take 80%, 720. NCI will take 80. There is no further reduction in other value of asset because entire 900 got adjusted only against the value of goodwill. So this is regarding impairment of goodwill in the subsidiary whenever you are trying to solve the questions. Clear, guys? I hope I was clear with this calculation. My question number 3. Netravati Limited purchased a commercial office space as an investment property in Global Trade Center Commercial Complex for 5 crores. However, for purchasing the same, the company had to obtain a membership of Global Trade Center Commercial Complex Association by paying 6,25,000 as one-time joining fee. Some commercial space of 5 crores, guys, it had a membership to be acquired at 6,25,000. Netravati wants to write off one-time joining fees as expense under membership and subscription charges. Value of property is 5 crores. Advice: answer is absolutely wrong, because he clearly said the company has to obtain a membership to purchase. At the time of purchase, the company had to obtain the membership. So that means in order to use that commercial space, you need to obtain that membership. It is incidental to the purchase of the property. Therefore, you have to capitalize the entire 5 crore 6,25,000. Would your answer change had the office space been purchased with an intention of using it as an administrative asset? Guys, be it Ind AS 16, be it Ind AS 40 investment property, my computation or measurement of cost at the time of acquisition is the same. So my answer will not change. The cost of the asset is 5 crore 6,25,000, no doubt. So no charging it off to P&L. Answer is 5 crore 6,25,000. As per Ind AS 40, the cost of purchased investment property comprised of its purchase price plus directly attributable cost. Accordingly, on initial recognition, the one-time joining fee of 6,25,000 should be added to purchase price. Therefore, the investment property should be measured at 5 crore 6,25,000, and writing off that 6,25,000 to P&L is inappropriate. If the property, plant and equipment, if the property is used as administrative center and not as investment property, then Ind AS 16 shall be applicable. Even under Ind AS 16, all direct cost of acquisition should be added to the purchase price. So the cost of asset under Ind AS 16 is also the same thing, 5 crore 6,25,000. X is engaged in the construction industry and prepares its financial statements up to 31st March each year. On 1st April, X purchased a large property consisting of land for 2 crores and immediately began to lease the property to Y Limited on operating lease. That means it is an investment property. Annual rents were 20 lakhs. As on 1st April for 31st March 2015, the fair value of the property was 2 crores 60 lakhs. Under the terms of lease, Y Limited was able to cancel the lease by giving a 6 months notice in writing to X Limited. Y gave this notice on 31st March and vacated the premises on 30th September. On 30th September, the fair value of the property was 2 crore 90 lakhs. On 1st October, X Limited immediately began to convert the property into 10 separate flats of equal sizes, which X intends to sell in ordinary course of business. So it is no longer investment property. Now it has become an inventory directly, because you want to sell in ordinary course of business. What do you sell in ordinary course of business? Inventory. X spent a total of 60 lakhs on conversion project on 30th of September to 31st of March 2016. The project was incomplete as on 31st March, and the directors of X Limited estimates that they need to further spend 40 lakhs to complete the project, after which the flat could be sold at 50 lakhs. Examine how these three events should be reported in the financial statements of X Limited for the year ended on 31st March. Guys, initially it will be recognized as investment property because they are giving it on operating lease. After the lease is completed, they are converted into inventory. So investment property should be de-recognized and inventory should be recognized. Look at the answer. On 1st April 2011, the property would be regarded as investment property since it is being held as an investment potential rather than owner-occupied property. The property should be measured based on cost model. There is no revaluation model under inventory, investment property. Therefore, it should be 2 crores. On 30th September, the property ceases to be investment property since X Limited begins to develop the plots. It transfers between investment property or owner-occupied property and inventory does not change the carrying value. Therefore, even though it became inventory, I will still carry it at 2 crores itself, even as inventory. Since the lease of the property is an operating lease, each year of 20 lakh rupees should be charged to P&L. In the year 2016, first 6 months I received the lease, which is 10 lakhs, which should be charged to the P&L or which should be credited to P&L as income up to September, end of September. End of September, I will de-recognize the investment property and I will transfer the 2 crores to your inventory. Under inventory, I have already additionally incurred 60,000 rupees, which should be added to the cost of closing inventory. So 2 crore value of investment property plus 60 lakhs cost of development. The inventory will be valued at 2 crore 60 lakhs. The selling price of the property is 5 crores because 50 lakhs into 10 properties. Since the further cost to develop is 40 lakhs, net realizable value is 4 lakh 60, which is much higher than the carrying value of 2 lakh 60. Therefore, the flats will be shown as a current asset as inventory at 2 crore 60 lakhs only. And that will bring us to the end of today's session and the problems which are meant to be covered as far as these topics are concerned. Yes, guys. So what do you understand about this standard Ind AS 105? Ind AS 105 is predominantly broken down into 2 parts. The first part of the standard, which deals with non-current assets held for sale, and the second part of the standard, which deals with discontinued operation. Now, I have to deal with both parts in a distinguished manner because both of them have a very little things in common. Since discontinued operation is a very small standard, they had to be clubbed into some relevant standard, so which happens to be your Ind AS 105. Now, if you look at the comparable standard in your accounting standard, it was AS 24, which was talking about discontinuing operations. Guys, though it's a significant change, there it was discontinuing operation. That means over the period of discontinuance, the standard had a relevance. It had a relevance over the period of discontinuance, because you need to understand, just because I want to discontinue my operations, next day I just shut down my office and the operations are discontinued, does not happen. Let's understand a manufacturing operation today had to be discontinued. There are significant things which happen, because before you shut down, there are some materials which have to be disposed of. There are some creditors which have to be paid off. There are some debtors which have to be collected. There's a factory shed which has to be dismantled. There's a lease which has to be cancelled. So many things happen as far as your discontinued operation is concerned. Therefore, it cannot be considered as a one-day activity. So AS 24 was talking about discontinuing operation, where it had a relevance of basically reporting or presenting or disclosing events throughout the period of discontinuance. But if you look at Ind AS 105, they have cut short the standard or basically reduced the importance of the standard by calling it as discontinued operation. That means he's only talking about after the discontinuance, what are the necessary things that should be done. While the first part of the standard is a complete new thing. Non-current assets held for sale has never been discussed as a part of your accounting standards or your IGAP. it is your Ind AS which is bringing on this new concept of Ind AS 105, talking about non-current assets held for sale. Understandably, why did this standard even come up? Now, the standard comes out because you need to understand that a few assets in the organization might be held for sale. For example, a reason for a new asset has been replacing the old asset. The old asset is no longer being used, has to be discontinued or has to be disposed of. Or a particular manufacturing equipment used for a particular product, that particular product is discontinued. So this asset which was manufacturing the product is no longer of any relevance. Therefore, has to be held for sale. Now, why should we have a different standard for this? We should have a different standard for this because, number one, I have a problem with the measurement. I cannot apply the same cost approach or revaluation approach as we have discussed under Ind AS 16, 38 or 40, even for this non-current assets held for sale. Because there is a going concern, that means that particular asset is being used for over a period of time. But here you have an intention to dispose the asset. So you cannot have the same intention or the same measurement pattern. Presentation. If I talk about my fixed assets or my assets which are under operations, I should have a clear distinguishment between the assets which I am using today and the assets which I want to dispose today. Because if I calculate my return on fixed assets, my net profit divided by operating assets, your operating assets should exclude such kind of assets which are held for disposal. So that is the second reason of presentation requirement, where it requires you to basically pull out these assets from the normal categorization, put them under a different category called as non-current assets held for sale. So any asset either recognized under Ind AS 16 property, plant and equipment, or recognized under Ind AS 38 intangible asset, or recognized as investment property under Ind AS 40, if the intention of the management is not to use the asset or continue to use the asset, but the intention of the management is to collect money from proceeds from the sale of the asset, then I'll have to categorize it separately as non-current asset held for sale. Clear? Now, when I say non-current asset, the first question that comes up, first of all, what is a non-current asset? How do I identify whether it is a current asset or a non-current asset? Then you will have to go back to the definition given under AS1. Your Ind AS 1, which is presentation of financial statements, gives you certain definitions, and one such definition is regarding your non-current asset as well. In simple sense, non-current asset can be defined as other than current asset. Or story kata. It is simply other than current assets. When I say other than current asset, one has to understand, first of all, what am I indicating towards? Anything other than current asset, then first of all, I should know what is a current asset. Without knowing what is a current asset, it is impossible to understand or have a knowledge of what is a non-current asset. So let's see what current assets are defined under Ind AS 1. Your Ind AS 1 defines current assets by breaking them into three categories. There are particularly three categories into which it breaks it down. First one, cash and cash equivalents are current assets. Cash and cash equivalents is nothing but cash balance, cash at bank, or any other deposits which have a maturity date of less than 60 days. They are called as cash and cash equivalent. Second one, assets that are expected to be realized, consumed, sold within an operating cycle. I'm saying assets which are expected to be realized, consumed, sold within an operating cycle. What is an operating cycle? Operating cycle means, in simple sense, the time which is taken from the day that you procure the raw material up to realizing the money from the customer. What is the process under this? The life cycle that goes under this is first to purchase the raw material from the supplier, bring the raw material to the factory premises, manufacture whatever the finished goods are, sell the finished goods to the customer, realize the money from the customer, and that is, say, one operating cycle. Now, operating cycles differ from organization to organization. Look at retail industry like Ratndeep supermarkets. What happens with Ratndeep supermarket? You need to understand that the operating cycle is very small because they cannot hold the inventory for a pretty long time. Every day in, day out, customer keeps walking in and the inventory keeps on getting sold out. So that means the operating cycle of such kind of DMarts or Ratndeeps are generally quite small. But if you look at a manufacturing entity or you talk about a real estate entity, then the operating cycle is much beyond 12 months. Much beyond 12 months. But however, for the purpose of simplicity, he says, you can consider an operating cycle as exactly 12 months. You can consider, for simplicity's sake, an operating cycle as within 12 months or less than 12 months. Unless or until you have a reason to believe that your operating cycle is more than 12 months. Like I told you, real estate entities have an operating cycle of definitely more than 12 months. So such kind of enterprises can take an operating cycle of more than 12 months. In any other case, normally the entities should consider an operating cycle as within a period of 12 months. An asset which gets consumed, realized or sold within an operating cycle. Debtors expected to be collected within a period of next 12 months. Inventory expected to be sold within the next 12 months. Raw material expected to be consumed in the process of production within the next 12 months. This way, if you understand, you can say that all these will categorize as current assets because they are assets which are expected to be realized, consumed or sold within a period of 12 months or an operating cycle. Third one, assets held solely for the purpose of trade. That means I'm purchasing that particular asset only with an intention to sell that asset and realize some profit. Now, that could happen either in the case of your inventory also, because a few inventory you just buy and you just sell. That is an intention to trade. You also have an intention to trade even for your securities as well, like equity shares and debt, but they don't get covered here. They should be covered under the standard of Ind AS 109. So in essence, I'm saying a non-current asset is an asset which is other than a current asset, and current assets defined under Ind AS 1 is basically broken down into three parts. First one, cash and cash equivalents. Second one, assets expected to be realized, consumed and sold within the period of an operating cycle, that is considered as 12 months. Third one, assets which are acquired solely for the purpose of trade. So these are the three parts which you can categorize as current assets. So anything other than these assets should be considered as a non-current asset. When do you call a non-current asset is held for sale? Held for sale is a management intention. It is the intention of the management to either use an asset in the process of production or to hold it for disposal. It's a pure management intention. So there he says an asset is held for sale if an entity expects to recover the carrying value of the asset from the sale of the asset rather than from continuing use of the asset. So I'm saying if an entity intends to recover the carrying value of the asset from the sale of the asset rather than from continuing use of the asset, in such cases we call that non-current asset as held for sale. Similar sounding we got when we were discussing about Ind AS 36 impairment. If you remember, there I said if an entity intends to recover the carrying value of the asset from the sale of the asset rather from continuing use of the asset, then recoverable amount should be your net selling price, which is fair value minus cost to sell. That same sounding I'm getting again here. I'm saying a non-current asset should be classified as held for sale if an entity intends to recover the carrying value of the asset from the sale of the asset rather than from continuing use of the asset, then you can call such non-current asset as held for sale. Arises due to various reasons. I discontinued a particular product. The manufacturing equipment of that particular product is held for sale on today's date because you don't have an intention to use that asset anymore. I'm basically relocating from one place to the other. So the existing equipment at this place is intended for sale or intended for disposal. Or let's say you have replaced an asset with another asset of higher efficiency than the earlier asset which I own is held for sale. So multiple ways or multiple reasons could happen for the purpose of holding an asset as held for sale. Now let's go on. For me to classify an asset as held for sale, it should meet two criteria. The first criteria is that the asset is held for sale immediately in the present condition. I'm saying an asset is held for sale immediately in present condition. What do you mean by this? Immediately in present condition. What do you mean by this? Very tricky word, right? Let's say, for example, I have a vehicle, four-wheeler vehicle I own. I purchased a new vehicle, and this earlier vehicle, I am no longer using it, but I'm saying there are certain repairs to that vehicle. The repair to the vehicle has to be performed before I intend to sell the vehicle. So I'm saying if I sell it like that, no one will buy. So let me repair the vehicle a little. It will take a good 15 to 20 days time. And that is when I will intend to sell the asset. So in such cases, this condition is not satisfied because the car is not held for sale immediately in present condition. You are expecting to perform certain action on that particular vehicle or repairs on that particular vehicle before the vehicle is actually disposed of or before the vehicle is intended to be disposed of. Therefore, this condition is not expected to be met. If you look at, he is very clearly using the word immediately in present condition. If the sale is expected to occur in near future, I am no longer using this asset and I am intending to sell it in the coming 12 months. Not possible to be classified as held for sale because you are saying it is in near future. You never said immediately in present condition. So immediately in present condition has to be taken in literal sense. In literal sense. That means this asset, as on today's date, you walk in, you take this asset and you leave. That is held for sale in present condition. So that's why the first point to explain this part, he says if an asset is held for sale in near future, it cannot be classified as non-current asset held for sale. Now, let's say there is an ongoing manufacturing process. Okay, there's an ongoing manufacturing process. I've given a huge advertisement on the newspaper saying that one particular machine with me is actually held for sale. Buyer walks into the premises and he asked me, where is the machine which you want to sell? I showed him the machine is already running. He said, the machine is already running. How can you say you want to sell this? I said, if you want it, I'll pack it right now and I'll sell it to you. Can I call it as held for sale? He says the answer is no. Because if the asset is vitally used in an ongoing production process, if an asset is vitally used in an ongoing production process, then it cannot be considered as held for sale in present condition unless the management intends to sell along with the ongoing order. That means I am packing a particular finished good and this packing machine is the one which I am holding for sale. Buyer walks into the premises and he questions, why are you using this asset? I said, there's a packing contract which I got. Now, if you buy that particular machinery, then I will not just sell the machinery, but also the contract is yours. So that means when it is vitally used in an ongoing process, it cannot be classified as held for sale. But if in case I intend to sell the machine along with the ongoing order for which it is vitally used on today's date, then you can classify that particular asset as held for sale immediately in present condition. Clear? Now, sometimes there is a delay, right? Immediate sale, immediate sale, immediate sale. What immediate sale? You think if I have a piece of land, you think there can be an immediate sale? It is not possible. I first advertise. Plenty of buyers will walk in. Plenty of agents will walk in. Those agents will introduce certain customers to me. Certain customers will directly reach to me. There is a set of negotiation which go on. There's a particular price which we ascertain. Finally, he says, I'll give you a certain advance, but the sale will be completed only after 3 months or 6 months. There's so much of process is involved. That's why he's saying sometimes there could be a delay in sale. Sometimes there could be a delay in sale. But in this case of a land which I gave you, the delay in sale is customary to the nature of the asset. The asset is of such nature that you cannot sell it immediately. Let's say I have this mobile phone. Immediately I go to the showroom and I'll say, I don't want this mobile phone. Take it off. He gave me 10,000 rupees and he asked me to go. So here the sale happened immediately. But in every asset, the sale may not happen immediately. Sometimes the delay is customary to the nature of the product and the nature of the process of sale. Look at how the land gets sold. First, there is an advance. There is an agreement to sale which happens. Then looking at this agreement to sale, the buyer goes to the bank, applies for a loan. Loan gets disbursed into the seller's account. Then you go to the registrar's office, submit all the documents. Then the transfer of title happens into his name. So much of process is involved. So that means immediate sale may not be possible by the nature of the asset. Sometimes the nature of the asset and the nature of sale are in such a way that there could be a delay. Such a delay can be ignored in classifying an asset as held for sale if it is customary to the process of sale. It is customary. Normally sale happens like this only. So there is an evident delay as far as the sale is concerned because of the nature of the asset and because of the nature in which I want to sell the asset. Therefore, such kind of delays can be ignored in classifying an asset as held for sale. So this is the first criteria to be satisfied for me to classify a non-current asset as held for sale. What is the criteria? An asset should be held for sale immediately in present condition. Second one is a very, very important criteria. The sale is highly probable. When do you say that a sale is highly probable? Let's say one of the accountants in my organization, accountant, okay, CFO, there's a manager of finance, and then there is an accountant, very down in the hierarchy. The accountant believed that a particular asset is held for sale. He intends to sell that particular asset. Buyer came in, he said, sir, this asset is held for sale. Then the buyer first asked, do you have the authorization to sell this asset? You are just an accountant. So do you have the authorization of the board of directors to dispose this particular asset? Do you have the authorization of the CEO to sell this particular asset? So therefore, you need to understand, for me to categorize an asset as held for sale, I cannot rely on the bottom tier or mid tier management. I have to rely upon the intention of the top tier management of their intention to sell. So that means the top tier of the management of the company is of an intention to dispose the asset. Fine. The board of directors have made a resolution in their board meeting every quarter saying that these particular assets are held for sale. They did nothing after that. They just said that they are held for sale. First of all, how do you want a customer to know that that particular asset is held for sale? You have to advertise first. Without even posting an advertisement, if you simply say that it is held for sale, how can it be even possible? Let's say I hold that my car is held for sale. I should communicate, right? I should either go to Cars24 or OLX Cars, or I have to post an ad on OLX saying that, sir, my car is held for sale. Without having an intention to look out for the buyer, what is the point of even claiming that the asset is held for sale? It is simply to say that my asset is held for sale. Very good. What effort did you make? Did you make an effort to find a buyer first of all? When you did not make an effort to find a buyer, you cannot say that the sale is probable. How can the sale be highly probable when you haven't made enough efforts to find a buyer? New machine today or new car today is 20 lakhs. I said old car I used, man. You know what I am? I use this car, 25 lakhs sale price. Buy now. Who will buy? Who will buy first of all? Sir, I use the car, sir. I am VVIP of this entire country. So I use the car. If you take that particular car, then you will also get VVIP treatment. Will anyone buy? So that means the price at which the asset is marketed should be reasonable approximation of its fair value. Today in the market, the fair value of that car is 8 lakhs, not 20 lakhs anymore. So you will have to market the car at an approximation of the fair value at which the car can be sold on today's date. Then only you can say that the sale is highly probable. Sir, the sale will be completed, sir. For sure, it will be completed. When it will be completed? Whenever the buyer comes, sir. Very good. Whenever I agree to the buyer's price, sir. When will that happen? You tell me one particular date. Whenever it is bound to happen, it will happen, sir. Not possible. You tell me one particular date, and such date which you tell me should be within 12 months. Then only I'll say that the sale is highly probable. What happens after 12 months? It is not probable. I don't even know whether I'll be alive or not after 12 months. So right now, either the sale is highly probable or not. If I have to classify, then that means that the sale should be completed within a period of 12 months. Management intends to sell this asset, sir, if they get 15 lakhs. If they don't get 15 lakhs, then they'll pull out from their intention to sell. They'll continue to use it. Sir, my car on today's date, if I get 10 lakhs, I will sell. If I don't get 10 lakhs, I'll continue to use the asset until I actually receive 10 lakhs. That means there is a high probability that the management can change its intention to sell the asset and shall continue to use that particular asset if it does not meet certain thresholds. In such cases, where the intention change of the management is likely to happen, it cannot be called that the sale is highly probable. So for me to call that the sale is highly probable, the conditions to be met are: first one, the appropriate level of management is committed to the plan to sell the asset. I am committed to sell this particular asset. An active program has been initiated to identify a buyer for the product. Number 3, the asset is marketed at a price at which it is highly reasonable with reference to its fair value. It is highly reasonable with reference to its fair value today. Number 4, the sale is expected to be completed within a period of 12 months itself. And lastly, significant changes or withdrawal of the plan to dispose the asset is unlikely, is highly unlikely. That means very, very impossible or very next to impossible is what we can use in colloquial sense. 5 conditions I told. First one, appropriate level of management has committed to the plan to sell the asset. Active program has been initiated to find a buyer to purchase that asset. Number 3, I quoted a price which is very reasonable with reference to the fair value of the asset. The sale is expected to be completed within a period of 12 months, and significant changes or withdrawal from the disposal plan is highly unlikely to occur. If these 5 conditions are satisfied, then you can say that the sale is highly probable. So 2 conditions which we put up for identifying an asset as held for sale. What are the 2 criteria? First one, that this asset is held for sale immediately in present condition. That means no more modifications to the asset. Near future cannot be considered. If it is vitally used in an ongoing process, then along with the order you are intending to sell the asset, then in such cases you can say that the sale is highly probable, or the asset is held for sale immediately in present condition. I'll say that the sale is highly probable if those 5 conditions are met. However, there is one particular case. You are saying that the sale should be completed within a period of 12 months. What if I am expecting that the sale should be completed within a period of 12 months? But what if 12 months are completed, but I still did not dispose the asset? Should I still continue to classify the asset under Ind AS 105? I said this particular car is held for sale. Classified it, recognized it, measured it as per Ind AS 105. Next year, again the board met, and now I see that the car is still there. The board asked me what happened. I said I could not sell the car. I expected that the sale will be completed within 12 months, but unfortunately today the car is still there. I could not sell the car, but I am still intending to sell the car within the next 12 months. Then in such cases, he says, you can continue to classify the asset as held for sale, even if the 12 months has already elapsed, if 2 conditions are satisfied. 12 months are over and the asset is still not disposed, but I'm still classifying it as held for sale if, first of all, The delay which occurred is due to reasons which are beyond enterprise control. Sir, you said you hold it for sale in March. April lockdown. 12 months are over. Still, the corona crisis is still existing. That is the reason why the sale has actually been stopped. The reason is not within my control. So therefore, in such cases, you can still continue to hold the asset as held for sale. Number two, there is sufficient evidence that the entity is still committed to sell. Just because it is more than 12 months, I don't withdraw from the plan to sell. I still have a strong intention to dispose the asset. So there is sufficient evidence that the entity still plans to sell the asset and is committed to the plan of selling the asset. So I'm saying if an asset could not be sold within a span of 12 months, you can continue to classify it as held for sale under Ind AS 105 if, number one, the delay is due to reasons which are beyond the control of the enterprise, and number two, there is sufficient evidence that the enterprise is still committed to its plan of selling the asset. Clear? These are the two conditions: held for sale immediately in present condition and sale is highly probable. If these two conditions are met, then a non-current asset can be classified as held for sale. Now, sometimes he uses a word disposal group. Look at here. First point, they are committed to a plan of selling the sale of an asset or a disposal group. What is a disposal group? Disposal group means something like a CGU. Something like a CGU, which we have seen under Ind AS 36. Two or more assets put together have some productivity. Individually, if I sell, they don't have any use. So therefore, the management today intends to sell the asset as a group together itself. There are group of assets, two or more assets, which are expected or intended to be disposed or sold together in one transaction itself. They are in such a way that even the buyer will get benefited only if they are sold in that particular group. Individually, the assets no one will buy. So therefore, the enterprise intended to dispose the group or sell the dispose the assets or sell the assets as one single transaction in a group of assets. Sometimes a liability can also be attributed to a disposal group. Liability can be a part of a disposal. Yes. If such liability is directly attributed to an asset within the disposal group, that means I bought a car and the car has a loan on it, and such loan is directly associated with that particular asset, and my intention is to sell the car along with the loan. I'm saying 20 lakh car, 12 lakh loan, you pay me 8 lakh sufficient. So I will transfer you the car, I'll also transfer you the loan. In such cases, a liability can also be a part of a disposal group. A liability can be attributed to a disposal group if it is directly related to the asset within the group and the entity intends to transfer the liability along with the asset. Clear? An asset held for exchange. My intention is I don't want to use this car, I want to buy a new car. Management has taken a decision, top tier management taken a decision. I go to the showroom, I'll give off this car and I will take a new car. Exchange of assets. No disposal. Here it is exchange. Exchange, can I still classify it as non-current asset held for sale? Answer is yes. This car, I am no longer using it, put it aside, buy a new car. Sir, what about this car? Leave it, man. Leave it in that lot, in that parking lot. No one wants to use the asset anymore. We'll sell it at a later point of time. This is called as abandonment of asset. Abandoning the asset cannot be classified as held for sale because your intention is not to dispose the asset, but your intention is to leave the asset from active use. So in such case of abandonment, the asset cannot be classified as held for sale. Clear? Now we'll go into the measurement of assets when they are classified as held for sale under Ind AS 105. measurement. Measurement of an asset once it gets classified into Ind AS 105 as held for sale. Earlier, my measurement was based on Ind AS 16, Ind AS 38 or Ind AS 40. These were non-current assets earlier, classified under either of these three categories. You were measuring them either on cost approach or revaluation approach if it was Ind AS 16 or 38. If it was 40, then I was carrying under cost approach. But now, once you classify the asset as non-current asset held for sale, you cannot continue the same treatment that you followed under Ind AS 16, 38 or 40. Now what you are supposed to do? Now you are supposed to change the measurement scheme. How do you measure it now? I will measure an asset which is classified as held for sale on the day when it is classified as Ind AS 105 at lower of its carrying value or the fair value less cost to sell. Guys, fair value less cost to sell, again the same logic of Ind AS 36 when we call it as net selling price. Same thing again, carrying value or fair value less cost of disposal should be the valuation at which I will measure the asset once the asset is classified as held for sale. Clear? Now, what if your carrying value is less than the fair value of fair value less cost of disposal? What will happen? No change in the value. The asset will be continued at the same book value. But if the fair value minus cost to sell is less than the carrying value, then I'll have to write down the asset. Today the asset's carrying value is 70. My intention is I can dispose the asset at 60 rupees by incurring a cost of 5 rupees. That means my fair value less cost to sell, my net selling price is 55 from that particular asset. So 70 rupees carrying value, 55 rupees is fair value less cost of disposal. That means the asset should be measured at 55 rupees only. So my 70 rupees asset has to be written down to 55. That means there is a difference of 15 rupees arising, which is a loss in value of asset or decrease in the value of asset. Such a reduction in the value of asset on the date of classification of an asset into Ind AS 105 should be charged to P&L. My board of directors met at the end of Q2. Q2 ended on 30th of September. On 20th of October, board of directors have held a meeting. On 20th of October, they have identified a particular asset and they said this asset is held for disposal. All conditions satisfied. The asset should now be classified under Ind AS 105, which was Ind AS 16 earlier. So what are we supposed to do now? Now that means on that particular day, when you have classified it as held for disposal or held for sale, I will have to write down the asset to 55 from 70 rupees. That balance of 15 rupees or the difference of 15 rupees should be straightforward charged off to P&L. Here, let's say a balance sheet date has arisen. 31st March, I still hold that asset for disposal. I've taken a decision on 20th October. I've classified it as held for sale. 15 rupees I already charged off to P&L. 31st March occurred now. 6 months already almost over. The asset is still held for sale. It is there with me. My intention is to dispose the asset only. But however, I will have to measure the fair value minus cost of disposal on each balance sheet date. Earlier, I thought fair value minus cost of disposal would be 55. But now for some reason, I understood that the fair value less cost of disposal can't even be 55. Maximum I could collect 50 rupees. 15 already charged to P&L on 20th of October when you classified the asset as held for sale. On balance sheet date, now your fair value less cost to sell has decreased even more and you are expecting only 50 rupees to be collected. The asset is carried at 55. Now you will have to reduce it to 50. Another 5 rupees I will charge to the debit of P&L. But let's say for suppose there is an increase in fair value. There earlier I thought only 55 rupees I will get from the value of the asset if I sell the asset. But now I realized that I won't get 55 but instead I will get 65. Fantastic. 10 rupees increase in fair value less cost of disposal. Now how will I recognize it? Such increase in fair value of asset should be credited to the P&L. That means from 55 to 65, the 10 rupees of increase I will credit to the P&L on the balance sheet date. Very good. What if instead of 65, I expect today that I will get 75 rupees? That means the increase is 20 rupees. Can I credit the entire 20 into the P&L? No, because he says that I will credit the P&L for increase in fair value only to the extent it was debited earlier. On 20th October, when I classified the asset as held for disposal, I charged to P&L 15 rupees. Today, how much can I credit to P&L? Maximum 15 rupees. Sir, I am expecting to collect 75. No problem. You only recognize the asset at the value of 70 because your measurement criteria still remains the same. Lower of carrying value or fair value less cost of disposal. Your carrying value was 70. Fair value less cost of disposal today is 75. So I have to measure the asset at 70 rupees only. So if I measure the asset at 70, that 15 rupees which was earlier debited to P&L, now I will credit to P&L. So whenever there is an increase in fair value of an asset, you credit the P&L to the extent you have debited the P&L earlier. Clear? When the asset was earlier classified under Ind AS 16 or 38 or 40, you kept on charging depreciation on these assets. But once the asset, which was earlier classified as 16, 38 or 40, property, plant and equipment, intangible asset or investment property, now classified as held for sale under Ind AS 105, you need not charge depreciation. The depreciation expected to be charged each year on the asset will cease once the asset gets classified as held for sale. Now question will be, sir, I classified it as held for sale only at the end of second quarter, no? Should I charge depreciation for the first 2 quarters? Answer is yes. I will charge depreciation on an asset up to the date on which it got classified as Ind AS 105. Here, until the asset is classified as Ind AS 105, I will charge depreciation. My depreciation on the asset should cease, should stop once the asset get classified as held for sale and started recognition under Ind AS 105. Clear? This is the concept of measurement and recognition of an asset by when they get classified under Ind AS 105 as non-current assets held for sale. Guys, if you have a disposal beyond 12 months, that means I'm expecting that the disposal of the asset could take a period beyond 12 months. Reasons? Because of the nature of the asset is like that. It is customary to the nature of the asset and the process of sale that it could extend beyond 12 months. Then in such case, you can continue to classify it as held for sale. We have given it above. What did we say? We said if the delay in sale can be ignored in classifying the asset as held for sale, if the terms and conditions are customary to the process of sale. That means if the delay is customary to the nature of the asset or the process of sale, then you can ignore this time period of 12 months. However, in such case, measurement change is also necessary because the cost of disposal which you are reducing from fair value at the time when you classify the asset as held for sale, that cost of disposal should now be measured at its present value. So it will be fair value on sale minus present value of cost of disposal. So cost of disposal should be discounted at present value and finance cost should be recognized on cost of disposal each year until the expected disposal. We have seen how finance cost is recognized yesterday when we were talking about Ind AS 16 regarding decommissioning liability, where I kept on charging finance cost or interest cost each year. Same way, this disposal cost, which is discounted to its present value, should keep on adding with the amount of interest every year until the expected disposal. That will bring us to the end of the first concept of Ind AS 105, where we discussed about non-current asset held for sale. Now let's step into the next concept, that is discontinued operation. Like I told you, significant difference from what AS 24 said. significant difference. Why significant difference? Because AS24 application started once I take a decision to discontinue an operation. Because AS24 language is discontinuing operation. Discontinuing means over the period of discontinuance, the necessary disclosures to be given were discussed under AS24. Here under Ind AS 105, I am not talking about discontinuing operation, but I am talking about discontinued operation. So automatically the scope of standard became very small. Over the period of discontinuance, there is no disclosures necessary. So the standard has cut to size because of the change in scope. So when do you classify an asset as discontinued operation? When a component of an asset is either disposed of or it is classified as held for sale. Now, what is this component first of all? What do you mean by component of an enterprise? Mobile phone. What is the components of a mobile phone? Screen, battery, operating software. All these are basically different components. So when I say component of an enterprise, it is a part of the enterprise. It is a part of the enterprise. What part should be considered as component under Ind AS 105? A component of an enterprise is a part of an enterprise which represents a separate major line of business or a geographical operation. I am Ramraj Cottons here. Okay. Ramraj Cottons is my enterprise. We are into selling lungis, and I established my network or chain of retail stores across the country. When I started expanding, I expanded, and I went into Kashmir also, where I put up in Srinagar my retail store of Ramraj Cotton. Now immediately one learned man came down and he said, "Sir, the temperature in Srinagar does not suit your lungi by any chance. Therefore, please shut down your geographical area of operation from North India." So what happened there? So he pulled out from North India and he said, "Yes, I am closing this geographical location. It represents a separate major geographical location, separate major line of business." Men clothing, women clothing are very famous example. Men clothing, same t-shirt I wore in winter, same t-shirt I'll wear in summer, same t-shirt I'll wear in rainy season also. Zero shame for men. We will wear same clothing here. For us, there is no change in winter clothing separate, your summer clothing separate, same thing. For us, shorts are basically purposefully used for 365 days a year. We don't really find any absurdity when we say that in a winter season you are still wearing shorts. Shorts make me feel comfortable is what we'll say. Men garment is zero profit industry, men. Zero profit. First of all, we are one fashion disaster, right? We don't have sense of clothing by any chance. Second thing, we don't intend to buy. For us, buying means once in a year we'll buy and we'll come back. Shopping is not a passion to us. Shopping is an urgency to us. So because you don't have clothes, you go and buy. Not because you fancy it. For women, it is different. They have a fancy. Now let's go to shop. That's a plan for me. It's a plan. It's like let's go to Maldives is a big plan. Shopping is also a big plan. So that is their passion. So men clothing, women clothing, both I started. I kept on running for 3 years. Now I understood men clothing useless to run this operation. So I said shut down men clothing, continue only women clothing, enough. So what happened now? I shut down a major line of business itself. A major line of business itself I shut down. I'm into making special structures of steel. I had my own galvanizing plant. But the galvanizing plant was not even used at 30% capacity. What is the point? I disposed of the galvanizing plant, and my galvanization today, I will do it outside. So what is happening? A line of business has been disposed. Clear? So a component of a business is a one which represents a separate line of business or separate major line of business or geographical location. The intention of the management is to dispose this separate line of business or geographical operation in one single transaction. One single transaction, close everything and come out. Third one, I have acquired a subsidiary with an intention to dispose of in near future. So that means my intention to buy the shares of that particular company is so that there I will get some capital gain when I sell it. But unfortunately, buying those shares, I crossed up 50%, it became subsidiary. So in such cases, it is a subsidiary which has been acquired with an intention of immediate sale. In such cases, consolidation does not apply. Here we have to classify it as Ind AS 105. Clear? So a component of an enterprise which is either disposed of, that means sold off, or is being classified as held for sale should be considered as discontinued operation. What is a component? A component of an enterprise represents a separate major line of business or a geographical location which I intend to dispose in one single transaction, or it is a subsidiary which is acquired with an intention of disposing in immediately. Clear? Now, to meet the criteria of a component, to meet the criteria of the word component, it should be distinguished operationally and for financial reporting purpose. When do I say that a component is distinguished operationally and for financial reporting purpose? This condition can be satisfied if the management believes that the cost of that, the revenues of that particular component can be identified separately. Majority of the cost in that particular component can be identified separately. For financial reporting purposes, for my reporting purposes, I call that as a separate operating segment under Ind AS 108. Then you can say that it is distinguished operationally and for financial reporting purpose. I can attribute revenues to it. I can directly attribute majority of cost to it. Then you can say that that particular component is distinguished for reporting purposes and operationally as well. This is my discussion regarding discontinued operation. But I will close this standard after one single statement regarding withdrawal of a disposal plan. I plan to dispose individual asset or a group of assets or a component of an enterprise. Either of these I plan. Under Ind AS 105, disposal can be for one single asset or disposal group or for a component of an enterprise. Either of these three can be classified as held for sale. But now on today's date, for some reason, the management out of nowhere has withdrawn its plan of disposal. First thing you need to do is to give a reason. Give a reason, disclose a reason why you withdrew from the plan. Sir, when I wanted to dispose, when I took a decision to dispose, you did not ask me reason why. Why are you asking me a reason now? Then my wish, I wanted to dispose. I classified it as held for sale. Today I am withdrawing. My wish. Absolutely no. The standard never asks you to disclose a reason on why you want to dispose a particular asset or a disposal group or a component. But if you plan to withdraw from your disposal, you should have a reason, and such a reason for withdrawal should be disclosed by the enterprise in its financial statements. Clear? Now, whether that reason is sufficient or not, no one can decide. Management will give whatever reason they feel like. Okay? But compulsory reason should be disclosed. Whenever I withdraw, until then I have been recognizing or measuring the asset at carrying value or fair value less cost of disposal, whichever is lower. Now I withdrew from the plan. Now I have withdrawn from the plan. Now what should I do? I'll have to recognize the asset at the cost of the asset or carrying value of the asset on the date on which it was classified as disposal minus the depreciation which should have been charged but you did not charge because when you classify it into Ind AS 105, you don't charge depreciation. So carrying cost of the asset on the date of classification as disposal less depreciation that would have been recognized if the asset is not classified as held for sale. Here, what did you say? Depreciation should cease. Very good. On that day, what was the carrying value of the asset? Minus the depreciation which I should have charged but I did not charge because I classified the asset as Ind AS 105. So such depreciation should be reduced from the carrying value of the asset on the date of classification as held for sale, or the recoverable value of the asset on the date of reclassification, whichever is lower. What is your recoverable value? Higher of value in use or net selling price. Your Ind AS 36 definition. This concept of recoverable value we have discussed under Ind AS 36. It is higher of value in use or net selling price, whichever is higher. So either the cost of the asset on the date of classification into disposal minus the depreciation that should have been charged but was not charged up to the date of reclassification, or the recoverable value on the date of reclassification, whichever is lower, should be the value of the asset at which it is recognized. Clear? However, I told you the enterprise should disclose the reason why you withdrew from the plan of disposal. Clear? That will bring us to the end of discussions on the standard Ind AS 105. Yes, guys, so let's look at Ind AS 23 borrowing cost. Guys, this happens to be a integral part of your asset related standard because the objective of borrowing cost standard is very simple. It says in general sense, you would have transferred the borrowing cost or the finance cost to the P&L. But in certain situations, this borrowing cost which you have incurred is eligible to be capitalized to the cost of the asset. That is the fundamental objective of this standard borrowing cost. If you go with the definition, first of all, to understand what is a borrowing cost, it says a borrowing cost is an effective interest rate or the finance charges under finance lease or exchange differences to the extent they can be regarded as borrowing cost. If you have a comparable standard to AS, your accounting standard, it was AS 16, which was talking about borrowing cost. Where under borrowing cost, you have a particular definition of borrowing cost, which says interest and other commitment charges, amortization of cost incidental to arrangement of borrowing, amortization of discount on issue or premium on redemption of debt, finance charges under finance lease, exchange differences to the extent they can be regarded as borrowing cost. So this is particularly how it was defined as per AS 16 borrowing cost. But when it came to Ind AS 23, he has confined only to 3 steps: effective interest rate, finance charge under finance lease, exchange difference to the extent they can be regarded as borrowing cost. That means the first 3 parts, that is interest and other commitment charges, amortization of cost incidental to arrangement of borrowing, amortization of discount on issue or premium on redemption of debt, these 3 have been combined together on a combination. They have called it with a word called as effective interest rate. Guys, this concept of effective interest rate you will also get in Ind AS 109. That is your financial instruments, where he uses the word amortized cost using effective interest rate. What is this effective interest rate? How do I calculate an effective interest rate? First of all, let's see. Yes, guys. So let's look at this concept of effective interest rate then. How do I calculate this effective interest rate? Let's say, for example, my loan amount is 1 lakh. Let's say the interest calculated or interest rate on this loan is about 10%. But there were also processing charges on the loan. The processing charges were about 2%. The tenure of the loan is, let's say, 5 years. That means each year my principal should get repaid by 20,000 and my EMI should be including my installment should be including the interest. So 20,000 plus interest will be paid each year. So if I look at cash flows, year cash flows, then look at it. Year 1 or year 0, the first time that I have taken the borrowing, I should have got 1 lakh, but since there is a processing charge of 2% which is attached to it, I will only get 98,000. Year 1, 2, 3, 4 and 5, I'll have to repay the loan. How much will I repay the loan by? First year, 20,000 plus 10% on 1 lakh. So I will repay, or there's a cash outflow of 30,000 rupees. Second year, 20,000 already repaid. Loan outstanding is 80,000. On 80,000, 10% is 8,000. Principal repaid 20,000, 28,000. Like this, if you go on, third year he'll repay 26,000. Fourth year he'll repay 24,000. And fifth year he'll repay 22,000. If you calculate an IRR, considering all these numbers, if I go with the computation of IRR, then my IRR will be 10.35% or something like that. A little over 10. It is not 10%. Why is it not 10%? Instead of this 98,000, if it had been 1 lakh, then it would have been 10%. But since now it is not 10%, but since it is not 1 lakh and only 98,000, you will find that the effective interest is slightly more. Why is it slightly more? Because the 2% or 2,000 which you got deducted as processing charges at the beginning, they have to be amortized over the period of loan, that is over the period of 5 years. To accommodate this, the concept of effective interest rate has emerged. Here, to accommodate this, we have this concept of effective interest rate which emerged. So that is the reason why he included the word effective interest rate. Effective interest rate includes all interest and commitment charges, amortization of cost incidental to arrangement of borrowing, amortization of discount or premium on redemption of debt, finance charges under finance lease, and exchange differences. To an extent they can be regarded as borrowing cost. So effective interest is a combination of all the three. So whenever you come across an effective interest, you will find that the effective interest is slightly more than the actual interest cost. What is this finance charges? Finance charges under lease we will observe today when we discuss about Ind AS 116. Exchange difference to the extent they can be regarded as borrowing cost. What is this exchange difference to the extent they can be regarded as borrowing cost? Let's look at this. Let's say, for example, look at the example first, then I will tell you how we calculate. Look at the example first. My borrowing is actually, I need 1 lakh rupees. I need a borrowing of 1 lakh rupees. But let's say for suppose, I take a borrowing in rupee, I would be paying 12% rate of interest. My finance manager walked in to me and he said, "Sir, why are you borrowing in rupee terms? Have you seen the rate of interest? The rate of interest is 12%. I'll give you a fantastic idea. Go to US and borrow from US. Rate of interest is just 5%. Then fine, nice. How much should I borrow? Said, sir, dollar rate is 50 rupees. We need 1 lakh. If you borrow $2,000, then automatically you will get 1 lakh rupees. But the interest rate is only 5%. I believed in what my finance manager has said and I borrowed in dollars. So I borrowed $2,000 at 50 rupees per dollar at the rate of only 5%. So at the end of the year, when the interest was supposed to be paid, 5% on $2,000, I paid just $100 interest. Had I borrowed in India, if I would have borrowed that 1 lakh in India at 12%, I would have paid 12,000 rupees. $100 at the end of the year. I looked at the end of the year and the interest, the exchange rate towards the end of the year was 55. Even then I was happy because $100, 55 rupees per dollar, I paid only 5,500. If I would have actually borrowed in rupee terms, I would have actually paid 12,000 rupees. Instead of 12,000, I paying only 5,500 has given me a significant advantage because today I have a savings. How much did you save? 12,000 minus 5,500. I saved 6,500 rupees of interest. Now, why did the rate on dollar increase? Because theoretically we align with the concept called as interest rate parity theorem. What is your interest rate parity theorem? It says that the country which has a lower interest rate always has a currency which keeps on appreciating. Same way, here since the dollar interest rate is lower, I expect the dollar to appreciate. Therefore, it increased to 55 rupees per dollar towards the end of the year. But now when a repayment comes up, I have to repay $2,000. Each dollar should be purchased at 55 rupees. Therefore, to buy $2,000 at the end of the year, in rupee terms, I should spend 1,10,000. I should spend 1,10,000. That is the exchange loss to be recognized on each balance sheet date as per Ind AS 21. So he is saying you saved a notional interest of 6,500, but unfortunately you incurred an exchange loss of 10,000. So in such situation, he is saying to the extent of lower of these two, savings in interest cost and the exchange difference on foreign currency borrowing, I will consider it as borrowing cost as per Ind AS 23. So lower of these two is 6,500, which I will consider as your interest or borrowing cost. So if you ask me what is your interest or borrowing cost as per Ind AS 23, actual borrowing cost paid in dollar 5,500 plus exchange difference to the extent they should be regarded as borrowing cost 6,500. Combination of both 12,000 rupees is my borrowing cost as per Ind AS 23. How much was your exchange difference on foreign currency borrowing? 10,000. Out of 10,000, 6,500 is treated as borrowing cost as per Ind AS 23. The difference or the balance 3,500, I will treat it as per Ind AS 21, where I will straightforward charge it off to P&L. Clear? What if? What if subsequently there is an exchange gain? Then what you will do? If there's an exchange loss, you treated it as borrowing cost. If there's an exchange gain subsequently, initially there was a borrowing cost, but subsequently I found that the exchange rate has decreased. Therefore, there is an exchange gain which arises. Then in such cases, I will reduce the borrowing cost only to the extent it was increasing the borrowing cost in previous years. Current year, how much did I increase my borrowing cost by? 6,500. 6,500 rupees of exchange loss was treated as borrowing cost as per your definition of borrowing cost. So subsequent year, if there is an exchange gain to the extent of 6,500, I will treat it as reduction from borrowing cost. But more than 6,500, if I get a gain, then that gain should be transferred to P&L as per Ind AS 21. I've given two examples. Check. Subsequent year, if your dollar rate has come down to 53 rupees per dollar, then the exchange gain is 4,000. It is less than 6,500. Therefore, it should be reduced from borrowing cost. But if your exchange rate goes down to 51 rupees per dollar, then the exchange gain is 8,000. Out of 8,000, 6,500 should be considered as reduction from borrowing cost, but the balance 1,500 should be treated as exchange gain as per Ind AS 21. Clear? I'll make this available for you. Check. Yes, guys. So welcome back. So we were dealing with borrowing cost and we were talking about what is the definition of borrowing cost. Now, fundamentally, we should know why is borrowing cost really important. The standard is important because the standard goes on to say that borrowing cost should be generally charged to P&L. However, in case the borrowing cost relates to a qualifying asset, such amount of borrowing cost is eligible to be capitalized. So this is fundamentally what the borrowing cost definition actually talks about. So when I talk about borrowing cost, so all these borrowing costs which I have already given you under the definition, he is saying that the borrowing cost should be charged to P&L unless such borrowing cost relates to something called as a qualifying asset. The borrowing cost related to the qualifying asset is eligible to be capitalized. I somehow missed that slide. So let's understand what do you mean by this qualifying asset. So I'm saying borrowing cost which is incurred on a qualifying asset is eligible to be capitalized. What is a qualifying asset then? A qualifying asset is an asset which necessarily takes a substantial period of time to get ready for its intended use or sale. So I'm saying it should take necessarily a substantial period of time to get ready for its intended use or sale. What do I mean by this? What did I mean by saying that it should take substantial amount of time? What do you mean by substantial? As fundamentally look at a CA student. For a CA student, 6 months is substantial. Hugely, very, very substantial, because for us, our life changes every 6 months. 6 months before, our friends are different. 6 months later, our friends are different. You fail, I fail, we are the thickest of friends. You fail, I pass, we both are not friends. We are enemies now. So you need to understand 6 months is substantial time for us. Look at an engineering student, a BTech grad. So what happens to him? 4 years. During the entire 4 years, at any point of time, he can complete his course. So that same liberty is not there to a CA student. So two people of the same age have a different substantial periods. Similarly, two enterprises may not have a similar substantial period of time. If I look at an enterprise which is into a retail segment, like I've given you the example of DMart or Ratnadeep, an item which is introduced as an inventory has to move within a span of less than 1 week. If my period is increasing beyond that, then that is a substantial period. If let's say an item is still stagnant for more than 6 months, it is very much substantial because I expect my inventory to move very fast. I expect users to come in or customers to come in, pick the good and leave from there. But unfortunately, if a particular product of a particular company is not moving even for 6 months, then it is significantly substantial for me. Let's say I am into construction of apartments. Okay, residential housing is my deal and I am constructing some residential houses. It's been 6 months and no customer has come in to purchase my product. I wouldn't call it as substantial, because to complete the construction itself, let's say it takes about 18 months period of time, 6 months cannot be considered as substantial here. So therefore, substantial period of time is a very subjective term. It is a very subjective term. Therefore, substantial period of time can significantly vary from enterprise to enterprise. That is the reason why he says substantial period of time is not defined by Ind AS 23. There is no particular definition of substantial period of time according to Ind AS 23. Ind AS 23 leaves it there. He says an asset which takes substantial period of time to get ready for its intended user sale is a qualifying asset. What is substantial period? Let the enterprise decide what is substantial to them. But standards' main objective is to standardize everything, harmonize entities, make sure that everyone is on the same page. Therefore, you can pick the word substantial from Accounting Standard Interpretation 1. Your Accounting Standard Interpretation 1 says that a substantial period of time is a period which is within 12 months. A period shorter than 12 months can be considered as substantial period. However, he says this is a rebuttable assumption. What do you mean by rebuttable assumption? The word is very tricky, right? Rebuttable assumption means a period longer than 12 months can also be considered as substantial period. A period longer than 12 months can also be considered as substantial period, provided sufficient facts of the case are provided for. Provided we have sufficient facts of the case, a period longer than 12 months can also be considered as a substantial period of time. That is the meaning of rebuttable assumption. Rebuttable assumption means an assumption which can be contradicted, but to contradict the assumption, I need sufficient facts of the case. If a period shorter than 12 months is considered a substantial period, no facts of the case are necessary. You need facts of the case only when you assume that your substantial period of time is longer than 12 months. So I'm saying that is Accounting Standard Interpretation 1, which gives you this rebuttable assumption for substantial period of time. However, Ind AS 23 has been silent with regard to what is substantial period. What is Ind AS 23 saying? A borrowing cost incurred on a qualifying asset is eligible to be capitalized to the cost of the asset. What is a qualifying asset? He says an asset which necessarily takes a substantial period of time to get ready for its intended use or sale can be considered as a qualifying asset. What is substantial period? Since there is nothing given under Ind AS 23, I am picking the definition given under Accounting Standard Interpretation 1, where it says substantial period is a period shorter than 12 months. But it is a rebuttable assumption, which means a period longer than 12 months can also be considered as substantial period, provided sufficient facts of the case are available. Therefore, if sufficient facts of case are available, your substantial period of time can be considered as a period longer than 12 months. Clear? So, when we say borrowing cost is eligible to be capitalized, we know what is a borrowing cost. We have seen the definition of borrowing cost. We have seen that to a certain extent, exchange differences also can be regarded as borrowing cost. But now I'm talking about how do I identify the borrowing cost which is eligible to be capitalized. There he brings in the situation. He says, for the purpose of identifying borrowing costs which are eligible to be capitalized, I'll bifurcate my borrowings into two types. I'll categorize my borrowings into two types: specific borrowing, non-specific borrowing. What is a specific borrowing? A specific borrowing is a borrowing which has been taken specifically for the purpose of qualifying asset. So simple, no? A borrowing which has been taken for the purpose of the qualifying asset is specific borrowing. This language won't be used in the standard. You know what the standard uses? Very tricky language. Look at the definition given down there. Borrowing that would have been avoided if the construction of qualifying asset has not been taken up. So I wouldn't have taken this borrowing had I not been constructing that qualifying asset. Ultimately, it means I have taken that borrowing only for the purpose of that qualifying asset. But the two negative statements used, a borrowing would have been avoided, negative. if the construction of the qualifying asset is not taken up, negative. Two negative sentences are basically used to define what is a specific borrowing. Your language, my language, a borrowing which is specifically taken for the purpose of the qualifying asset is called as a specific borrowing. Clear? Whatever is not a specific borrowing but still utilized for the purpose of qualifying asset is called as a non-specific borrowing. I have taken a borrowing for a term of 10 years. I've taken a term loan. Such term loan, I never said I will use it only for this purpose or this purpose. It is taken basically for the construction. A part of it has been utilized for the construction of a qualifying asset. Then such borrowings are called as non-specific or general borrowing. In simple sense, non-specific borrowing is any borrowing other than a specific borrowing. To the extent of specific borrowing, the interest or the borrowing cost on the specific borrowing is directly attributable to the qualifying asset. Therefore, borrowing cost eligible to be capitalized is equal to the actual borrowing cost incurred on the borrowing reduced by return on idle funds. Reduced by return on idle funds. What is this idle fund and why do you get a return? Let's say, for example, my qualifying asset had a cost of about 15 lakhs to be incurred over 12 months. Or let's say over 18 months. About 15 lakhs to be incurred over 18 months. First 6 months I'll use 5 lakhs. Next 6 months I'll use 5 lakhs. Last 6 months I'll use 5 lakhs. This is my expected utilization of the borrowing. Let's say, first when I got the borrowing of the entire 15 lakhs, I thought anyways I'm not using 10 lakhs for the next 6 months. So what I did, I kept 5 lakhs aside. The balance 10 lakhs, I parked it into an investment. A short-term investment was made. This investment has yielded some return. This is called as return on idle fund. It is a funds which are kept idle. They are parked into an investment. Such investment are yielding return. Such a return on the investment should be reduced from the actual borrowing cost. So therefore, the actual borrowing cost on the entire 15 lakhs minus return on the 10 lakhs parked for 6 months should be the actual borrowing cost on specific borrowing which is eligible to be capitalized. This is very simple. But when it comes to non-specific borrowing, it becomes tricky. Why tricky? Because when you talk about non-specific borrowing, the borrowing utilized for a qualifying asset is only to a fraction. A certain amount has been utilized for the qualifying asset as well. The entire borrowing cost on non-specific borrowing is not eligible to be capitalized. Specific borrowing, entire borrowing cost is eligible to be capitalized, but on non-specific borrowing, entire borrowing cost is not eligible to be capitalized because the entire borrowing is not spent only on the qualifying asset. Therefore, we have to first consider what is the amount of borrowing actually utilized towards the construction of qualifying asset. That amount of borrowing utilized for construction of qualifying asset should be multiplied by a capitalization rate. What is this capitalization rate then? Capitalization rate is a concept which has propped up because of the fact that there could exist multiple non-specific borrowings in an enterprise. When there are more than one non-specific borrowing in an enterprise, then he is saying that I will take the capitalization rate as a weighted average rate of interest on non-specific borrowing. I'll consider it as weighted average rate of interest on non-specific borrowing. Only if I have multiple non-specific borrowing. If only one non-specific borrowing is there, then the capitalization rate is straightforward the interest rate of the non-specific borrowing. As simple as that. But if I have more than one non-specific borrowing, then I will have to bring out the concept of capitalization rate. So what is this capitalization rate which I am talking about? Let's say, for example, I have non-specific borrowings like this. about a term loan and a bank OD. Both are my non-specific borrowings. Term loan was 10 lakhs, which was borrowed at the rate of 11%. Bank OD, I had 4 lakhs, which I have borrowed at 8%. Both the non-specific borrowings were utilized in construction of the qualifying asset. Therefore, in such case, how much amount of non-specific borrowing is used, I don't know. Therefore, I'll have to apply a capitalization rate. What is the capitalization rate then? Look at this. What is the interest on term loan? 1,10,000. What is the interest on bank OD? 32,000. What is the total? 1,42,000. What is the borrowing? Total non-specific borrowing? 14 lakhs. So what he says is, whenever you have these non-specific borrowing, I'll identify something called as a capitalization rate. My capitalization rate CR is given as 1,42,000. That is total interest on non-specific borrowing divided by total non-specific borrowing 14 lakhs into 100. Answer, just check. I think it is something around 10% or some change. 142 divided by 1400 is 10.14. 10.14 is my capitalization rate. Let's say, for example, taking the same capitalization rate, let's say my qualifying asset had a value of 8 lakhs. On this, let's say my specific borrowing is, let's say, 5 lakhs, which I have borrowed at let's say 14%. Then you need to understand, out of 8 lakhs, 5 lakhs is financed out of specific borrowing. The balance 3 lakhs should be financed out of non-specific borrowings, assuming that there is no promoter funds. If I have to identify the borrowing cost eligible to be capitalized, borrowing cost eligible to be capitalized is equal to my borrowing cost eligible to be capitalized. Calculate. First part, specific borrowings. How much of specific borrowing was utilized for construction of qualifying asset? 5 lakhs, which I borrowed at 14%. I'm taking 12 months completely. Therefore, the amount is 70,000. To the extent of non-specific borrowing, how much did I utilize? 3 lakhs. What is the capitalization rate? I've already calculated capitalization rate. The capitalization rate is 10.14. Calculate. This is nothing but 30,420. Total is 1,04,20. you have to record entries for this, I'll go on like this. First, I'll record the amount of borrowing cost paid, borrowing cost account debit to bank. How much borrowing cost did I pay? On non-specific borrowings, I paid a total borrowing cost of 1,42,000. Correct? On specific borrowings, I paid a borrowing cost of 70,000. So 1,42,000 on non-specific borrowings plus 70,000 on non-specific on specific borrowing. The total borrowing cost which I incurred is 2,12,000. Out of this 2,12,000, I am capitalizing 1,04,20. Therefore, I'll record the entry like this. P&L account debit. How much should be debited to P&L? I don't know. But I know that the qualifying asset should be capitalized with the borrowing cost to borrowing cost. So I'm cancelling the borrowing cost straight from whatever I paid into my P&L and capitalizing it to the cost of the asset. How much do I capitalize? Check. I capitalize 1,04,20. So this amount is 1,00420 capitalized to the cost of the asset. Total borrowing cost incurred 2,12,000. This is what we got in the first hit. So how much should be parked into your P&L? 1,11,580 should be transferred to the P&L, which should be the balancing figure. This should be the balancing figure transferred into the P&L. So a part of the borrowing cost is eligible to be capitalized, while the balance borrowing cost is eligible to be charged off to P&L. Clear? This is the concept of borrowing cost, on how we calculate the capitalization rate and how much of borrowing cost is eligible to be capitalized. Clear? This concept of capitalization rate will only arise when I consider situations where I have more than one non-specific borrowing. If I only have one non-specific borrowing, then I don't have to take this situation. Directly the interest rate can be considered. This is the two entries that we need to pass to ensure that the borrowing cost is capitalized to the extent it relates to qualifying asset. The balance borrowing cost is eligible to be charged off to P&L. All those who are taking down the example, please take this down. These are the two entries that we pass. Yes, guys, I assume you people have got enough clarity there. Any doubts, you let me. What I was saying was, basically, whenever we have this kind of situation there, you need to understand that a qualifying asset can be an inventory, or can also be a situation where it is a where it can be also it can be an inventory, or it can be a qualifying asset where, like a property, plant and equipment, or could be an intangible asset, or could be an investment property. Remember, there are two particular instances where I cannot capitalize borrowing cost to the qualifying asset. What are the two particular instances? Number one, if the asset itself is measured at fair value. If the asset itself is measured at fair value, you cannot capitalize the borrowing cost to the inventory, to the qualifying asset. Why is that so? Asset itself is measured at fair value. If I capitalize borrowing cost again, the value of the asset will increase beyond its fair value. That is the reason why he says certain assets, which we have seen under Ind AS 16, 38 and 40, were measured at their fair value. If an asset is measured at fair value, borrowing cost is not eligible to be capitalized even if that asset is a qualifying asset. Number one. Number two. Second is a very important exemption, guys. Inventory is also an item of qualifying asset. Because what did he say as a definition of qualifying asset? An asset which necessarily takes substantial period of time to get ready for its intended use or sale. So what is an asset which is intended for sale? Inventory. That means an inventory can also be an item of qualifying asset, right? So my question here is, when can an inventory be considered as a qualifying asset? When the inventory necessarily takes substantial period of time. That means the inventory, for the purpose of its production, is taking more than 12 months. Let's say I have a case where my production capacity is 5 units per day. 5 units per day. The current order which I have is to supply 2000 of such inventory. 2000 inventory I have to supply, or let's say 10,000 inventory I have to supply. 10,000 inventory if I have to supply, and my supply is only up to 5 units per day, my production capacity, then 10,000 divided by 5, it takes me 2000 days to complete the production. 2,000 days to complete production is substantial period of time. Can I consider it as a qualifying asset? Answer is no, because he says inventory produced on a repeated basis through a same production cycle on a repetitive manner. If I'm producing inventory through the same production process on a repetitive manner, you cannot consider it as a substantial period. So to comply with the order, you cannot consider it as substantial period. Inventory produced in huge volumes put through a repeated production cycle cannot be considered as qualifying asset even if it takes substantial period of time. Here, two exemptions where I told you. One, if the asset itself is measured at fair value, no capitalization of borrowing cost. Two, inventory produced in large quantities through a same production cycle on a repetitive basis cannot be considered as a qualifying asset even if it takes substantial period of time. These are two particular exemptions which have to be understood along with the standard of Ind AS 23. Since we have understood the qualifying asset and capitalization of borrowing cost to it, let's get into the last three concepts. Commencement of capitalization, suspension of capitalization, cessation of capitalization. What are these three words? Commencement means start. Cessation, cease, stop. Suspension, temporarily I'll break. Temporarily I'll break for it. So if you look at it, what is commencement? Commencement is when should I start capitalizing of borrowing cost? Capitalization of borrowing cost should commence when the following conditions are met. What are the conditions? First one, borrowing cost should be incurred. Cost on qualifying asset should be incurred. And activities necessary for the construction of qualifying asset are in progress. If all these three conditions are met, then you can say that there is a commencement of capitalization, or the capitalization of borrowing cost should start. Let's see. Borrowing cost is incurred. Let's say, for example, I have started a qualifying asset construction on 1st of April 2020. I have taken a borrowing only on 30th of June 2020. From 1st April to 30th June, the enterprise is using its own resources to commence for the construction of qualifying asset. You cannot capitalize the borrowing cost from 1st April to 30th June because there was no borrowing. There was no borrowing cost incurred. Therefore, you have to commence capitalization of borrowing cost only when the actual borrowing cost is incurred. Other example, I have taken the borrowing on 1st April, but I haven't started the construction of qualifying asset. 2 months later, in the month of 1st of June, I started the construction of qualifying asset. In such cases, the first 2 months for April and May, I incurred a borrowing cost, but the borrowing cost is not eligible to be capitalized since the cost on the qualifying asset is not incurred. Since the cost on qualifying asset is not incurred. Number 3. I paid an advance to the supplier for supply of materials for the purpose of qualifying asset. Supplier delivered the material after 2 months. Until 2 months, I did not undertake any activity for the construction of qualifying asset. I have taken a borrowing. I gave an advance to the supplier. I incurred borrowing cost. I incurred expenditure on qualifying asset. But the material was supplied to me 2 months later. After 2 months, I started the construction of qualifying asset. Therefore, in this case, I can say that even though borrowing cost is incurred, even though I incurred a cost on qualifying asset, I am not eligible to capitalize the borrowing cost during the 2 months period because no activity was undertaken which was necessary for the construction of qualifying asset. Therefore, the third condition says activities necessary for the construction of qualifying asset are in progress. Let's say a qualifying asset is a building which I am constructing. Okay, I've taken a borrowing. And I paid the architect a sum of 1 lakh. Expenditure on qualifying asset has been incurred. I went to the architect the very next day. He started doing some drawings on AutoCAD. AutoCAD is a software that the architects use. So he started doing the drawing. We had days and days of discussion on how the building should actually frame up. We had disagreements, we had agreements, but ultimately it took 20 days for the final drawing to come in. Finally, I took the drawing, I went to an engineer and I said, according to this drawing, I want the construction of qualifying asset. Engineer walked into the premises, looked at the land, took the dimensions of the land, said, checked the level of the land, said that the land is not level. So he started guessing or estimating what is the excavation work or cleaning up work that he has to do. For all this, he took another 10 days. 11th day, he started cleaning up the process and construction of qualifying asset. So a planning and designing was what was happening over 30 days period. Can I capitalize borrowing costs during 30 days? Yes, because he says your activities necessary for the construction of qualifying asset also include designing and planning as well. So activities like designing and planning are also considered as activities necessary for the construction of qualifying asset. Clear? So I will start capitalization of borrowing cost when all the three conditions are met. Borrowing cost is incurred, expenditure on qualifying asset is incurred, activities necessary for the construction of borrowing cost are in progress. Then we will come into the next paragraph, cessation. Cessation means stop. You cannot capitalize after that. I'll give you the sentence, listen to it very carefully. I'm saying the capitalization of borrowing cost on a qualifying asset should cease, should stop when the asset is ready for its intended use or sale. Capitalization of borrowing cost on the qualifying asset should cease when the asset is ready for its intended use or sale. Very good. Let's see. For example, I am constructing a building. This building which I am constructing is an investment property with an intention to let it out on operating lease in future. I took a borrowing for it. I started incurring borrowing cost. I incurred expenditure on qualifying asset. Activities necessary for construction of qualifying asset are in progress. I started capitalizing the borrowing cost. Building was almost complete. Where it said stop capitalization, I thought if I stop capitalization, then the borrowing cost should go into the P&L. P&L will get affected. So I said, let me say, until I find an tenant, until I find a lessee, let us continue the construction. Construction was over. So what he did, every day he used to go into the construction site, fit one screw into the window and come back. Fit one screw into each window and come back. Like that, he continued to do it for another 3 months. 3 months later, he found a tenant. He fit all screws in one day and he said, yes, stop capitalization. The intention of the enterprise there is to use the provisions of Ind AS 23 to prolong the period of capitalization. Why do they want to prolong? Because if I stop capitalization, the entire borrowing cost should be coming into P&L. I don't want my P&L to be affected. That's why I continued the construction of qualifying asset until I find a tenant. Once I found a tenant, operating lease income was recognized, borrowing cost expenditure can be recognized, enterprise happy. Is it in compliance with the standard? Answer is no. Because I read out the sentence a little modified. I'll give you the exact sentence now. Capitalization of borrowing cost should cease when the qualifying asset is substantially ready for intended use or sale. Not ready. Use the word substantially ready. When I use the word substantially ready, that means basically it need not be ready in complete sense. An almost ready situation is sufficient. The intention of including this word substantial is to discourage enterprises from taking undue benefit of the paragraph. Clear? If that word substantially was not there, then the treatment which I suggested to you, saying that you fit one screw every day and you keep on capitalizing, would have been correct. But here now in this situation, since the asset was substantially ready, they have to stop capitalizing, and the suggestion which I gave you to prolong capitalization of borrowing cost is not appropriate as per Ind AS 23. So we have seen commencement, when to start. We have seen cessation, when to stop. Now my question is, what is suspension? Suspension means temporary period. A particular athlete was found caught of doping or use of illegal drugs, suspended for 2 months. What happens? After 2 months, he can come back and start playing his sport. That is a temporary break that they happen. So there is a temporary break even in capitalization also. He's saying for a temporary period, I will suspend the capitalization of borrowing cost. Question will be why? Why? Capitalization of borrowing cost can be suspended. Can be suspended if the active development of qualifying asset is interrupted. Saying the capitalization of borrowing cost on a qualifying asset should be suspended when the active development of the asset is interrupted. active development is interrupted. Means what? That means I am not performing any activities necessary for the construction of qualifying asset. Let's say, for example, my qualifying asset is being worked upon only 5 days a month, 5 days a week. 2 days, Saturday and Sunday, are off. We are CA students, we don't have off, but in general sense, weekends are normally off. Saturday, Sunday, they stopped working. Gandhi Jayanti, that B.R. Ambedkar birthday, Guru Nanak Jayanti, all Jayantis are there in India. Festivals, don't even ask. Muslim, Christian, Hindu, Parsi, we enjoy every festival. There is no particular religious debate as far as festivals is concerned. We will celebrate Ramzan, we will celebrate Christmas. Ramzan, we will eat halim, we will eat kheer. Christmas, we'll have our cake. Hindu, whenever you have Diwali, we have sweets. Everything we do. So those holidays also you consider. So 2 days every week, 52 weeks, 104 days off. Apart from that, August 15th, January 26th, Gandhi Jayanti, all these offs included another 10 days. Festivals take another 20 days. So about 130 days or 140 days, I don't really work. Total 365 days or 360 days in a year. If 130 days I don't work, that means 1/3 of the days I am not actually working. If I am not working for 1/3 days, that means for 1/3 days, there is no active development on the construction of qualifying asset. When there is no active development in the construction of qualifying asset, then your capitalization should suspend. So therefore, out of total borrowing cost, 1/3 should be transferred to P&L, 2/3 is eligible to be capitalized, is absolutely wrong. Why? Because he said capitalization should be suspended when active development is interrupted, no full stop, over an extended period of time. What do you mean by extended period? Dasara holidays 4 days, not extended period. Christmas holidays 8 days, not extended period. Extended period is beyond normal length of interruption, beyond normal period. Let's say, for example, COVID situation has occurred. Suddenly for 2 months there was a lockdown, no active development happened, 60 days we did not perform any activity. This is called as a beyond normal length or extended period of interruption in active development of the asset. Therefore, the capitalization should be suspended. Capitalization of borrowing cost should continue if the suspension is necessary to get the asset ready for its intended use or sale. What do you mean by this? Capitalization of borrowing cost should continue if the suspension is necessary to make the asset ready for its intended use or sale. Someone gave the example of cheese or wine. Cheese and wine, you actually make the mix and leave it for a set number of years. As it ages, it will start becoming even more better. So in such kind of situations, there is no active development which you do, but leaving it out or not doing any active development itself is necessary for making the asset ready for its intended use or sale. Therefore, in such situation, you are not supposed to suspend capitalization. I will not suspend capitalization of borrowing cost if the interruption in active development of the asset is necessary to make the asset ready for its intended use or sale. Clear? Now you tell me, any doubts? Even if the cause is beyond the control of organization, absolutely. If there is a strike or a lockout, if there's a strike or a lockout in the enterprise, then obviously it is beyond the control of the enterprise. It is necessary for us to suspend capitalization even in those situations as well. So let's start with Ind AS 116 leases, guys. Guys, this is a very interesting standard because has a significant change from what we learned as far as IGAP AS19 was concerned. AS19 and Ind AS 17 leases were actually more or less in line with each other. But after 2019-20 financial year, or with effective from 1st April 2019, when leases became effective, there's a significant difference in the way lease gets accounted, especially in the books of lessee. It has taken a significant different view or different approach in recognizing a lease in the books of lessee. So this standard Ind AS 116 replaces Ind AS 17 starting from 1st April 2019 onwards. So any enterprise adopting Ind AS starting from 1st April 2019 should adopt Ind AS 116 for determination of leases. Now, what is this Ind AS 116 talking about, and how do we recognize leases, especially in the books of lessee? Lessor, there is no significant difference. Whatever we have learned as per AS 19, I'll repeat once again. But lessee is the one where significant differences have actually occurred. Let's see what we have here. Here we say that according to your Ind AS 116, it applies to all types of leases. It applies to lease of machinery, lease of land, lease of any building. So lease of any kind, either written or oral, whether there is a written lease agreement or an oral lease agreement, shall be applying this particular standard. However, there are certain exclusions from the purview of the standard or from the scope of the standard. What are the exclusions from the scope of the standard? First one, biological assets. Because you have a particular standard called as Ind AS 41, guys, not 40, Ind AS 41, which particularly deals with agriculture, where biological assets are specifically dealt with, they are excluded from the purview of the standard Ind AS 116. Exploration of mineral oils, natural gas, etc., they are governed as per Ind AS 106, which is not related as far as your portion is concerned, but there is a particular Ind AS regarding that. 104 and 106, both the standards have been eliminated for you. Both are really important standards as well. But however, since they're not there in your portion, even your Ind AS 116 excludes them because there is a particular standard which deals with them in particular. Licensing arrangements of motion picture rights, manuscripts, videos, scripts, etc. These should be excluded because Ind AS 38 intangible assets deals with those kind of items. License of intellectual property rights is also excluded because it is covered as per Ind AS 38. Your service concession agreements is a part of Ind AS 115. Your revenue from contracts with customers is also excluded because it is particularly dealt with under Ind AS 115. So these are excluded because they are dealt with under another specific standard. Clear? Now, apart from these exclusions, any other lease shall be accounted only as per Ind AS 116. Now, though we talk about exclusions from the scope, there are certain exemptions from application itself. There are two types of leases which are exempted from application of Ind AS 116 leases. What are those specific exemptions provided by the standard where the principles of Ind AS 116 of recognition and measurement need not apply? These are short-term leases and lease of low-value items. Short-term leases are leases where the lease term is less than or equal to 12 months. That means not exceeding 12 months. Such kind of leases are called as short-term leases. And also, even if there is a renewal option for a short-term lease, such renewal option is not reasonably certain to occur, then you can call it as a short-term lease. Let's say a lease term is for 11 months, but can be extended for furthermore 11 months at the option of the lessee, and the lessee is certain to renew the lease at the end of 11 months, then you cannot call it as a short-term lease. So a lease should be less than 12 months, and at the same time, it should not have a renewal option. If there is a renewal option, then the renewal is not certain. In such cases, you can claim an exemption from recognition of a lease under the standard Ind AS 116. The second exemption is regarding a lease of low value items. The value of an asset is immaterial. If the value of the asset is immaterial, then you can call it as a lease of low value item. So a lease of an asset which is immaterial in its value is called as lease of low value item. Very small item, even if it is given for 8 years or 10 years of lease, will not be considered under Ind AS 116. You can claim exemption regarding that because these are immaterial leases, and giving a treatment, cumbersome treatment of Ind AS 116 will unnecessarily make the entire process much longer. That is the reason why they've excluded this completely. However, this lease of low value item should be independent. That means that asset should not be dependent upon the lease of another item, and it cannot be given on sublease to someone. If these conditions are met, that means the value of the lease asset is immaterial, it is independent, and it is not given on sublease, or it cannot be given on sublease. If these three conditions are met, then you can claim exemption from recognizing a lease under Ind AS 116 as a low value item. Clear? So short-term leases, lease of low value items are exempted from recognition under Ind AS 116. So what is the recognition for these items then? These items should be recognized as these items of lease rentals should be recognized as expense in the books of lessee and income in the books of lessor as and when the payment is falling due. Clear? So no 116 will apply. Doesn't mean that you don't recognize. I recognize. How I recognize? Whatever lease payments are supposed to be paid by the lessee should be treated as expense by the lessee. Whatever lease rentals should be received by the lessor should be recognized as income by the lessor in the period in which they fall due. They fall due quarterly. Make sure that you recognize on quarterly basis, but I will exempt them from application of standard Ind AS 116. Clear? Now, what does Ind AS 116 look into? There are certain definitions, certain parts which we have to talk about, and then we will go into the concept of recognition in the books of lessee, recognition in the books of lessor, sale and leaseback, sublease. These are the different parts of the standard. So let's look at the definitions part first. A lease transfers a right to control the asset to the lessee. A lease should transfer right to control the use of asset to a lessee. What do you mean by right to control the use of asset? If a lessee claims to have a right to control the use of the asset, that means he has a right to obtain substantially all the benefits which arise from the use of the asset. That is, exclusive right to use the asset over the lease term. And additional to that, and lessee should have a right to direct the use of the asset. What do you mean by right to direct the use? Right to direct the use means how the asset can be used and for what purpose can the asset be used. Both should be decided by the lessee. Then only you say that the lessee has a right to control the use of the asset. This right to control the use of asset is necessary for me to classify any contract as a lease. For me to classify any contract as a lease, a lessee should have a right to obtain maximum economic benefit from the use of the asset or substantially all the benefits from the use of the asset, and he has a right to direct the use of the asset, how and for what purpose the asset can be used. Looks simple. Looks very simple. Let me try to complicate it. Let's say, for example, a diesel generator set. A diesel generated set, I am not considering it as a low value item. I am considering it as a material item. So you cannot claim exemption under 116, has been taken on lease. That diesel generator set was installed in the premises of the lessee, was attached to the lessee's premises so that whenever there is a power failure, the diesel generator set will be applied. In such situation, the lessee will pay to the lessor a fixed monthly payment, and also based on the number of units it's consumed from the diesel generated set. The diesel should be applied, or diesel cost should be borne by the lessor himself. Lessee will only utilize it. So there are two types of payments he is making. One, monthly payment for the diesel generator set. Two, for even on the basis of number of units of power consumed from the diesel generator set. Now, can I say that this is a power supply contract rather than a lease? Answer is no. Why? Because number one, the diesel generator set is established or installed only in the premises of the customer. So other than the customer, no one else can take the benefit of it. Exactly correct. Absolutely right. Number two, when to use that particular asset depends on the lessee. If the lessee has an outage of power or a power failure, then he can start using it. He can stop using it by shutting down the factory also for that particular period whenever there's a power cut. Let's say it's a scheduled power cut between evening 4 o'clock to 5 o'clock in the evening. A lessee can simply claim that between 4 to 5, I'll stop the entire production process. So diesel generator set need not be utilized. So how it should be used, for what purpose it should be used, it is the lessee who decides. Therefore, you can say that such kind of contracts will fall under the purview of Ind AS 116, and those contracts are of lease. Let's say, for example, there's a specialized machinery which is used for fabrication. Okay. Entity X has purchased this machinery, special purpose machinery, and have installed very next to an entity Y. Entity Y is using the facility or using the fabrication machine of entity X. It pays on the basis of usage. It pays on the basis of usage. The capacity of X is to fabricate 1000 metric tons per day. Entity Y has a use of entity X's machinery for almost the entire 1000 metric tons a day. However, Y did not tell X that you cannot do it for outsiders. But in general sense, establishing it right next to entity Y, X intends to do only for entity Y. Now you tell me, does this contract contain a lease or no? Answer is again yes. Because X is not using the machine for anyone else. Can they use? Yes. But substantially all the benefits or majority of the economic benefits from that particular machine will be used only by the entity. Will be used only by the entity. Number two, entity Y asks entity X on how to fabricate, how much to fabricate, and basically the structure or the design in which they fabricate. So how and for what purpose the asset can be used is directed by entity Y. Therefore, since Y takes substantially all the benefits from the asset and Y will direct X on how and for what purpose the asset can be used, you can say that this contract perfectly contains the lease of the asset, because entity Y has a right to control the use of asset. Clear? Any So we have seen this part where we talk about right to control the use of the asset and where a contract can be called as whether it contains a lease or not. What is inception of lease and what is commencement of lease, and why are they so important to understand? First of all, now why should I know that what is the inception of lease and what is commencement of a lease? I'll tell you. Inception of a lease is the date on which I classify a lease. I identify a lease. I identify a lease on the inception of lease. I recognize a lease on commencement of lease. Oh, inception and commencement are not the same. English Oxford Dictionary, if you look at, actually both will somewhat mean the same. Then how is it so different as far as your lease is concerned? That's why you need to look at what, basically inception and commencement both mean the same. And what is the difference between a chartered accountant and other than a chartered accountant? Everyone will say commencement of lease is start of lease. Inception of lease is start of lease. That is where chartered accountant will come in and say, no. Inception and commencement are not the same. So why my knowledge is important to you, I will exhibit. I will tell you. Inception of lease is the date on which you have entered into the lease agreement, or the date on which principal provisions of lease are agreed upon. Inception of lease is the date on which I entered into the lease agreement, or the date on which the lease agreement, or the date on which principal provisions of lease are agreed upon. What do you mean by principal provisions? Let's say, for example, I gave you a lease contract of 150 pages. 150 page lease contract I gave you. I threw it on your face. I said, in 15 minutes, give me a brief of what it contains. What do? I'll quickly look at the pages. First thing, what is the asset? For what purpose it can be used? How long is the lease tenure? What is the lease payments? What is the periodicity? Should I pay it monthly, quarterly, annually? What is the increase in lease rentals each year? These are generally the principal provisions which I concentrate upon whenever a lease document is given to. So the date of lease agreement, or the date on which principal provisions of the lease are agreed upon, whichever is earlier of these two, should be considered as inception of lease. On the date of inception, I will classify or identify whether the transaction contains a lease or not. Clear? Number 2. What is commencement of lease? The date on which the leased asset is made available to the lessee. The date on which the leased asset is made available to the lessee. So the lessee can start using the asset from that particular date is called as commencement of lease. The date on which lessee has a right to control the use of asset is called as commencement of lease. The distinguishment between both is very simple. Let's say, for example, I entered into a contract with Mr. X. Mr. X is into manufacturing of commercial vehicles. I entered into a contract with Mr. X to lease a commercial vehicle for 5 years. However, I have asked him to customize the vehicle in a particular manner. Mr. X said he needs 3 months time to customize the vehicle. I've already sent him the lease contract. He signed the lease contract with a particular date, let's say 1st April 2021. And he said, this asset, according to your modifications, will be made available to you starting from 1st July 2021. So 1st April 2021, the date on which the lease was entered into is called as inception of lease. On 1st July, the asset will be made available to the lessee, where the lessee can have a right to control the use of the asset. So from 1st July onwards, you can say that it is a commencement of lease. I recognize the lease. I'll account for lease on 1st July, not on 1st April. On 1st April, I will check whether the agreement contains a lease or not. and if necessary, I will classify the lease. That's it. After that, my accounting treatment starts only on 1st July when the right to control the use of asset was transferred to the lessee by the lessor. This is a significant difference between what is inception of lease and what is commencement of lease. So tomorrow you can definitely exhibit your knowledge in front of a client. When he says inception and commencement is the same, you can tell him that this is a significant difference. What is a lease term? In colloquial sense, the period for which the lessee has a right to control the use of the asset is called as a lease term. As simple as that. A lease term is a period for which the lessee has a right to control the use of the asset. But again, there has to be certain complications to it. Look at it. So he says a lease term is a period for which, a non-cancelable period for which the lessee acquires a right to control the use of asset from the lessor. It is a non-cancelable period for which the lessee acquires a right to control the use of asset from the lessor. Plus, in addition with a period for which it can be renewed. A period for which it can be renewed if it is reasonably certain that the lessee will exercise his renewal option. Okay? Lease term is a non-cancelable period for which the lessee acquires a right to control the use of asset from the lessor, plus together with the period for which the lease can be extended if it is reasonably certain that the lessee will extend the lease, plus a cancelable period if it is reasonably certain that the lessee will terminate the lease. What do you mean by this? You should give at least 6 months notice for me to terminate the lease. So what happens here? If it is reasonably certain that the lessee will terminate the lease, but still he has to use the asset for 6 months period, that is called as cancelable period. The period for which the lessee will continue to use the asset until their lease is cancelled, if it is not certain that they will terminate the lease. Clear? So I'm saying it is a period for which the lessee acquires a right to control the use of the asset, plus a period for which the lease can be extended if it is reasonably certain that the lessee will extend the lease, plus a period for a cancelable period, that is a period for which the lessee has to use the asset until the lease is terminated. I'll give you one more. If a lease can be terminated by either parties unilaterally, either party means lessee or the lessor. If either the lessee or the lessor can unilaterally cancel a lease contract without paying a compensation to the other party. Unilaterally, I can cancel the lease without paying any damages to the other party. Then the lease period cannot be determined. It cannot be accounted as per Ind AS 116. It should go into the account as short-term leases only, because you cannot determine the lease period. Either of the party, either lessor or lessee, depending on their mood, they can cancel off the lease. Therefore, a lease term is a sum of together all combination non-cancelable period for which the lessor grants to the lessee right to control the use of the asset, plus the period for which the lease can be renewed if it is reasonably certain that the lessee will exercise his renewal right, or cancelable period if it is reasonably certain that the lessee will terminate the contract but has to use the asset for certain time until the lease is terminated. Together is called as lease term. What is lease payments then? Lease payment means a fixed and a periodic lease payments which they have to make. Fixed and periodic lease payments are nothing but a certain amount which has to be paid at the end of each month or each quarter or at the end of each year. Annually, quarterly, half yearly or monthly payments. Fixed payments which are supposed to be made. Reduced by any lease incentives which are offered. Lease incentive means basically if you utilize the period, if you use that particular asset for beyond 1 year period of time and you have been continuously meeting the deadline of 10th of each month, then from next month onwards pay 2000 less. Incentive offered to the lessee so that he pays a lesser amount than actually the promised amount is called as lease incentive. Third one, variable lease payments which are based on a rate or an index. What is this rate or an index? It means, let's say I said the machinery which I have given to you supplies power. The power will be determined based on the rate of the electricity board. So electricity board sets out a particular index based on which the lessor charges the lessee a particular fees every month. They are variable because the board keeps on changing the index. If the index changes, automatically your lease payment also changes. So such kind of variable lease payments which are based on a particular rate or an index will also be included within lease payments. Penalty which is payable at the termination of the lease if the lease is not reasonably certain to be renewed. I am estimating that this lease will be terminated. It is reasonably certain that I will terminate the lease. But at the time of termination of the lease, I am supposed to pay a compulsory value, a termination value. That penalty for termination is also included within lease payments if it is reasonably certain for the lease to be terminated. Lastly, guaranteed residual value. What is this guaranteed residual value? I will take it up later on. Park it aside. I will tell you what is residual value, what is guaranteed, what is unguaranteed, who gives a guarantee, how many guarantees can be given. We will discuss about that. So fixed and periodic lease rentals, less all lease incentives, variable lease payments which are dependent upon a rate or an index, penalty for termination of a lease if it is reasonably certain for the lease to be terminated. Lastly, guaranteed residual value. This combination is called as lease payment. There are certain exclusions from lease payments. There is a non-lease components in a contract which should not be considered as a part of lease payment. What are these non-lease components? I give you a machine on lease. At the end of each 6 months, I have to replace certain components of the machine. Whenever I replace the components of a machine, I will bill you and you have to pay me for that charges. These repairs, these renewals, any scheduled maintenance which has to be performed and the lessor does the scheduled maintenance, lessee pays to the lessor the particular charge. These are non-lease components. It is a repair charge. It is a maintenance charge. It is not lease charges. Here they should be excluded from lease contract. Or variable lease payments which are not based on any rate or index. It is variable lease payments based on utilization. I utilized 100 units this month. I'll charge 100 units into particular. Next month, there are huge power cuts. I use 250. Then automatically it is variable based on the usage of the lessee. It is not variable based on a rate or an index. Clear? So I'm saying fixed and periodic lease rentals, reduced by lease incentives, variable lease payments which are based on a particular rate or an index, penalty for termination of the contract if it is reasonably certain that the lease will be terminated, guaranteed residual value. It excludes all payments for non-lease elements which are non-lease components which are not covered under the contract paid by the lessee to the lessor, or any variable lease payments which are not dependent upon any rate or index. This is my discussion regarding lease payments, which I'm not done with because I still have to cover the concept of your guaranteed residual value. Let's move further, guys. Yes, what is a guaranteed residual value? What is a residual value? What is a guaranteed residual value? What is an unguaranteed residual value? How many types of guarantees can be given? A residual value means, I'm talking about residual value, RV. It is the fair value of the leased asset. It is the fair value of a leased asset at the end of the lease term. Lease term is 5 years. At the end of the 5th year, what is the fair value of the leased asset? The leased asset is 5 years old. So what is the fair value of the leased asset at the end of the lease term is called as residual value. But since the lessee himself is using the asset for 5 years period, lessor offers to the lessee, why don't you buy the asset at the end of the lease term? After 5 years, you buy up the asset. Fair value is 100 rupees. I'll give it to you at 60 rupees. Take it. Buy. Will he buy? That is dependent. But such value at which the lessee can acquire the leased asset at the end of the lease term is called as guaranteed residual value. Let's say, for example, lessee said, I don't want to buy. Now someone will ask me, sir, what if lessor is asking for 120 rupees, not 100? Then lessee obviously won't buy. See, if it is less than fair value only, he will buy. If it is more than fair value, he'll say, Ram Ramji, I don't want to buy your asset anymore. So you need to understand a guaranteed residual value is always less than residual value. I'll tell you. Let's say you have written an exam. ICAI has circulated a questionnaire for you, asking you what are your expected marks in each exam. And he said, take a total of 800 marks of the 8 subjects that you have written and give me a number on how much you are expecting. You thought you did fairly well. 450 is something which I am expecting. But ICAI put up a clause. If you fill up the questionnaires and if you don't get exactly the same marks, or if you get less than that marks, you will not write CA final again. So, you tell me how much are you going to write in that question? Will you write 450? Will you write 400 at least? Or will you write 100? Or will you write 200? How much will you write? If I was there, I would have written 100 only. Or if possibility is there, I'll write 10 only. Because I don't know with certainty what I will get. Fairly, I should get 400 plus. But I don't know. But since you are asking me to give a guarantee, saying that below this I won't get, then I have to give you a guarantee of much lower amount. I can never give you a guarantee for more than that. So therefore, you need to understand that guaranteed residual value, if someone is guaranteeing you, then obviously he'll give it at less than residual value. Less than fair value only he'll give. The difference between the fair value of the asset and the guaranteed residual value of the asset, the difference is called as unguaranteed residual value. Let's say fairly, I think I will get 450 on 800, but I wrote as a guarantee 200. Then the difference of 250 is called as unguaranteed residual value. Now, should the guarantee be received by the lessor only from the lessee is the question. Answer is no. Let's say, for example, I've taken a bus on, I purchased a bus and I've given it to a travels on hire, on lease. The travels person has taken it for 3-year lease. At the end of the 3rd year, the travels fellow is saying, I don't want to buy your bus, you take your bus. I said, what will I do with the bus? I can't go to my place of work every day on a bus. I need a car for that, not a bus. So I have to find potentially who is ready to take over a second-hand bus. I identified a school. I went to the school and I told him, new bus is there, which is right now out on lease for 3 years. At the end of 3 years, once the lessee leaves the asset, I will deliver it to you. You purchase the asset at the end of 3 years. School fellow said, why should I buy? New bus, sir. New bus is 1 crore. 3 years later, old bus also, if you take, easily 50 lakhs. But this is said, if you give me a guarantee today, I'll give it to you at 35 lakhs. Take it. 30% discount I'm giving. Then, in such cases, the guarantee to the lessor was not given by the lessee. The guarantee was given by a third party. So, a lessor can receive a guarantee for a leased asset. To purchase the leased asset at the end of the lease term, either the lessee can give a guarantee or a third party can give a guarantee. Guaranteed residual value is always less than residual value. The difference between the residual value and guaranteed residual value is called as unguaranteed residual value. There. Yes, guys. So let's start looking recognition of lease. When I start looking at recognition of lease, the first thing that I look at is recognition of a lease in the books of a lessee. Lessee is the person who has taken or who has obtained a right to control the use of the asset from the lessor for a particular lease term or for a particular lease period. This lessee has obtained a right to control the use of the asset. Therefore, by applying the concept of substance over form, even though he is not the owner of the leased asset, even though he has not obtained the legal title of the asset, he will recognize the right to use the asset. So therefore, he recognizes an asset. What is the asset he recognizes? Right to use the leased asset. So therefore, this tag is called as, or this heading is called as right to use asset, ROU asset. At the same time, he also recognizes a liability. What is the liability that he recognizes? He has a liability to pay the lease rentals over the lease term to the lessor. He has a liability to pay lease rental to the lessor over the lease term. This payment of lease rental to the lessor at the, throughout the lease term is called as a lease liability to be recognized in the books of lessee. So lessee writes an entry as ROU asset account debit to lease liability. How does he measure this ROU asset? How does he measure this lease liability? ROU asset should be recognized at the value of lease liability plus payments made to the lessor prior to the commencement of lease. I paid you 50,000 upfront and I am agreeing to pay 10,000 rupees to you over the lease term. So how do I recognize the ROU asset? 50,000 plus the liability to pay 10,000 rupees over the lease term. That is the second one. Third one, initial direct cost on lease, which we will have a discussion about. What is initial direct cost and how does he incur? And if he incurs, what is the entry that has to be recognized? Finally, lastly, I will recognize a provision for dismantling, removal, and site restoration, just like how I'll recognize even for Ind AS 16 or 40. The same cost of dismantling, removal, and site restoration has to be included even to the value of ROU asset. So I'm saying the ROU asset should be measured at the amount paid to the lessor before the commencement of lease plus the lease liability, which is the value of the lease rentals paid to the lessor over the lease term by the lessee plus initial direct cost on lease to acquire the leased asset. Number 4, provision for dismantling, restoration, and removal, which has to be included just like in the case of Ind AS 16 or Ind AS 38. If you look at computation or measurement of ROU asset, lease liability was an integral part. So how do I measure a lease liability? Lease liability should be measured at the present value of lease payments arising over the lease term. Present value of lease payments, periodic lease payments, series of lease payments which the lessee makes, they have to be discounted to the present value, whichever are paid over the lease term. Lease term is 6 years. Every month I have to pay 12 months into 6 years, 72 installments, 72 lease payments. Those 72 lease payments, if they are discounted to their present value, will be my lease liability. What is the rate at which they have to be discounted? The rate at which they have to be discounted is called as interest rate implicit from lease or an incremental borrowing rate. Interest rate implicit from lease can be also called as IRR or incremental borrowing rate, which is called as IBR. So I'm saying a lease liability is present value of lease payments made by the lessee over the lease term discounted to their present value. That discounting should be based on the rate called as interest rate implicit from lease IRR or could be also called as incremental borrowing rate, that is IBR. This value of lease liability is also included in the value of ROU asset. In your right to use asset, lease liability, amount paid to the lessor before the commencement of lease, initial direct cost of the lease, And finally, provision for dismantling, removal, and site restoration also should be included in the computation of ROUSA. Clear? What is this interest rate implicit from lease and what is this incremental borrowing rate? Which of these two rates is more appropriate to be applied, and when do I apply IRR? When do I apply IBR? Let's try to break down and let's try to see each one separately. Park that aside. Park the first part aside. Come down below. What is IRR? IRR is a rate at which the present value of lease rental plus guaranteed residual value is equal to fair value of the leased asset plus initial direct cost by the lessor. If the lessor has met any initial direct cost, it should be added to the fair value of the asset. If that is equal to the lease payments plus the GRV present value, that rate is called as IRR or interest rate implicit from lease. So what am I saying? Interest rate implicit from lease is a rate at which the present value of lease payments made over the lease term and the guaranteed residual value paid towards the end of the lease term is equal to the fair value of the asset and the initial direct cost of the lessor. Then you call it as IRR. What is IBR then? Incremental borrowing rate. The rate at which the lessee can borrow funds to purchase the leased asset instead of acquiring the asset on lease. I need this asset. Since I don't have sufficient funds, I am going for lease option. If I had sufficient funds or if I can borrow sufficient funds, I would have bought that asset. Then at what rate you would have borrowed the funds? That rate at which you could have borrowed the funds to purchase the asset instead of acquiring the asset on lease is called as incremental borrowing rate. Which rate is more relevant? IRR is more relevant. However, if your IRR cannot be ascertained, the lessee can adopt an IBR or incremental borrowing rate as well. Clear? Now, we have seen initial measurement of lease of ROU asset and lease liability. Subsequent measurement of ROU asset and lease liability should happen in this way. As far as your ROU asset is concerned, apply cost approach or revaluation approach as we have already discussed under Ind AS 16, 38 and 40. We have discussed these approaches: cost approach where I take ROU asset at cost minus the accumulated depreciation, or revaluation approach where I take revalued amount minus subsequent depreciation. This way, I'll identify the value of ROU asset on each balance sheet date. When it comes to the lease liability, the opening lease liability should be added with the amount of interest using IRR or IBR and should be reduced by the lease rental paid during the period. Your opening lease liability should be added with the interest calculated based on IRR or IBR and reduced by the amount of lease rental paid during the period. Ultimately, at the end of the lease term, your lease liability should become zero. Clear? What is this initial direct cost of lease? We said initial direct cost of lease, if it is paid by the lessee, should be included in the cost of ROU asset. This is nothing but an incremental cost paid for obtaining the asset on lease. What cost can be included in this incremental cost of obtaining the lease or initial direct cost of lease, which shall be included in the value of ROU asset? Look at the inclusions. Commission paid to an agent who is helping me to acquire the leased asset. Number 2, legal fees paid for the execution of the lease. So lease is an executed lease document or a stamp duty which is paid, which should be included there. Document preparation cost. I've hired a lawyer to prepare a lease deed. The amount which I paid to the lawyer for the preparation of the lease deed shall be considered as initial direct cost. The payment made to the existing tenant to move out. If the lessee is paying something to the tenant or the existing lessee to leave that leased asset, then the additional amount which I paid should be considered as an initial direct cost of the lease. Consideration paid for obtaining GRV from a third party. this will be paid only by the lessor. Lessor, if they have to obtain a GRV, and if lessee is not giving a GRV, then the lessor has to arrange the guaranteed residual value from a third party. I don't know the third party. So I identified a particular person who could arrange a GRV with the third party. Such amount or consideration paid in obtaining the GRV from the third party should also be included in the initial direct cost. This is initial direct cost either met by the lessee or could be met by the lessor. If it is met by the lessee, I will include it in the value of ROU asset. What are the exclusions then? Any salaries paid, advertisement or depreciation before the commencement of lease should be excluded from the initial direct cost. Salaries paid, I already paid the salary. It's a sunk cost. There is no additional cost which I paid. There's no incremental cost which I paid. Advertisement. Advertisement to get a lessor or to identify a lessee or to identify a lessor cannot be considered as an initial direct cost. It should be transferred to P&L immediately when I incur that expenditure. Any depreciation on the leased asset by the when owned by the lessor before the commencement of lease cannot be considered as initial direct cost of lease. Clear? Now, this is initial recognition. This is subsequent recognition. We have seen what is IRR, what is IBR, at what rate they have to be discounted. We have also seen what is a lease liability computation, the payment which is made prior to the lease, and the initial direct cost, the provision for dismantling which we have already discussed upon. Subsequent measurement also discussed upon. Now we will move into the most important concept of lease, which deals with modifications of lease. Earlier. Now, there is a doubt which someone has claimed saying that what if there is a difference between an ROU asset and a lease liability? If you look at it, when I write the entry of ROU asset account debit to lease liability, the entry will tally. How will it tally? ROU asset should be increased by the payment. Sorry, ROU asset inclusion is what? Lease liability. But apart from lease liability, there are three more points which I have added in ROU asset. So that means the value of ROU asset is much more than the value of lease liability. So ROU asset account debit to lease liability will not tally because of the three inclusions which I did. What are the inclusions? First one, payment made to the lessor prior to the commencement of lease. So to start the lease itself, I made some initial down payment. So in that case, I will write the entry as ROU asset account debit to lease liability to bank. Entry tally. What if there is an initial direct cost of lease which should be included into the ROU asset if they are incurred by the lessee? Initial direct cost incurred by the lessee included in the value of ROU asset. Entry ROU asset account debit to lease liability to bank, cost paid by the lessee. Regarding provision for dismantling and removal and site restoration, ROU asset account debit to lease liability to provision for dismantling, removal and site restoration. In all cases, whatever you include, ultimately the entry will tally. Clear? The entry will tally, guys. There is no doubt about it. What is this lease modification then? Lease modification arises due to 5 reasons. First one, extension of lease. Initially, I measured the lease term as 5 years only. Extension of lease was not certain initially, but at the end of 5 years, the lease was extended for a furthermore 3 years lease term. First modification. Early termination of lease. Termination was not reasonably certain, so I assumed that the lease term will be for a complete period of 5 years only. However, due to whatever reasons, after the end of second year, the lessee has given a notice for termination of lease. After 6 months, he has terminated the lease. So lease term instead of 5 years has now become 2.5 years. Change in timing of lease payments happened due to COVID also sometimes, because in some situations, certain payments of April, May, June, which were hugely disrupted due to corona crisis, have been deferred, and the timing has been scheduled at next year also. So these change in lease payments also can be considered as lease modification. Amount did not change, timing changed. Additional asset on lease. Initially, I have taken a lease of 2000 SFT premises. Now I am falling short of it after 2 years. I asked him to add another 500 SFT which was lying vacant out there. So now the leased asset is not 2000 SFT, it is 2500 SFT, additional lease asset. Surrender of a part of underlying asset. Now due to work from home logics, I don't have so much of workspace. So about 2000 SFT was there, out of which I went to the lessor and I said 1000 is sufficient. So remaining 1000 I am vacating it, you use it or you can lease it to someone else. That is surrender of a part of underlying asset. Extending the lease, early termination of lease, change in the timing of lease payments, additional asset being bought in, surrender of a part of underlying asset. These are the reasons for a modification to a lease. What happens whenever there is a modification to a lease? This modification to a lease can either be treated as an adjustment to the existing lease or can be treated as a separate new lease altogether. When can I treat it as a separate new lease? I will treat it as a separate new lease only if there is an increase in scope by adding an ROU asset of right to use of one or more asset. That means I have added one more asset or additional asset to the existing ROU asset. And together plus the increase in lease consideration is equal to the standalone selling price of the additional asset which I bought. Let's say earlier my lease was 2000 SFT. Now due to expansion of operation, I have taken another 500 SFT additionally. So the lessee told me, okay, the lessor gave me the additional 500 SFT, which is an increase in adding the ROU asset. First condition met. Second one, that 500 SFT lease space, if he would have let it out by itself, he would have got 50,000 rupees per month. I also increased my lease consideration by 50,000 rupees per month. So that means the increase in lease consideration is equal to the standalone selling price of the additional asset. Then in such cases, if both the conditions are satisfied, you treat that part of 500 SFT lease as a separate lease arrangement. But let's say, since I already took 2000 SFT on lease, that additional 500 SFT, lessor is offering it to me only at 30,000 rupees. If he would have given it independently, 50,000 he would have got. But since I already own 2000, he is giving it to me only at 30,000. Therefore, the increase in lease consideration of 30,000 is not equal. It is less than the standalone selling price of the additional asset, which would have been 50,000. In such cases, you cannot treat it as a separate lease. Any other case of modification, change in the timings, early termination, change in lease term or that is extension of lease term, surrender of a part of the asset, all these lease modifications should be considered as an adjustment to the existing lease itself. They should be considered as an adjustment to existing lease itself. I will consider it as a separate lease only if there is an additional asset and the increase in lease payment is equal to the standalone payment of that particular additional asset. If it is not the same, then I will treat it as an additional an adjustment to the existing asset itself. Same thing, I'm giving it in a picture form. Is there an additional asset? Yes. Then increase in lease rental is equal to standalone selling price? Yes. Then separate lease. If either of these conditions are not satisfied, treat it as an adjustment to existing lease. Whenever I treat it as a separate lease, again I'll follow the principles of Ind AS 116, where the lessee will recognize ROU asset and a lease liability. But if there is an adjustment to the existing lease, that means only in any situation other than an additional asset is taken and the lease increase is not equal to your standalone selling price, in all other situations, then I will divide it again into two parts. A decrease in lease term or a surrender of an ROU asset will be considered as decrease in scope. Whenever I surrender a part of the asset or I reduce the lease term, then it is an adjustment to the existing lease and it should be called as a decrease in the scope of the lease. Whenever such thing happens, it was a 10-year lease before, now it is cut short to 8 years. Earlier I had 2000 SFT, now I gave off 500 SFT, I am happy with 1500 SFT. Whenever there is a decrease in the scope, then I will remeasure the lease liability on the date of modification. At the same time, the ROU asset should be decreased proportionately. How you will decrease proportionately? Let's say 10-year lease. ROU asset initially measured for over 10 years payment. Okay. You kept on charging depreciation 5 years over. Another 5 years lease is there. Now modification occurred. Now he is saying the lease will be only 8 years, not 10 years. How many more years? 3 years. But actually your ROU, what is existing today, is 5 years. So what should I do? I will proportionately reduce the ROU asset. How I'll reduce? Carrying value of the asset into 2 by 5. That is a reduction in the value of the asset. What about the lease liability? Lease liability should be measured based on the next 3 years payments discounted to their present value. Now there is a reduction in the scope. So how I'll write the entry? Reduce lease liability. So lease liability account debit. Reduce ROU asset to ROU asset. The difference between both, there will be a difference. The difference between both will be charged off to P&L. Clear? Target aside. Next, any other modification, remeasure liability on the date of modification. I will remeasure the liability on the date of modification. That means what? If it is not a decrease in scope, but it is any other case, that means change in the there could be a change in the timing of the payments, right? It could be an extension of the lease, right? Or it could be an additional lease, but not coming that the increase in lease payment are not equal to the standalone selling price. In such cases, if there is any other modification, then you remeasure the lease liability on the date of modification. Whatever is the change in lease liability, same change you perform even on ROU asset. Therefore, I will write the entry of ROU asset to lease liability, or if it is decrease, then lease liability account debit to ROU asset. Whatever it is, ultimately the change in lease liability should be equal to the change in ROU asset. This modification of lease, 2 questions have been added by ICAI. The first 2 questions in your study material which has been added right now are only revolving around these situations. Fantastic illustrations. We will solve one of them. We will solve one of them right towards the end of the session. And that will bring us to the end of lease modifications and the end of discussion in the books of lessor. Let's get into the concept of sublease now. When we talk about sublease, it is a simple case where X has transferred a leased asset to Y. Y has given the same asset to Z. Z pays lease rental to Y. Y pays lease rental to X. X and Y lease is called as head lease. Y and Z lease is called as sublease. And Y here will be called as intermediate lessor. The accounting treatment which is given under Ind AS 116 is only with respect to intermediate lessor. That is only for Y. X does not know about Z. Z does not know about X. It is only Y who knows about both X and Z. Therefore, it is only Y's accounting which I have to be bothered about, which is the intermediate lessor. If sublease is classified as a finance lease, then I will de-recognize the ROU asset. Whatever ROU asset I recognize, when I took the asset on lease from X, I will de-recognize it, and instead I will recognize a net investment in lease. Net investment in lease is nothing but your lease receivable. What is the lease receivable for Y? Look at here. First, when Y took over the asset from X, Y will recognize ROU asset and will recognize a lease liability. But when Y has transferred the same asset to Z, he will de-recognize the ROU asset because it is Z who will recognize the ROU asset. But now Y will recognize a lease receivable from Z. Y's liability to X will always be there. So if I combine both the transaction, it will look like this. Lease receivable from Z account debit to lease liability to X. Clear? If the sublease is an operating lease, then it is not a finance lease, but it was an operating lease, then Y will still have the concept of ROU asset. ROU asset will still be there with Y. However, whatever lease rentals he collects from Z, I will treat it as an income. I will treat it as an income. Clear? ROU asset which is recognized by Y, let's say it is an operating lease. X acquired the asset from X, Y acquired the asset from X on lease. Y has given it on sublease to Z. Z, whatever lease he has given is an operating lease. So whatever Y recognized initially from when he received the lease from X, I wrote the entry as ROU asset account debit to lease liability will be intact. Whatever income I receive from Z as lease rental, I will treat it as income. However, Y will consider that his ROU asset is impaired if the carrying value of the ROU asset is greater than the anticipated sublease income. That means the total of lease receivable from Z should be more than the value of the ROU asset. If your anticipated income from Z on sublease of the asset is less than the value of the carrying value of the asset, then you can say that the ROU asset of Y, intermediate lessor, is impaired. This is the concept of sublease and the accounting in the books of intermediate lessor. Okay, now let's take up the concept of sale and leaseback. Whenever I come across this situation of sale and leaseback, observe that X sells the asset, receives consideration from Y. But Y, who is now owning the asset, will lease back the asset to X, and X will continuously pay periodic lease rent. Why does this transaction take place? Purely finance nature. Because X did not have money, he received consideration from Y. But X needs the asset. So what is doing? X is taking the asset back on lease, paying periodic lease payments to Y. Why did Y do the transaction? He has sufficient cash. So he gave that cash to X. X is paying Y over periodic lease rentals. Whenever I have this situation, in the books of X, who is the seller lessee, I will recognize an ROU asset. Seller X first will de-recognize the asset, correct? When he sold the asset, he will de-recognize the asset. But when he again took it back on lease, I will recognize the ROU asset now. When I recognize ROU asset, I'll apply this formula. Carrying value of the asset before the sale into present value of lease payments which I do divided by fair value of the asset. This is the recognition of ROU asset in the books of X, who is the seller lessee. The asset which is already owned by the X is sold to Y, so I'll de-recognize the asset at its carrying value. But at the same time, I'll also recognize a lease liability at present value. So what is the entry? Bank account debit because I collected consideration from Y. ROU asset account debit because I'm taking the asset on lease to the asset at its carrying value because I'm selling it. I'll de-recognize it, but I recognize a lease liability which has to be paid has to be paid to Y over the lease rent or over the lease term. The balance or the difference of the entry, if any, I will directly charge it off to P&L. If I'm thinking from Y's perspective, he will recognize the purchase of asset and classify and recognize the asset based on operating lease or finance lease because he's a buyer lessor. Lessor accounting requires operating lease and finance lease. So he'll apply the principles of operating lease and finance lease and he will account for the transaction. Clear? This is the concept of sale and leaseback, and that will bring us to the end of the session regarding your Ind AS 116. So now we will be covering the liabilities part. Now what are the Ind AS which are related to a liability side? So until then what we have seen is property, plant and equipment, investment property, we have seen intangible assets, we have seen borrowing costs capitalized to these assets, we have also seen impairment of assets, we have also seen Ind AS 105 which relates to these assets. So all these which we have covered is relating to the assets. But there are also standards which relate to the liabilities. Now you need to understand when I say liabilities, it includes both equity and liabilities. To the extent of equities, I'll put it aside because equities are dealt as per a different standard called as Ind AS 32109. So I'll park them aside. But I will talk about predominantly the other liabilities. Your non-current and current liabilities are the two liabilities which are covered out there. Under your current and non-current liabilities, we have the distinction of financial and non-financial liabilities as well. So we have certain liabilities which are classified as financial and certain liabilities which are not classified as non-financial in nature. These financial liabilities, be it of non-current or current in nature, are discussed under Ind AS 32 and 109. So these two standards will talk about financial assets as well as financial liabilities. So even that part from the liability side is also gone. So majority of the liability side, be it your equities or financial liabilities, are covered under the standard of 32 and 109. Then what are the other liabilities which get covered under the standards which we are going to look at now? So the other liabilities that I'm trying to look at is the non-current liabilities. Now among the non-current liabilities also, what we are going to look at is provisions. So there are certain long-term provisions and even current provisions. So your long-term provisions made for employee benefits, which is a very, very important standard. And other one is your current provisions or any other short-term provisions that you have. These short-term provisions or your current provisions will be discussed as a part of Ind AS 37, which deals with not just provisions, but also deals with contingent assets and contingent liabilities as well. So we will primarily start with the employee benefits part, which is a very important and a noted standard. And one thing that I want to clarify before we enter the session, that don't have a preconceived notion that this is a very difficult standard, because actually it is not. It is not a very difficult standard. It's a very simple standard, but you need a lot of common sense to apply. It requires you to apply some common sense. I don't need you to apply some accounting sense or technical sense. Purely a common sense approach is sufficient for you to understand and interpret and also reproduce in your exam your Ind AS 19, which deals with employee benefits. The other simple standard is Ind AS 37, which deals with provisions, contingent assets and contingent liabilities. Happens to be a very, very plain, simple, vanilla standard. Okay. So while we come to this concept of Ind AS 19, let's see what Ind AS 19 talks about. Ind AS 19 talks about accounting for employee benefits. So when I say employee benefit, so I need to understand first of all, who is this person who is called as an employee? First thing. Number two, what are the benefits which are included into the employee? I think the picture down below is sufficient enough explanation that you have employee means it covers both the employee as well as their family. Absolutely right. So when I talk about an employee, the benefits which are arising to an employee are not just necessarily directly to the employee, but could also provide benefits to the family of the employee as well. So it could apply to the spouse of the employee or to the children of the employee or any other dependent of the employee. So benefits which are arising or benefits which are applicable to an employee or his spouse or his children or any other dependent will get covered as far as the standard is concerned. There are multiple multinational companies which provide employee with healthcare support. Now, healthcare support is basically whenever there's an emergency, whatever healthcare requirement is there, the company will reimburse the employee to that extent. Now, some employees or some employers basically cover employees' health as well as the children's health along with the spouse's health. There are certain companies which also cover the parents of the employee health as well. So that's why I said such benefits can either be provided directly to the employee or to the spouse of the employee or to the children of the employee or even any other dependents of the employee. So these are the employee benefits covered as per Ind AS 19. Not just health requirement, I'm talking about any other benefit as well. Let's say for suppose I have a particular school in which the employer has a particular school in which free admission is provided to the employees. Sufficient enough. You need to understand that Jamshedpur, which is basically where the Tata Steel is actually set up, the entire institutions are maintained by Tata. Be it the healthcare support, be it their education support, all public infrastructure is provided by Tata Steel itself. So all those benefits will also get covered under the standard Ind AS 19 employee benefits. Then who is an employee? An employee can either be a past employee or the present employee. So I can provide benefits or an enterprise can provide benefits not just to the current employee, but also to the past employment as well. Look at government employees. They have a healthcare benefit called as CGHS, Central Government Health Scheme. And your armed forces have something called as EHS, Emergency Health Services. So these services are provided not just to the employees who are currently under employment, but are also provided to the employees who have already retired. So even post-retirement also, they are entitled to take the benefit of these kind of schemes. Central government health schemes and EHS scheme not just covers the employees after retirement, but they also cover the spouse of the employee after the retirement. So all these put together, they can be called as employee. So, and then whenever I use the word employee to define under Ind AS 19, such employee could either be a past employee or could be a present employee. Future employees you can't know. So there is no point of even covering the future employees into the ambit of the definition. So a past employee who has already served the organization and certain benefits are still applicable to him, or a present employee to whom benefits are being provided by the enterprise, all these benefits will come covered under the concept of Ind AS 19. So when I talk about Ind AS 19, what is your Ind AS 19 fundament? What do you mean by Ind AS 19 employee benefits and who is an employee by definition? An employee is a person where there is an employer-employee relationship which exists. If there exists an employer-employee relationship, then such a person can be called as an employee of an enterprise. Now, when can I say that then there is an employer-employee relationship? You need to fundamentally understand that there is a separation or there is a distinguishment which the standard does between a principal to principal contracts and principal to agent contracts. These principal to agent contracts are covered under the definition of employee, but principal to principal contracts are not covered. I still did not even start the standard. You're using words which I don't even understand. What is this principal to principal? What is this principal to agent? Let's say, for example, me as a qualified chartered accountant, I was appointed as a statutory auditor of a company, let's say Reliance Industries Limited. Okay, let's dream big. Okay, let's say for suppose I become the auditor of Reliance Industries Limited. Now look at the concept. Just because I became the auditor of Reliance Industries Limited doesn't mean that the head of finance of Reliance Industries will come up to me and tell me how the audit should be performed. I have qualified my exam. I know how the audit should be performed. I know how to do my audit planning. I know how to do my resource allocation. I know what to see as far as the audit is concerned. I will apply my substantive and compliance techniques in performing my audit, which I have learned already. So I don't need someone else to come and direct me on how to perform my audit. That means as far as the appointment of auditor is concerned, that is the discretion of the management out there. Once the management has appointed me as auditor, how to perform my activities or how to discharge my duties, it is according to me. I plan my audit, I allocate my resources, I make sure that I apply my techniques. So all these things are based on my ideas or my idea of audit or my knowledge regarding the audit. So in such cases, these contracts are called as principal to principal basis. Because we are talking about accounting standard, I'm talking about the example of chartered accounting. See? But if I want to give a much simpler example, let's take a doctor. Let's say I was diagnosed with a chronic disease and I go to the doctor. Doctor said immediate surgery is necessary. He took me to the operation theater. Now I tell the doctor, doctor, I am paying you fees, right? Right? Agreed. I am paying you fees. So you perform the operation according to how I want it to be performed. So you first take the anesthesia first, give me the anesthesia, cut me here, cut me there, then you stitch it again. So all these things, if I tell the doctor will first give me anesthesia and ask me to shut up. So that means, though I am paying the doctor is having complete sense of what he has to perform as far as his duty is concerned. I don't have to direct the doctor on how the duty has to be discharged. Clear? So you need to understand that such kind of contracts where even a payment is done, but the contract between the doctor and the patient is purely on principal to principal basis. The doctor is not the agent of the patient and will not perform duties according to what the agent asks him to do. He will perform his duties based on his technical knowledge is concerned. Same thing is the case with an engineer or an architect. All these are technical services. They are professional services where they perform the duty according to what their knowledge regarding that particular ambit is concerned, but they will not perform the duty according to what the enterprise wants or the employer wants. These contracts are called as principal to principal basis. Let's say, for example, I have hired a driver on a contract. I asked him to slow down, he will have to slow down. If I ask him to stop at a particular place, he will stop at that particular place. So that means, though there is a contract, ultimately you need to understand the driver is performing his duties according to the requirements of the employer. So there, the relationship is not principal to principal. It is called as principal to agent relationship. To distinguish these two, the standard comes out with a very important aspect called as contract of service and contract for service. Contract of service and contract for service. What is a contract for service? Any professional services which are rendered on principal to principal basis. There is no employer-employee relationship and they are excluded from the scope of the standard. But contract of services, they are services which are performed at the direction of the employer on a principal to agent basis, where the employer-employee relationship exists and therefore they should be included within the scope of the standard. So who is an employee? Either the past employee or the present employment. Either he is in a full-time employment or a part-time employment, or a casual employment or a contract employment, or any kind of an employee gets covered within the definition of Ind AS 19. When I talk about benefits to employee, the benefit can either be in monetary terms or non-monetary terms. What is a monetary benefit? Purely in cash. Dearness allowance, house rent allowance, educational allowance, traveling allowance, leave travel allowance. So all these are basically cash allowances which are provided to the employee, and they are called as monetary benefits. What are non-monetary benefits? Healthcare schemes, education provided in employer school to the students, or any training provided to the employees, or you can even include a rent-free accommodation, a driver given, a chauffeur driven vehicle free of cost. All these are non-monetary, not in the form of cash. So if you look at your income tax language, these monetary benefits are called as allowances. Non-monetary benefits are generally called as perquisites, your income tax language. Here in our accounting language, we only use the word monetary and non-monetary. We don't use the word allowances and perquisites. I just wrote the word so that you people are clear about what you're basically referring to. And you also can link between Income Tax Act as well as your standard Ind AS 19. And these monetary or non-monetary benefits can be allowed directly to the employee, or to the spouse of the employee, or to the children of the employee, or any other dependents of the employee. Then we can say that they are covered under the scope of this standard Ind AS 19 accounting for employee benefits. Clear? Now, as of now, what we understood is what is the scope of the standard. We just understood that this standard talks about certain kind of employees which are covered within the definition, and certain benefits which are provided to the employee which are covered under Ind AS 19. Now, these employment benefits, we are supposed to account for it. Look at the name which is given to Ind AS 19, accounting for employee benefits. So for the purpose of accounting, that is recognition and measurement. Accounting means recognizing and measuring. To recognize and measure these employment benefits, I will divide the employee benefits particularly into 4 categories. Only for the purpose of recognition and measurement, I am doing this, that I am classifying employee benefits into 4 categories. First one, short-term employee benefits. What is a short-term employee benefits? A benefit which is a benefit to the employee which falls due within 12 months from the date of service by the employee is called as short-term employee benefit. Best example is salaries. A salary falls due within 12 months from the date of providing the service. Guys, actually 30 days. So you serve the employer for month of April. I'll have to make sure that the employee's salary is paid in the next month by May. Sometimes people even paid on 30th April itself. Sometimes people pay it in May 1st. So anytime during the month of May. Since the benefit is accruing to the employee within 12 months from the date of service, you can call them as short-term employee benefits. Okay. Second type of benefit is called as post-employment benefit. Post-employment benefit is nothing but a retirement benefit. A retirement benefit or a post-employment benefit is a much broader sense. What is a post-employment benefit? That means after the employee leaves the employment, that means there is no longer employer-employee relationship. He has now become a past employee to me, but such kind of benefits which are payable after the employment get covered under this definition of post-employment benefit. You can include your provident funds. You can include your gratuity paid. You can include your leave encashments. All these are as superannuity. All these are schemes which are provided post-employment to the employees, and therefore these benefits are called as post-employment benefits. For easier sense to understand, you consider them as retirement benefits itself. No problem. But remember, the word is post-employment benefits. Third one, other long-term benefit. What is an other long-term benefit? That means if you serve the organization for a period of, let's say, 5 years, I'll give you an additional benefit. Let's say you serve the organization for 10 years, I'll give you another additional benefit. So these benefits are arising to the employee only if he serves the organization for a particular period of time. which is generally longer in length than 12 months. If it is arising within 12 months, then it is a short-term benefit. But if any benefit is payable during the course of employment, only because the employee has served the employer for a longer period of time, these benefits are called as long-term benefits or other long-term benefits. They are not benefits which are paid at the time of end of termination or end of your employment, but these are benefits during employment provided to an employee if he serves the organization for a certain period of time. Third, and that is the third one, post other long-term benefits. Let's come to the fourth one, which discusses about termination benefit. What is a termination benefit? A termination benefit is a benefit payable to the employee when the employer-employee relationship is terminated. When do you say employer-employee relationship is terminated? You can say employer-employee relationship is terminated when the employer himself is putting an end to the employment. The employer is calling up the employee and saying that Ram, I don't want you. Please leave the organization. Please leave the organization. I don't want you. In today's language, we call it as pink slip. So pink slip is very famous because of your technology companies which are existing on today's date. They bought out this concept of pink slip. Pink slip is basically a very similar to a post-employment, your termination benefit. There, I give you a pink slip. That means I'll give you 3 months salary in advance and I tell you don't come tomorrow. Very famous schemes under termination benefits is what we received under government schemes, under government employees, which was called as voluntary retirement scheme. A VRS scheme was announced to the government employees probably early 2000s. Okay. At the same time, even you had bankers who gave some similar scheme called as golden handshake. Golden handshake means from tomorrow don't come. I'll give you your benefits, or I'll accrue all the benefits and I'll give it into your account. So immediately when the core banking software was applied, okay, earlier it was a manual banking. That means you can only bank at your branch in which you have an operation. Today, I might have a branch in Hyderabad, but I might be banking in Bombay with the same bank. So that means core banking software or centralized banking has come into picture. So as soon as centralized banking has come into picture, all the existing staff which were accustomed to using the old techniques, they could not really get up. That is the reason why golden handshake has come in, saying that your services are no longer required. You can leave the organization. We will make sure that we are recruiting fresh staff. These are called as termination benefits. Golden handshake, VRS scheme, pink slips, all these are termination benefits. So fundamentally, I'm looking at 4 benefits out here. First one is called as short-term benefits. Second one is called as post-employment benefit. Third one is called as other long-term benefit. And lastly, we call it as termination benefit. What is a post-employment benefit? Short-term benefit. Any benefit which is expected to be settled wholly before 12 months from the end of the annual reporting period in which the employee renders the related service. So employee rendered the related service in a particular year. In that year, whatever benefits accrue to him, if they are falling due within 12 months from the end of the year, it is called as short-term benefit. Salaries, allowances, bonus, profit sharing plans, compensated absences, these are casual leaves. All those come under short-term employment benefits. Next one. What is a post-employment benefits? Benefits which are basically expected to be settled upon retirement of an employee. So after the retirement or after the employer-employee relationship is gone, what are the benefits which are still continuing to be paid? Post-employment health scheme, CGHS, what I gave you, superannuation, pensions, gratuity, all these come under post-employment benefits, which in our language we can call them as retirement benefits. Other long-term benefits which are payable during the period of employment, but only if the employer served for a particular period of time. Disability benefit, sabbatical leaves, these are generally some other long-term benefits, but it depends upon enterprise to enterprise whether they give such other long-term benefits or not. What is a termination benefit? Immediately on termination of employer-employee relationship, whatever benefit is paid to the employee is called as termination benefit. Clear? So you can have retrenchment compensations, you can have voluntary retirement schemes, you can have golden handshakes. All these will be included under termination benefits. These are the 4 categorizations under which I classify my employee benefits. So as far as the accounting is concerned, as far as your accounting for employment benefits is concerned, to perform this, I've divided them into 4 categories. Among these 4 categories, we have only 3 accounting treatments, because he says your short-term employee benefits, number 1 accounting treatment. Number 2 accounting treatment is a combination of both post-employment benefits as well as other long-term benefits, which is the most crucial part as far as the standard is concerned. Lastly, termination benefits, which have a separate recognition and measure. So that means there are 3 types of accounting treatments given for 4 types of employment benefits. Clear? So from here, we will start with first one, short-term benefits. Then we will go into post-employment and other long-term benefits. Finally, we'll discuss about termination benefits. So what is a short-term employment benefit? Any benefits which the employee will receive within 12 months from the end of the reporting period in which the employee has rendered the service is called as a short-term employee benefit. I'm saying any benefit which the employee is expected to receive within 12 months from the end of the financial year in which he has rendered the service is called as short-term employee benefits. Guys, salaries is a classic example. Salaries is a classic example. But don't forget there are further more examples. Bonus. If you remember Payment of Bonus Act, which was a part of your law, you had this concept of minimum bonus to be paid to the employees at the end of the year based on their profit of the enterprise. So that is also amount expected to be paid within 12 months from the end of the reporting period. Clear? Number 3. Generally, under employment, there are certain leaves which are provided to the employee, which are basically called as employee receive some earned leaves, some casual leaves, some medical leaves. These are leaves which are provided to the employee. That means you need not report to work, but I will still compensate you for whatever leave that you have availed. So such kind of concepts will also get covered under this concept. Casual leave is a very common concept, guys. Think about a casual leave. I put a casual leave on a particular day saying that I won't be reporting to work because it's my birthday that day. So what happens? So automatically, even though I haven't reported to work, the employer has to pay the salary to me even for that particular day because it is an entitlement which I have. So you need to understand that these are also benefits which are accruing to the employee during the course of his employment. So short-term employment benefits are salaries, wages, and other short-term benefits. Employee profit sharing plans, which are nothing but your bonus. Short-term compensated absences, which are your earned leaves, medical leaves, and your casual leaves. How do I recognize these short-term employment benefits? Short-term employee benefits should be recognized as expense in the period in which the employee has rendered the service. Even though you said that the benefit is payable within 12 months from the end of the reporting period in which the employee has rendered the service, what is the definition which we have seen? Benefits expected to be settled within 12 months after the end of the annual reporting period in which the employee renders the service. So you are payable within 12 months, but it is arising due to the employment during the current reporting period. Therefore, all such benefits payable to the employee should be recognized as an expense. So it should be recognized as an expense in the period in which the employee has rendered the service on an accrual basis. I pay the salary or not, I will recognize it as expense because it is expected to be paid within 12 months. Bonus, I will create a provision in the current year for payment of bonus, even though I settle it after the end of the financial year. All these are to be provided as expense in the year in which the employee has rendered the service. However, if the benefit paid to the employee during the current reporting period is less than the benefits which are payable, 12 months salary is payable during the current year. I paid 11 months, one more month I will pay in the subsequent year. So what is happening? My benefit paid is only for 11 months, but the liability of benefit is for 12 months. In such case, the enterprise reports a liability. A liability is called as outstanding salary. Whenever there is a payment of bonus, I identify the bonus only payable only towards the end of the year. But I create a liability for the payment of bonus based on the calculations which I make. Clear? In the same year in which the employee has rendered the service, even though the amount is paid in the subsequent year. These are called as liabilities. So I'll recognize a liability when the benefits paid to the employee are less than the amount of benefits which accrue to the employee during the current reporting period. His service in the current reporting period is entitling him to a benefit of 100 rupees. If I pay only 90 and I am expecting the balance 10 rupees to be paid within 12 months from the end of the reporting period, I will report the 10 rupees as a liability. What if I paid excess? That means I gave a festival advance. A festival advance was already paid. So what is happening? I will reduce the advance from the salary of the subsequent months. So in such cases, the benefit paid could exceed the benefit payable to the employee. The entitlement of the benefits to the employee during the current reporting period is 100, but I paid 105. That extra 5 rupees, I will reduce it from the salary of the future period. In such case, that extra 5 rupees will be reported as an asset. So I'll recognize an expense to the extent of benefits arising to the employee during the current year for the employee service in the current reporting period. If the benefit paid during the current year is more than the benefits payable, I'll recognize an asset. If the benefits paid are less than the benefits payable to the employee, I'll recognize a liability. Asset is nothing but advances and prepaids, and liability is nothing but outstandings and provisions. Clear? Remember, when I measure the short-term employment benefits, it should always be done on an undiscounted basis. Why? It should be done on an undiscounted basis because they are falling due at the end of the reporting period itself. What is the discount factor? 1. Because the year for the discounting is 0 and the discount factor becomes 1. Therefore, short-term employment benefits should always be measured on an undiscounted basis. But sometimes when you need to create a provision, like provision for bonus, you need to estimate the provision, and all the judgments made in measuring that provision should be disclosed in your notes to accounts. This is a derivation from Ind AS 1. Ind AS 1 says there are multiple accounting estimates which the management makes. The judgment which the management has made has to be disclosed in your notes to accounts whenever the management uses an estimate in presenting its financial statements. Same way, whenever your short-term employment benefits, there is a estimate which is being made for measuring a provision, then such judgments made in making that estimates should be disclosed in your notes to accounts. But while measuring short-term benefits, I'll always measure it based on an undiscounted basis because the benefits fall due at the end of the financial year itself. Therefore, since they are falling due, you have to make sure that the discount factor is 1. No discounting is necessary. Undiscounted basis measurement is necessary for short-term employment benefits. Clear? I'll progress to the most important part of the standard regarding short-term employment benefits. In short-term employment benefit, there's something really important to be discussed upon. So let's see what these are. These are called as short-term compensated absences. What do you mean by a short-term compensated absence? Your short-term compensated absences are simple nothing but casual leaves or medical leaves. These absences are two types of nature. I can classify them broadly into two types. Accumulated absences, non-accumulating absence. What is accumulating absences? That employee has an entitlement to 12 casual leaves during a year. During a year, an employee is entitled to take 12 casual leaves. Out of the 12 casual leaves, he availed only 4. 8 casual leaves are not yet availed. Now, employer's HR policy can be of two types. He can say that the remaining 8 which you haven't availed, I'll give you a benefit to avail it in the subsequent years. So in the next year, instead of availing 12 casual leaves, you can avail 12 plus 8 carried forward from the previous year. 20 casual leaves you can avail in the next year. These are called as accumulating short-term compensated absences. What are non-accumulating? If you don't avail, they will lapse. Generally, casual leaves are accumulating in nature. Medical leaves are non-accumulating in nature. Generally, I'm talking about. I am not standardizing because it depends upon the HR policy of the employer. The employer's HR policy generally says that the short-term absences, if they are of nature of casual leaves, they can accumulate. If they are of medical leave, then they cannot accumulate. I am only talking about general sense. I am not specifically mentioning any particular company. I'm saying generally this is what happens. So if the absence, if not availed during the current year, lapses, they will lapse if you don't use it in the current year. They are called as non-accumulating short-term compensated absences. Those non-accumulating absences need not be recognized as a liability. So no further accounting treatment is necessary if those short-term compensated absences are lapsing at the end of the reporting period. Clear? They are non-accumulating short-term compensated absences. But what about accumulating short-term compensated absences? This is very interesting. These accumulating short-term compensated absences should be recognized as a liability. They should be recognized as a provision in your financial statements. Now, these accumulating compensated absences are also of two types: vesting, non-vesting. If they are vesting, that means they are encashable. All those accumulated leaves you can encash towards the end of your retirement date or after 10 years or after 5 years, whatever it is. But the employer is giving you a right to encash those leaves instead of using those leaves. Central government employees can encash 300 casual leaves, almost equal to 12 months salary at the end of their retirement date. That is encashable leaves. They are encashable or vesting, accumulating compensated absences. What is non-vesting then? You can't encash, but you can use. You cannot encash those leaves, but you are entitled to use those leaves. Clear? Whatever is the case, be it vesting in nature, non-vesting in nature, be it encashable, non-encashable, I will have to recognize a provision with respect to these accumulating short-term compensated absences. How do I recognize a provision? I will recognize a provision using the best estimate. What estimate are you talking about? How do I measure this estimate? How do I create a liability or a provision for a short-term compensated absence which is accumulating in nature? Let's see. We will have even questions also on this, guys, because your new ICAI material has included certain questions on these short-term compensated absences. So I will have my heading as short-term compensated absences which are particularly accumulating in nature. If they are non-accumulating, then I don't need accounting treatment at all. Now, what are these short-term compensated absences which are accumulating in nature? And how do we recognize these amounts? Let's say, for example, number of days in a year. Let's say I have about 365 days in a year. Okay. Weekends, 52 weeks, 104 weekends. Office does not work. Correct? Public holidays or your religious holidays. Festivals. We enjoy everything. Let's say I take it as 16 days. Okay. So that means the total working days in the organization is about 245. Out of those 245 working days, I am allowing casual leaves to my employee. And my casual leaves available to the employee are, let's say, 15. So therefore, expected man days for each employee, I expect him to work for about 230 days. So each year, I expect an employee to work for 230 days. So that means for 230 days, working days, I am compensating him with 12 months of salary. Each month I pay him salary. So my 12-month salary is 230 working days equal. If this is the benefit to the employer, the employee's work is the benefit to the employer, then this is the cost of such benefit. 12-month salary is the cost of such benefit. So I'm saying an employee can work in the organization for 230 days and he is entitled to receive 12-month salary. Therefore, I am saying to derive a benefit of 230 days of work from an employee, the employer is required to pay 12 months of salary. Clear? Concept very simple so far. Now let's try to understand. Year 1, year 2, year 3. I'm just taking 3 years for the ease of it. Let's say, for example, each year my working days are estimated to be 245. Let's say the employee is availing some leaves. He is availing some casual leaves. In the first year, let's say he has availed 0 leaves. Second year, he has, however, availed 5 leaves. Okay. So each year he is entitled to receive 15 casual leaves. First year, nothing he availed. Second year, he availed 5. Third year, he was entitled to avail 15 plus second year's 10, 25, which are accumulated. First year's 15, which is 40. Total 40 days he availed of in the third year. Okay. Now try to understand how many working days did he come to the office. He reported to the office entire 245 days in the first year, 240 days in the second year, and 205 days in the third year. But understand, there is a carried forward leave as well. At the end of first year, he was entitled to carry forward 15 days of leave. At the end of second year, he was entitled to carry forward 25 days of leave. Third year, 0 leave. Because he is utilized entirely. Now, remember your cost benefit, which I have told you. What did I say? The cost of 230 working days of benefit derived from the employee is 12 months of a salary. So let's see. Year 1, if I write this as cost and this is the benefit. Year 2, cost and benefit. Year 3, cost and benefit. Remember, what did I tell you? The cost is 12 months salary. Benefit is 245 working days. In every case, it is same. 12 months salary of the cost is equal to 245 days of working days from that particular employee. But actually, how many days were, sorry, what 245 days? I'm sorry, guys. It is only 230 days, right? After casual leave, he is only entitled to take 230 days of benefit. Sorry, what did I say? Yep, 230 working days is 12 months salary. So 230 working days is 12 months salary. But in the first year, the employee served the enterprise for 245 days. That means my benefit is increased by 15 working days. Similarly, next year, he has reported to the office for 240 days. That means additional 10 working days he has reported to work. But there should be a matching cost as well. Because in the third year, in the last year, he did not report to the office for 230 days. He has reported to the office only for a period of 205 days. That is fundamentally what I'm talking about. So here what I do is, whenever you have this kind of concept, to the extent of this 15 working days which he served extra, I'll recognize a cost. What cost I will recognize? I'll recognize a provision of carried forward leave. Similarly, here 10 days of working days, I'll recognize a provision for 10 days of leave. So the total provision at the end of second year became 25 working days. So when I write a cost, automatically I will debit or I'll credit the provision because I'm using the provision for about 25 days. Because I use the benefit only for 205 days. So that means each year, whenever there is a carried forward leave, I have to keep on continuing to create a provision. So what is the benefit that I'll receive? So I'll have to recognize the entry as in the first year. P&L account debit to provision for carried forward leave. First year, I'll recognize the same entry for the second year, but when it comes to the third year, I'll have to reverse the entry. because the provision has been utilized. So provision for carried forward leave account debit. I'm reversing the entry to P&L. Now you will say, sir, what judgment did you apply? You were saying management estimate required certain judgments. Such judgments should be disclosed. What judgment did you apply? 15 working days. I have to create a provision. I know 230 working days is equal to 12 months salary. Then what is the value of 15 days salary? But you need to understand that these 15 days are not utilized in the current reporting period. They are utilized subsequently. When they are utilized, what is his salary? Do I know? I don't know what is his salary. Sir, year on year 15% growth they will give to the employee. So next year salary I can estimate. Do you know next year he'll utilize the leave? I don't know. He can utilize the leave next year. He can utilize the leave in year 3. He can utilize the leave at the end of retirement date also. So therefore, I really don't know. This 15 days should be multiplied with what? In the first year, it should be 15 days into what? His estimated salary when he utilizes the leave. This what is nothing but salary per day. When the employee utilizes the leave, utilizes carried forward leave. When will he utilize the carried forward leave? That I don't know. But I have to make an estimate. Now you will say, sir, making a provision today, right? Making a provision today. When is this provision being utilized? Somewhere in year 3. Even I don't know. At the end of first year, I know in future. Year 2, year 3, year 4, year 50 also you can utilize. So my understanding is, whenever this utilization is postponed, as on today's date, I'll have to discount it to present value. Because here the provision is being used in the third year. When I'm estimating to create the provision in the first year, shouldn't I create a time value of money discounted value? Answer is no. Because it is uncertain. You don't know whether he will utilize the leave next year, whether he'll utilize it in year 3. Since it is example, I told you year 3. It could also be in year 10. So therefore, for me to discount it, I need a discount rate, which is fine. But I also need how many years I have to discount it. How do I know how many years I'll have to discount it? I have no idea. Because I don't know when the employee will utilize the leave. Therefore, I will have to create a provision for carried forward leave of an employee or accumulated compensated absences on an estimated basis. Management makes an estimate to find out what will be his salary when he utilizes the leave and might try to make sure that the provision is calculated. I'll go back to what I have just seen under your carried forward leaves. So provision has to be made on an undiscounted basis since the estimate cannot since the enterprise cannot reliably estimate the year in which such accumulated absences are availed. Therefore, whenever the employer makes an estimate, he has to report those judgments as a part of your notes to accounts. Recognize liability based on the management's best estimate. Guys, vesting benefit and non-vesting benefit, they are not measured in the same manner. Why? Encashable benefit. Encashment can only be to the extent of probably basic and DA only. But non-vesting benefit, when I utilize the leave, then in such cases, then I am entitled to much more amount of benefits. Just because I'm utilizing a leave, the driver or the vehicle which is given to me cannot be withdrawn for those days. The accommodation which is provided to me free of cost cannot be withdrawn just because I have availed the leave. Therefore, while estimating non-vesting leaves, my value of employee's salary is much more than in the case of vesting. Because in case of encashment, I am only entitled to get monetary benefit. Monetary benefit means either your allowances and your salary. That's it. But non-vesting benefit, he is entitled to receive the salary along with monetary as well as non-monetary benefits as well. That is why your estimated value of provision, both in case of vesting and non-vesting, are significantly different. This is a very critical concept. That's why I said more application of common sense than anything else is required. And this is this is a paragraph on which certain questions has been added by ICAI as far as your additional material is concerned. The new amended material applicable from 2021 onwards will have certain additional questions with respect to these short-term compensated absences for which a provision has to be created. Yes, guys. Now that we are done with short-term compensated absences, we have another short-term benefit to an employee which I have to cover. What is the other short-term benefit which I have to cover? That is regarding your employee profit sharing plan. Very simple discussion that we'll do under profit sharing plan. What is a profit sharing plan? Bonus plan. As simple as that. So towards the end of every year, the employer or the enterprise has to create a particular provision regarding the payment of certain commission or bonus to the employees. Some people have a commission because based on the sale they might get a commission. Some people are entitled to receive some profit sharing plans in the form of a bonus. So whenever I create this kind of provision, it is a charge against profit. Though you calculate it based on the profit, I will not call it as an appropriation, but it should be a charge. It is a present obligation arising from a past event. His past service during the preceding financial year is entitling him to receive a certain portion as a present obligation or a present benefit. Therefore, the entity or the enterprise has a present obligation arising from a past event, and a reliable estimate should be made by the enterprise. On this basis, I will create a provision for bonus, a minimum bonus of 8.33% on the total profit of the enterprise. So that is an estimate of the provision which I'll have to make sure that I'm recognizing it in my P&L. So I'll recognize the entry as staff cost or employee cost account debit to provision for bonus or provision for employee profit sharing plan. This is the entry which I'll recognize. So I'll repeat the entry, guys. The entry which I'll recognize here is staff cost account debit to provision for bonus, simple sense, go with the language of the standard, employee profit sharing plan. So I'll recognize this entry, but there should be an amount as well. This amount should be a management estimate. This amount at which I will create this provision is purely a management estimate. This staff cost should in turn be recognized or charged to P&L. Here, this is the provision which I recognize, or this is the entry which I'll recognize for profit sharing plans. That's why I said recognize as a charge against profit for the entity's present obligation resulting from past event and where a reliable estimate can be made by the enterprise. Now you'll say, sir, what if a reliable estimate cannot be made by the enterprise? If a reliable estimate cannot be made for a provision, then it has to be reported as a contingent liability, which we will cover as a part of Ind AS 37. When we talk about Ind AS 37, I will tell you when a provision cannot be reliably estimated, they generally recognize a contingent liability. But when I stick to this employee profit sharing plan, sometimes, let's say, the HR policy of the company is designed in such a way that the employee profit sharing plans are only entitled to employees after 5 years from the date of their employment. They are entitled to the employee only after 5 years. That means they are not falling due within 12 months from the end of the reporting year in which the employee has rendered the service. They are not payable within 12 months. They are payable after 5 years. In such cases, these benefits will not be categorized as short-term benefits, but they should be considered as other long-term benefits. Clear? So in such cases, discounted approach is necessary. So we will see that as a part of other long-term benefits. Clear? So if the benefits are expected to be settled beyond 12 months, then it is considered as another long-term benefit where I will give a treatment on a discounted basis. And that is the last item or last concept to be covered under your short-term employment benefits. So what are your short-term employment benefits that we have covered? Salaries, wages, and other short-term benefits, they have to be recognized on an accrual basis. Employee profit sharing plan, it should be a provision based on the best estimate of the management. Short-term compensated absences, I told you only accumulated absences will require an additional accounting treatment. Non-accumulating absences does not require any additional accounting treatment. Again, short-term compensated absences which are accumulating in nature, I said the provision should be based on whether the absence is vesting in nature or non-vesting in nature. Clear? And that will bring us to the end of discussion on this concept of short-term employee benefits. And the last part that we have discussed is your employee profit sharing plan, which should be a charge against profit based on the best estimate of the management. Clear? Now let's get into the concept of a very interesting or the most interesting part under Ind AS 19, which deals with post-employment or retirement benefits and other long-term benefits. Now, why are these so interesting? I'll tell you. Let's take the best example of a gratuity. How do you calculate gratuity? Gratuity, Payment of Gratuity Act, if you remember, even you had a particular part of Income Tax Act under Salaries chapter, which was dealing with payment of gratuity. So when you talk about gratuity, gratuity is calculated as 15 days of salary or half month salary for every completed year of service or part thereof. So that means a 15 days, let's say I'm taking 15 days salary, 15 days of salary for every completed year of service or part thereof. If I use this language, if I'm using this language, let's say an employee X has completed first year, then his gratuity obligation, the enterprise obligation to pay gratuity to Mr. X is increased by half month salary already. If he completes 2 years, then it is 2 times half month salary obligation has already arisen. Third year when he completed, it became 3 times half month salary. Fourth year when he completed, 4 times half month salary. So like this, by every completed year of service, the obligation of payment of gratuity to my employee keeps on increasing. It keeps on increasing every year. But this obligation of payment of gratuity will only arise if the employee has completed 5 years and has retired from the organization or has left employment. If he leaves employment after 5 years, then this benefit of gratuity is available or the obligation arises to the enterprise. Now my concept is, every year, since there is an obligation to the enterprise which is increasing, I'll have to create a provision. Very good. When I create a provision, how long you should create? As long as he's in employment. But these amounts which are created have to be set aside and utilized for a further period. Correct? So whenever I create a provision, let's say the enterprise has earned a profit of 100 rupees, out of which the employer has created a provision to the extent of 10 rupees. What is the cash profit? 100. But what is the profit after the provision? 90. That means this 10 rupees of provision that you created is a non-cash expenditure which is debited to P&L. Such non-cash expenditure debited to P&L, I'll have to park it somewhere. Why should I park it somewhere? Apply logic. Depreciation, I'll go back to that concept. If you remember depreciation, we had a concept called a sinking fund. Why do you create sinking fund? Because depreciation is a non-cash expenditure and depreciation is trying to create sufficient funds for replacement of asset at the end of its useful life. Every year I'll pull out depreciation from the profit and I'll keep it somewhere. If I put it in my drawer, ultimately there's no profit or there's no addition which is happening. So what do? Every year the concept of depreciation which is pulled out from there, I will take it and I will make sure that this amount is invested elsewhere. If I keep on investing like this, there is a certain amount of return which I'll keep on getting on this. Clear? That's why you have a sinking fund reserve on the liability side and a sinking fund investment on the asset side. Same logic you apply here. Every year I create a provision towards payment of bonus to employees, and this provision which I create towards payment of employees has to be invested because this fund is necessary only when the employee is leaving the organization. When is the employee going to leave the organization? Sometime in future. So therefore, I will have to make sure that these funds are parked somewhere so that it gives me some return on investment, so that sufficient amount is available to repay the employee when he leaves the employment. Clear? This is the underlying concept under your long-term benefits or your post-employment benefits. Clear? Whenever I talk about this post-employment benefits, it requires complex calculation because it is 15 days of salary for every completed year of service into last drawn salary. What is the employee's last drawn salary? I don't know. If you ask me today, let's say an employee at the age of 25 has joined your organization. Today he has already completed 5 years of service. His gratuity obligation of 15 days of every completed year of service is multiplied by 5, number of years of completed service, into last drawn salary. What is his last drawn salary? He is not leaving the organization today. When will he leave the organization? Sir, probably at the age of his 60. What will be his last drawn salary at the age of 60? I don't know. That is why these calculations are quite complicated. Not just to understand for us, but also in practical sense, these are quite complicated calculations. So let's see what we have under the concept of long-term benefits or post-retirement, post-employment benefits which are offered to the employees. My post-employment benefits are basically categorized into two classes or classified broadly into two categories. The first category is called as defined contribution plan. What do you mean by defined contribution plan? Where the contribution made by the employer towards the employee's benefit is fixed, is defined. What is defined means fixed. So the employee's contribution towards payment of benefit to an employee is fixed. Best example is Provident Fund. Provident Fund, what do? The Provident Fund benefits are available to the employee only after certain period of time or when he leaves the organization. So what will happen? The employer will contribute a certain portion of the salary of the employee as Provident Fund contribution from himself. He will deduct a portion from the employee, he will contribute his part and he will deposit it into the employee's PF account. Clear? So here in this case, the employer's obligation is limited to the contribution made by the employee or to the maximum extent of 12% of his salary. As simple as that. So we are saying in a defined contribution plan, which is also a part of post-employment benefits, the employer's contribution towards payment of benefit to the employee is limited, is fixed, is determined, is defined. Clear? In this case, it becomes very simple accounting treatment because whatever is the employee's contribution payable should be recognized as an expense. So therefore, in the P&L, I will debit employer's contribution to Provident Fund directly in the face of P&L as a staff cost. Clear? But the most interesting concept arises when you talk about defined benefit plan. What are your defined benefit plan? Gratuity. The benefit received by the employee is defined. Employee knows I will get 15 days salary for every completed year of service based on my last drawn salary. The employee knows this benefit, how much he will get. But in the case of Provident Fund, the employee does not know because the employee only knows that certain amount got contributed, on that there is a certain amount of interest. How much will I get based on the accumulation? But defined benefit plan, the employee very well knows how much he will get. He will say 15 days of salary I will get for number of years I have spent in the organization based on my last drawn salary. So what is the last drawn salary? That I don't know. So in such cases, your defined benefit plan requires a lot of complex calculations. To manage these kind of complexities, not just for accounting purposes, but even for management to make an estimate, it requires certain complex calculations. That's why they have to plan this obligation. How do they plan? Employer plans this obligation in a particular manner. There are three ways in which the employer can plan his obligation. Number one, multi-employer plan. Why does this concept of multi-employer plan come into picture? Like I told you, every year the employer contributes or makes a certain provision for payment of gratuity to employee. This provision that he makes has to be invested in a certain manner so that he derives maximum benefit from that money. Now, if I invest, let's say I invested in stock market. Suddenly stock market collapsed. What will happen? My entire investment is waived out. So that means to make this kind of investment, I need someone who is knowledgeable to handle this fund. Who is this person who is knowledgeable? They are called as fund managers. They are called as fund manager to whom all these funds are given, and I give him the responsibility of managing the fund in such a way that he derives benefit to the employee. He derives benefit to the enterprise. But one employer alone may not be having a fund manager to manage all these funds because these fund managers are quite costly. So how will I afford a fund manager when my fund size is very small? If you're talking about companies like Infosys, Reliance, Tata, huge enterprises, big enterprises, for them they can afford a fund manager. But it is not necessary for every small enterprise to afford a fund manager. So what they will do, for better management of funds, to employ an efficient fund manager, multiple employers will come together and will say, my current year provision is 100. What is your current year provision? My current year provision is 80. What is your current year provision? My current year provision is 250. Like this, 4 or 5 or even more employers will come together. They will pool their funds and they'll give it to the fund manager. The fund manager will now try to allocate these funds into multiple investments, certain government securities, certain fixed deposits, certain risky investments like mutual funds, units of mutual fund or units of equity shares. Like this, the fund manager will try to allocate the funds in such a way that these funds will derive maximum benefit. So multi-employer plans are famous because each employer may not be capable enough to meet the requirements of the fund manager. Each employer may not have sufficient funds to employ the fund manager himself. So he is collaborating with multiple other employers to afford this fund manager. First one. Second one, easy one, state plan. State plans are normally run by central governments or state governments, generally by the central government. So where the benefits of the plan are basically that each employer, to his extent of the provision, will directly be given to the state plan. Under state plan, the government entity will normally place the funds into government deposits or government bonds, where the rate of interest is slightly low, but ultimately you need to understand that it is the most affordable case because state plans are very cheap to subscribe. Third, most famous, 99% of enterprises today to manage their defined benefit plans have gone into insured benefit plan. What is an insured benefit plan? Under insured benefit plan, logic is very simple. Employer has a risk. What risk? To pay employment benefits under post-employment benefits to the employee whenever he leaves the organization. When he leave, uncertain. What is his last drawn salary? Uncertain. So much of uncertainty is there. These uncertainties have to be borne by the employer. The employer has to absorb these uncertainties. But the employer is saying, sir, I should do my business. I can't absorb all this. Tomorrow suddenly an employer leaves and employee will leave and he'll say, pay my gratuity. I may not have sufficient funds because my funds are already utilized in particular manner. So what I'll do, I'll go to an insurance company. The business of insurance company is to absorb risk, absorb uncertainty. Since there's an uncertainty, I'll go to the insurance company and I'll say, see, I have these employees. They might leave the organization at any point of time. There are certain benefits which are payable to these employees. And the benefits payable to these employees, I've given them in an order. The insurance company will calculate and he'll say, you subscribe to this particular plan. If you subscribe to this insured benefits plan, by paying an insurance premium, tomorrow you don't have to bear the burden. Whenever an employee retires, you just tell him to contact me. I will pay that employee benefit to the employee. Your risk of paying employment benefit is completely over. You don't have to pay those benefits any longer. It is the insurance company which will absorb the risk of making the payment. Clear? In such case, the employer need not recognize any employee benefit at all, because today the employee benefit is an obligation of the insurance company, for which I pay as an employer an insurance premium. That premium amount which I paid to the insurance company, I will directly recognize it as expense. So that means by subscribing to an insured benefit plan, a defined benefit obligation of the employer has now become defined contribution plan, because the employer contributes only the insurance premium over. After I contribute insurance premium, whatever employee benefit is payable, it will be the insurance company which will pay it. So the risk and the obligation is the insurance company's risk and insurance company's obligation. It is no longer the company's obligation or the enterprise obligation. Therefore, I don't recognize it as defined benefit plan anymore. I will now recognize it as defined contribution plan. Clear? So to manage the defined benefit plan, to manage the benefits payable to the employees under defined benefit plans, the employer can choose either of these three methods. Either he can go for multi-employer plan, where with multiple employers he will get into a collaboration to pool their funds and to appoint a fund manager to manage this fund. Number two, easy one. Go to the central government, tell them that I have an obligation, I am depositing this money, you use this money and give me a return. State plan. Insured benefit plan. I'll go to the insurance company and tell him that this is the obligation which I have, this is the uncertainty which I have, this is the risk which I have. You take off the risk, you tell me how much I have to pay you today. The insurance company will calculate a premium and the employer will pay the premium. Once the employer paid the premium, the employer no longer has an obligation to pay these benefits. It will be the obligation of the insurance company to pay these benefits. Therefore, your defined benefit plan has become a defined contribution plan now. Clear? These are management of post-employment benefits. So this is a multi-employer plan where multiple employers come together to subscribe to a particular plan, where they pool their resources and they employ a fund manager who will take the responsibility of managing the fund in such a way that they maximize the return on these monies invested. So pooling of resources from all employers to manage the fund and make them available for payment of benefit when they actually fall due. Insured benefits plan, the risk of the employment benefits is on the employer. The employer, by paying an insurance to by paying a premium to the insurance companies, transfers the risk of employee benefits also to the insurance company. So whenever the benefits fall due, the employee is going to receive the money from the insurance company itself. So therefore, under insured benefit plan, the defined benefit plan of the employer converts into a defined contribution plan, since the risk associated to employee benefits are transferred to the insurance company. Therefore, only the insurance premium paid to the insurance company will be recognized as expense in the P&L. No other provision is required to be created. All those provisions required to be created for employee benefits will be created by the insurance company, no longer by the employer. Under a state plan, the employer contributes to the fund to a state plan, which monitors the fund and makes funds necessary to pay the obligation when the amount falls due. Clear? So until now, we are only talking about how do we manage these how do we manage these defined benefit plans which are payable to the employee at a future date whenever there's a post-employment or other long-term benefits. So we said we will manage the fund either by multi-employer plan, state plan, or insured benefit plan. So forget about insured benefit plan from here on, because insured benefit plan, I told you, there is no risk of the employer. There's no obligation on the employer. There's no uncertainty to the employer, because the employer transferred the risk uncertainty to the insurance company by subscribing to a policy. He will only pay the premium on the policy. Such premium will be charged to the P&L as an expense. But now we'll have to discuss about what if the employer himself is managing these employee benefits or these funds made available to the employee benefits. Let's see what happens in this case. Now, we will get into the most important concept of how to recognize and measure defined benefit plans. Defined contribution plans or insured benefit plan, like I told you, whatever is the employer's contribution to a defined contribution plan, or whatever is the employer's insurance premium he is paying to the insured benefit plan, these have to be recognized as expense in the P&L, and that is the only accounting treatment. If I make a contribution, employer's contribution to PF, which is a defined contribution plan, what is the entry that you record? Employer's contribution to provident fund to bank. That employer's contribution to provident fund should be charged to P&L. P&L to employer's contribution to provident fund. Over. If I go for an insured benefit plan, the defined benefit obligation has become defined contribution plan. So what will happen? In such case, the insurance premium paid should be charged off to P&L. insurance premium to bank, P&L to insurance premium. These are simple accounting treatments. But when I talk about where the employer himself is managing the risk, where the employer himself is parking the funds, where the employer himself is subscribing to a multi-employer plan, where the employer himself is subscribing to a state plan, to make funds necessary, whenever the benefits have to be paid, we will have to look at a sequence of accounting treatments. It is not as easy as it looks. So let's see what are the multiple accounting treatments necessary whenever you have a multi-employer plan or a state plan, or where the employer himself is managing the risk. Under a defined benefit plan, you have two types of things. First one is defined benefit obligation. What is a defined benefit obligation? The obligation to pay my employee the employment benefits when they fall due under defined benefit plan. Clear? That is the obligation or the liability to the employer. So whenever I talk about this obligation of the employer to pay benefits to the employee when they fall due, I call this as defined benefit obligation, or in simple terms, I can call it as plan obligation. But this obligation is not paid at the end of each year, but it is provided at the end of each year. That means you are only creating a provision. Just like sinking fund, these funds which are set aside for the purpose of meeting employer obligation in future, I will park these funds into a separate investment. Sinking fund reserve, sinking fund investment. Same way, defined benefit obligation, I will invest somewhere into something called as plan assets. Plan asset is an investment portfolio of the enterprise to ensure sufficient funds are made available to meet the obligation of paying employment benefits when they fall due. Clear? So I'm saying I have an obligation where the obligation is called as plan obligation or defined benefit obligation. The obligation to pay my employment benefits when they fall due. This amount is not due yet. It is not supposed to be paid yet. So these funds, I will pull them aside, I'll invest it, and these investments are called as plan assets. So when I record an entry, I'll record P&L to provision, and I will invest these funds. So plan asset or investment account debit to bank. So in this way, I create a liability or an obligation. I'll also create an asset. Clear? Now, what is the recognition? Let's see. There are 5 recognitions which I do under obligation. Under your defined benefit plan, there are 5 recognitions which I do. Current service cost, interest cost, return on plan assets, actuarial gain or loss. I'll repeat. Current service cost, interest cost, return on plan assets, actuarial gain or loss, and the last one is called as curtailments, settlements, and past service cost. There are 3 different things, but I will deal them separately. So I'm leaving this 5th part aside. I'm first concentrating on the first 4. Current service cost, interest cost, return on plan assets, and actuarial gain or loss. What are these 4 components first? First one, current service cost is an increase in present value of defined benefit obligation arising from employee service in the current reporting period. What is interest cost? It is increase in the present value of defined benefit obligation since the investment is 1 year closer, since the settlement is 1 year closer. Nothing you understood from the definition, I know that. So let's take a practical illustration to understand what is a current service cost and interest cost. Take this example. Let's say the defined benefit to an employee is number of years of service into last drawn salary per month. Let's say this is the defined benefit obligation to an employee. I'm just taking some example guys. Don't ask me what is this gratuity or what anything else. This is my defined benefit plan. I'm taking number of years of service into last drawn salary per month is the defined benefit plan to employee. Let's say the employee's salary today per month is 10,000. And every year it is expected to increase by 5%. Let's say the number of years of service of the employee is 5. I don't know whether it is 5 or it could be 30 also. But for the purpose of Illustration or example, I'm taking it as 5 years. And let's say the discount rate is 10%. So that means the benefits payable to the employee are falling due at the end of the 5th year based on his last drawn salary into number of years of service, that is 5 years. So what is his last drawn salary? Each year it will increase by 5%. Current it is 10,000. Next year it will be 10,000 plus 5%. That next year it will be 10,000 plus 5% plus 5%. Like this, 5% will increase over 4 years. At the end of the 5th year, I'll calculate a salary as 12,155. Increasing it by 5% every year. You use your calculator and get it. 10,000 now. Next year, how much it will be? Into 1.05. Next year, it will become 10,500. That is year 2 salary. Year 3 salary, 1.05 again multiply. Third year salary will become 11,025. Fourth year salary will become 11,576. Fifth year salary will become 12,155.0625, rounded off to 12,155. That will be the last drawn salary per month of the employee. Clear? How much of benefit is payable? Last drawn salary multiplied by 5. That means 60,775 rupees of benefit is payable to the employee at the end of 5th year. Clear? Now, at the end of 1st year, I'll first have to create a provision because I know that the obligation arises at the end of 5th year. So each year I'll have to create a provision. As he completes 1st year of service, the obligation is 1 into last drawn salary. As I complete 2nd year of service, the obligation is 2 into last drawn salary. As I complete 3rd year of salary, it is 3 into last drawn salary. Like this, the provision keeps on increasing every year. Correct? So 1st year, when I create a provision, for first look at this concept. So total amount I have to pay at the end of 5th year is 60,755. Correct? So divided by 5, each year I'll have to create a provision of 12,151. Each year I'll have to create a provision of, second guys, 175, right? 775 divided by 5. Each year I'll have to create a provision of 12,151. So when I create 12,151 of provision each year, understand 1st year when I create 12,151, the amount is not payable at the end of the current year. It is payable at the end of 5th year. So therefore, I'll have to provide it on a discounted basis at present value. So at the end of 1st year, when I create 12,155, it is to be paid at the end of the 5th year. Therefore, it should be discounted by 4 years. Why 4 years? At the end of 1st year, you create a provision to pay at the end of 5th year. So that means end of 1st year to end of 5th year, only 4 years discounting is necessary. So since discount factor is 10%, so present value factor of 10, 4 into 12,155. Look at the current service cost. Current service cost is 8,302 at the end of 1st year. 2nd year, again I'll create 12,155 provision at the end of 2nd year. But since this amount is payable at the end of 5th year, I'll discount it by 3 years. Amount came up to 9,128. 3rd year, when I create a provision for 12,155, discount it by 2 years. Amount will come down to 10,045. 4th year provision will come down to 11,050. Last year, 12,155, because there is no discounting, the amount falls due at the end of 5th year. Clear? Now, look at what is the interest cost then. Interest cost is because, look at 8,302 1st year current service cost. You created a provision of 8,302 in year one, at the end of year 1, to make sure that the payment becomes 12,155 at the end of 5th year. How will it become 12,155 at the end of 5th year? Just like that, it won't become. So therefore, every year since you're coming closer to settlement, you have to keep on increasing the amount of provision. So 1st year, when I created 8,302, 2nd year, I have to create an interest cost of 8,330 on that. 2nd year, again, I'll create a current service cost of 9,128 and my closing provision will become 18,260. That is the present value of the obligation at the end of year 2. When you come to year 3, again interest cost should be calculated on the opening provision, becomes 1826. Third year, current service cost is 10,045. Therefore, it becomes 30,131 at the end of third year. Like this, if you keep on repeating your calculations, at the end of fifth year, your obligation of 60,755 should arise. It became 60,768 because of approximation 7 rupees short. Okay. But otherwise, this is a simple calculation which shows interest cost as well as your current service cost. Now you look at the definition. What is current service cost? The increase in present value of defined benefit obligation. Every year your obligation towards payment of post-employment benefit to employee increases. So the increase is not in current terms, but it should be in present value terms, because the obligation is to be settled at a future date. So increase in present value of defined benefit obligation arising from the employee's service in the current reporting period. Since he completed the first year, I created a provision of 8,302. Since he completed next year, again I create 9,128. Since he completed third year, I created 10,045. These are increase in present value of defined benefit obligation because the employee has completed his service in the current reporting period. What is interest cost? Since I recognize the current service cost on a present value basis, as it comes closer to the settlement date, interest should be catching up on the provision, and this catch up of interest is called as interest cost. It is the increase in present value of defined benefit obligation since the settlement is 1 year closer. Remember, even under Ind AS 16, when we discuss about present value of estimated dismantling cost, every year I keep increasing the provision, not because the amount estimated change, because as it keeps on coming closer to the day on which it has to be met, I have to keep on increasing the interest. Such interest increase is called as interest cost. So 4 aspects I told you under defined benefit plan: current service cost, interest cost, return on plan asset, and actuarial gain or loss. Out of these 4, first 2 I covered, and I'm saying it is current service cost and interest cost. Increase in present value of defined benefit obligation arising from employee service in the current reporting period is called as current service cost. The increase in obligation arising due to the settlement coming 1 year closer is called as interest cost. These are the first 2 aspects which I helped you with which I gave you with the help of an example I illustrated. Clear? Guys, in general sense, these calculations are more complex because here I took it as only 5 years, it became easy. If I take 25 years, then obviously you have to use an Excel sheet to get this answer. It is not possible to use your calculator to get the answer. Clear? What is this return on plan asset? A return on plan asset is called as expected return on plan asset. What is expected return? Expected return is nothing but the interest and dividend on plan assets, because plan assets are investments. These investments can yield return in the form of interest or dividend, can also yield in the form of capital appreciation. So that's why unrealized gain or loss on plan assets minus fund administration cost. What is this fund administration cost? There's a fund manager. The fund manager requires to have some percentage or his commission or his salary. That is called as fund administration cost. So interest plus interest or dividend on plan asset plus increase in the value of that plan asset minus fund administration cost is equal to expected return. Always calculate expected return as a percentage, apply it on the plan asset, and that is called as return on plan assets. This return on plan asset should be credited to P&L. The first 2 which I discussed about interest cost and current service cost should be debited to P&L, while your return on plan asset should be credited to P&L. What is to be credited to P&L is called as expected return on plan asset. It is not actual return, it is only expected return. Clear? 3 things are covered. Now I'll bring up the most important concept called as actuarial gain or loss. What is this actuarial gain or loss? and why does this arise? Yes, guys. So what is this actuarial gain or loss? And why does this even appear? Now, this is the only standard where we talk about actuarial valuation. Now, what is actuarial valuation? Why is it necessary in this case? Guys, if you remember till now where we were discussing about your interest costs, current service costs, it requires complicated calculation. It might have appeared easy to you because in the example or the illustration which I've taken, I've just taken 5 years of life. But imagine the employee has entered the organization at the age of 25 and he has another 35 years until retirement age. So that means for 35 discount factors have to be applied. You need to understand that the complicated calculations get involved when we have too many employees. So that is the reason why instead of believing in what the management estimate says, here we will start depending on the work of another expert. We have an auditing standard on that. Standards on auditing where we talk about work of another expert. So this expert here is called as an actuary. An actuary is a person who has qualified from Indian Actuaries Institute and he is eligible to give us a valuation with respect to your your fair valuation on what is the obligation of the employer towards the employees in respect of the defined benefit plan. So what does the actuary do and how is it so different from what the management does? Because your management estimate is purely based on the management judgment, which may not be right. There's always a case where there's a management judgment which can utterly go wrong. Absolutely, right? So what we try to do here is we bring in a professional value. Now, let's say for example, you write an assessment test or a mock test. So in the mock test, when I asked you to estimate what could be your score, you said, sir, I would be scoring something between 65 to 70 marks. That is your estimate of the exam that you have written. But what is a fair estimate of what you have of what is the marks that you're going to secure? So I'll have to bring in a mock examiner. The mock examiner is going to reevaluate your paper, and based on his evaluation of paper, he will come up and say that this paper is eligible to get about 62 to 65 marks. So he is coming up with a much better estimate, or I would put it like this, that he is in a much better position to give an estimate than what you are. Same thing. Management is trying to identify their obligation, but their assessment might be significantly different from a professional assessment by a qualified person. That is the reason why, since these involve significant amount of management estimates, I will try to rely on the work of another expert who has technical knowledge in making such fair value assessment, and that person in this case is called as Indian actuary. This actuary has multiple valuation models, but the one model which is prescribed by your Ind AS 19 and also was prescribed under your AS 15 as far as your IGAP was concerned is called as PUCM model, which is called as projected unit cost model. So what is happening under PUCM model is very simple. The Indian Actuaries Institute has identified a person called as actuary who is qualified, and this qualified actuary is trying to make an assessment of fair value. Does he also believe in certain assumptions? Yes, he does. He also believes in some judgments. He'll also believe in certain assumptions. But they are more reliable. Why are they more reliable? Because he's a qualified person to make an estimate. Therefore, it is more reliable than what the management simply assesses. So what does the actuary actually do, or what is the actuarial valuation actually happen? This actually is going to give us a fair value of the obligation, that is your liability, and also the fair value of your assets, that is your investment portfolio. Or if I talk about the language of Ind AS 19, he will give you an assessment of a fair value of your present value obligation deriving from defined benefit plan, that is nothing but your defined benefit obligation, and also he'll give you a fair assessment of your investment portfolio called as your plan assets. So plan obligation and plan assets are valued by the Indian actuary based on certain parameters using a model called as PUCM. Based on the model, he's going to arrive at a valuation which will be observed as the appropriate value at which the obligation or the asset should be recognized. But the management has already recognized, right? The management, whatever it has recognized, we will have to adjust it so that the value of the obligation and also the value of the asset will come down to their fair valuation as ascertained by the Indian actuary. Clear? Now, so there are things which we recognize under actuarial gain or loss. You will have to identify the actual gain or actuarial gain or loss on the obligation and also on the asset. Now the obligation and the asset both are fair valued as per your Indian actuary. This fair valuation is different from the management estimate. So the difference between the fair value and the management estimate has to be identified as actuarial gain or loss. This is the fourth relative item as far as your defined benefit plan is concerned. We have seen current service cost, interest cost, which are debited to P&L, expected return on plan assets, which is credited to P&L. But when I come down to the fourth part, that is actuarial gain or loss, I will recognize actuarial gain or loss in my statement of OCI. I will not recognize it in P&L, but I will recognize it in my statement of OCI, which is very much within the statement of profitability, but not in the P&L, but in the another part called as statement of OCI. What do you recognize? Actuarial gain or loss. How do I measure actuarial gain or loss? The difference between the present value of the defined benefit obligation as identified by the management estimate compared to the fair value as assessed by the actuary. The difference between both in respect of the defined benefit obligation should be recognized as actuarial gain or loss in my statement of OCI. It could be resulting in a gain if your fair value as per actuary is less than the present value, or if the fair value is greater than the present value, then it results in a loss. But what about the plan assets? In case of the plan assets which are fair valued as per the actuary, you will try to determine actuarial gain or loss by comparing two items, which is your actual return on plan assets compared with expected return on plan assets. What is expected return? We've already seen expected return on plan assets in the earlier slide, where we said expected return is nothing but the interest plus unrealized gain or loss on plan asset minus the fund administration cost, which is identified as expected return as a percentage applied on plan assets. So the difference between the expected return and actual return will be considered as my actual gain or loss on plan assets. So first of all, what is this actual return on plan assets? My actual return on plan assets, I think I missed that slide. So I'll tell you how to calculate actual return on plan assets, guys. So if I have an actual return on plan assets, I will measure it in this manner. Guys, you remember capital definition, or how do I identify capital in balance sheet? Opening capital plus additional capital minus drawings plus profit during the current period, net profit of current year. This should give us the closing capital. Our discussion point was actual return on plan assets. No, why did capital come into picture? I'll tell you. Similar is your cycle even for your fair value of plan assets as well. Go like this. Opening fair value of plan assets. Opening fair value of plan assets plus additional capital is nothing but contributions to the fund. Contribution in current year. Every year there is a contribution which has to be made by the enterprise towards the defined benefit obligation. Such contributions minus benefits paid during the current year. Any employee has retired, then the benefit has to be paid, plus actual return on plan asset which is nothing but similar to our current year profit or loss, should result in closing fair value of plan assets. Should result in closing fair value of plan assets. Very similar to our capital. Very similar to how we calculate capital. Same way I'm calculating even for plan assets. But the entire point is to calculate what is actual return. So how do I get actual return? Use the same formula and calculate actual return. Actual return on plan assets is equal to, now use the same formula and tell me how do I calculate? Closing fair value of plan assets. Closing fair value of plan assets. Who will do the fair valuation? The actuary does the fair valuation minus opening fair value of plan assets minus contributions to the plan in the current year each year the enterprise has to contribute to the plan, defined benefit plan, plus drawings are nothing but benefits paid during the current year, benefits paid to employee in the current year, this will give us what is actual return on plan assets. So therefore actual return on plan asset is equal to closing fair value minus opening fair value being determined by the actuary, minus contributions to the plan in the current year, plus benefits paid to the employee in the current year, will give us what is actual return. This actual return on plan assets, when compared with the expected return which was already credited to P&L, the difference between these two returns shall be considered as actuarial gain or loss. This actuarial gain or loss has to be recognized in the statement of OCI. Clear? On plan assets, the actual return compared by expected return should be transferred to actual gain or loss to the OCI of your statement of profitability. Clear? So your actual gain or loss is identified by PUCM model by valuing at fair value both your present value of obligation, which is your plan obligation, and also your plan assets, and both these fair values when compared with the carrying value results in actual gain or loss. Guys, then what is this PUCM model and what assumptions do they make? Is it important for us to know? Because if you look at the standard, it describes the entire PUCM model, assumptions that the actuary take, the valuation technique that he applies. So many things are there in the standard, but I am not going to talk about those things. Why is it so? Because even if I know the PUCM model, even if I can apply the PUCM model, remember my valuation will not be considered as a technical expert valuation. My valuation cannot be considered as actuarial valuation unless and until the actuary has signed on it. Therefore, me knowing how the pattern of calculation is there or what are the assumptions being made is not going to change the fact that I need an actuary to do the valuation. Clear? That is the reason why I'm ignoring those steps of how to calculate your fair value of defined benefit obligation and the fair value of plan assets by applying your PUCM model under Ind AS 19. Clear? But in general sense, what are the assumptions that he makes? He'll make an assumption as to what is the expected life of my employee. Because immediately if there is a demise of the employee or deceased of the employee, then automatically the employee benefits get payable. Number two, what is the employee turnover? How quickly is the employee expected to change the organization? Because if the enterprise has a high employee turnover, that means the employer is leaving the organization, then the obligation will not be discounted for so long because I'm expecting that the employee will leave in near future itself. So that will also determine what is the expected growth rate of the salary each year. What is the discount factor to be applied? All these are assumptions made by the actuary in determining what is the fair value of the defined benefit obligation and also the fair value of your plan assets. Clear? Finally, once we're done with this, we go into the next step. The three things which we have to discuss after this, we have already discussed 4 parts: current service cost, interest cost, return on plan assets, and actual gain or loss. These 4 have to be considered in P&L every year. While the first 3 items, current service cost, interest cost, and expected return on plan assets, should be debited or credited in the P&L, your actual gain or loss will be debited or credited in the OCI. These 4 items should happen every year. But there are 3 things which can emerge subsequently on a particular event: past service cost, curtailments, settlements. Past service cost and curtailments are exact opposite to each other. I'll tell you what is past service cost, then I'll explain you what is curtailment. A past service cost is an increase in the present value of defined benefit obligation. It is an increase in the present value of defined benefit obligation. Why did your obligation increase? It can increase due to 2 reasons. 1, the benefits payable to the employee under the plan have increased, or the number of employees eligible to receive the benefits under the plan have increased. I'll tell you. Let's say I've announced a defined benefit plan and I said the benefits under this plan are only eligible to be received by managers or above hierarchy if they finish at least 5 years of service in the organization. And I'm saying the benefits will accrue to them and they will be paid only if they complete the next 5 years in the organization. And the benefits under the plan are only available to manager and above category. That's it. 2 years have passed by. I observed that all the people below the manager cadre started leaving the organization. When I identified the reason, they said, sir, the plan benefits are only applicable to manager and above. Therefore, those people who are managers and above, they are continuing in the service of the company. But all those people below the hierarchy are more inclined towards leaving the organization. So management said, okay, fine. 2 years are over. I'll make an announcement saying that this plan benefits are today from now onwards applicable to even the people of assistant manager or deputy manager level as well. So what happened? Earlier, manager and above category, the number of people in the organization were 70. Now, after I included assistant managers and deputy managers, now the total number of employees who are eligible to receive benefit under the plan have shot up to 150. First 2 years, when the number of employees eligible to receive the benefits under the plan are 70, you might have estimated the provision based on a particular value. But today, when the number of employees have increased to 50, automatically there is an increase in the present value of obligation. Such increase in the present value of obligation arising due to the increase in number of employees who are entitled to receive the benefits under the plan is called as past service cost. One more thing, one more example. Let's say the benefits under the plan are payable as 20 days of salary for every completed year of service. 2 years are over. I find that the managers are not happy. When I ask them, sir, what happened? That's at 20 days, we find it too less, sir. 20 days is too less. I said, fine. 2 years later, the management came up with a rectification and they said, yes, 20 days looks less to us. So we are increasing the benefits under the plan to, instead of 20 days per completed year of service, to 30 days for every completed year of service. So what happened? The benefit is still available to those 70 employees itself. But the benefits payable under the plan, instead of 20 days for every completed year of service, became 30 days. Automatically, the obligation increased. So such increase in the present value of defined benefit obligation arising due to the increase in benefits eligible to the employees under the plan is also called as past service cost. So it could arise due to increase in number of employees entitled to the plan or number of benefits which are available to each employee under the plan. Clear? This is called as past service cost. What happened in the case of past service cost? Your obligation has increased. If your obligation increases, then automatically it is a expense to us. It is increasing my cost. It is increasing my obligation. Therefore, it has to be debited to P&L. Now the question comes up, should I debit the P&L immediately when the modification is done, or can I spread it over the period? In the example which I gave you, I said the benefits of the plan will be paid after 5 years. When did I make a modification to the plan? After 2 years. Are the benefits payable under the plan already due? No. They will fall due after another 3 years. Therefore, such items or such plans are called as unvested plans. If the benefits under the plan are unvested, then the increase in the present value should be charged to P&L or should be debited to P&L over the remaining vesting period, in the example 3 more years. Let's say the modification was done in year 5 itself. Year 5, the benefits under the plan are due. On that day, I did a modification and there is an increase in the obligation value. Then what you do? Then these benefits payable under the plan are already vested. They are already due. In such case, whatever is the increase in the past service cost or whatever is the increase in the present value of obligation should be directly charged to P&L. It cannot be allocated over a period of time. Only if the benefits are not due, then the benefits are unvested. In such case, the increase in the present value of defined benefit obligation or the past service cost should be spread over the remaining vesting period. If the benefits payable under the plan are already vested, that means they are already due, then the increase in the present value of defined benefit obligation, that is the past service cost, should be charged to P&L immediately. Clear? What is curtailment? Exact reverse is curtailment. Because in curtailment, he says, it is a decrease in the present value of defined benefit obligation arising due to decrease in number of employees eligible to the plan or decrease in the benefits eligible to each employee under the plan. Exact ulta of what we have dealt under past service cost. So here we are talking about increase in present value due to increase in benefits or increase in employees. Here I am talking about decrease. I am talking about decrease in present value of obligation due to decrease in benefits or decrease in number of employees. Whenever it's a curtailment, it's a reduction in the obligation. Whenever it is a reduction in the obligation, it is a gain. So therefore, such gain should be recognized in the credit of the P&L immediately when such curtailment occurs. When the curtailment occurred itself, I will start recognizing the amount of gain, that is a decrease in the present value of obligation, into the credit of P&L. So guys, remember, past service cost or curtailment, both these situations occur only if the management or the enterprise has done some modifications to the plan. If there is no modification to the plan, there is no past service cost, no curtailment. That's why I said these are items which will appear only if a particular event occurs. Here, what is the event? Amendment or modification to the plan occurred, which has resulted either in a past service cost or could result in curtailment. Clear? Last concept under this is called as settlement. What is settlement? I call up the employee and I tell the employee, boss, you are entitled to receive so many benefits, right, from the employer. Today, I will give you one amount. You tell me how much amount you want. Tomorrow, don't claim any benefit under the post-employment benefit plan. No post-employment healthcare, no pensions, nothing. Today, you tell me how much you want. That today's value is called as settlement. Settlement is a lump sum payment made to the employee in consideration to waiving off the future benefits payable to employee. So, employee is eligible to receive some benefits from the employer in future. He is waiving off all those benefits. But for waiving off those benefits, today he is accepting one single payment. Guys, let's say an employee is at the age of 35 or 40, right? His retirement benefits will accrue to him at the age of 60. You don't know, first of all, whether I'll be alive or not, whether I'll be able to enjoy those benefits or not. Today, I need those money. I want to buy a house. I want to buy a lavish car. I want to go on a foreign trip. So all these expenses cannot be met out of my salary. So if the employer comes out with a proposal saying that today you take 10 lakhs, forget about every other benefit that you will receive after your employment. I said, fine, today's 10 lakhs is more important to me. So he has taken the today's value, and this is called as settlement. Whenever a settlement occurs, I will have to compare the amount paid under settlement with the current carrying value of the present benefit obligation. I will compare the settlement value or the settlement amount paid with the carrying value of the defined benefit obligation. The difference between the settlement amount and the carrying value of the defined benefit obligation should be recognized in the P&L. If your benefit paid is more than the carrying value, then it is a loss debited to P&L. If your settlement value is much less than the present value of obligation, then in such case it is a gain credited to P&L. These are the three things which we have to discuss apart from the 4 items which occur every year. But the last 3 items, past service cost, curtailment, settlement, these 3 emerge only when a particular situation appears. Only when there is an event which occurs. An event of increase in the benefits of the plan have arisen. An event of decrease in the number of employees eligible to the plan have arisen. An event of settlement has occurred. Only in such cases, these 3 items will appear and will be given effect to in the P&L. Clear? Concept clear so far? The last concept under your employee benefits is a small concept regarding termination benefit. What is a termination benefit and when does it arise? These termination benefits arise when the employer-employee or relationship is terminated. That means you basically end the employer-employee relationship, which results in certain benefits being paid by the employer to the employee. Pink slip, 3 months salary in advance, termination benefit. Golden handshake offered to bankers. In your banking profession, when golden handshake was offered, let's say an employee has another 10 years of service, he is coming up to you and saying that, sir, I leave, I can't do this computer work. Today the banking has become more a computer duty. I don't know how many of you been to bank audits. You find the core banking softwares. So whenever you look at those core banking softwares, you need to understand that India earlier in our banking system, we never had this core banking software. There was no centralized bankings. So we had particular home branches in which we bank. So from there, when it transformed, so these employees who could not transfer or who could not learn the computer core banking software, they left the organization. To leave the organization, they were incentivized. 10 years of salary, if you would have served, I would have paid you so much. But today, since you're leaving, I'll pay you a fraction of that. You get out of the organization. Don't come from tomorrow. Whatever money you got, you can do some business or you can do any other activity. This is a general thing which has applied to everyone. So that is called as golden handshake. So either a VRS scheme which was given to Garmin employees. All these are concepts which are emerging out of termination benefit. So what is a termination benefit? How do I account for it? A termination benefit, an entity is required to recognize a liability and an expense for termination benefit at the earlier of the date on which the entity has no longer an option to withdraw from the benefits of the plan. I've announced a plan and the entity does not have an option to withdraw from the plan. I've already told the employees at the age of 45 or above are eligible to apply for the plan before 31st March and I have no option to withdraw. If the employee comes up, I'll have to pay him that benefit. It is called as a termination benefit to be recognized as a liability and an expense. And the entity recognizes cost for restructuring within the scope of Ind AS 37 and involves a payment of termination benefit. Guys, let's say, for example, now you see bank mergers which are happening, right? You find that basically Andhra Bank got merged with some other bank. You find that some other bank got merged with another bank. When these mergers happen, then the banking has got restricted because you find two banks having branches right beside each other. Now, once the bank merger happened, then some branches will be eliminated. When the elimination of branches happen, then certain number of employees also have to be removed from service because two branches will have two branch managers. Now, if one of the branches is eliminated, I need only one branch manager. So in that case, those are called as restructuring costs. Whenever you recognize a restructuring which is occurring, then it involves termination benefits. In such cases, I'll have to recognize a liability and an expense for termination benefit. Now, I'll have to make sure that the entire termination benefit is recognized in the statement of P&L when either of these two events occur. When I have already announced a plan, I have no option to withdraw from the plan. And I have already identified recognition of restructuring cost and this involves the payment of termination benefit. In such cases, the termination benefits payable to an employee should be recognized on the date on which the termination benefits are payable. When they become due, that is sufficient for you to recognize these termination benefits as expense in the statement of your P&L. Clear? And that will bring us to the end of discussion on this concepts of Ind AS 19, that is accounting for employee benefits. Clear? Yes, guys. So Ind AS 37 gives us an insight about provisions, contingent assets, and contingent liabilities. Guys, when I talk about provisions, contingent assets, and contingent liabilities, one has to understand that there is a very thin line of difference between a liability and a provision and a contingent liability. Very thin line of difference. When I say outstanding salaries, do you call it as a provision for salary or outstanding salaries? Is it a liability or a provision? It's a liability. Now, why is it a liability and why not it can be called as provision for salary? Because both the cases I'll debit the P&L. What difference does it make? Does it make a hell lot of difference? Yes. So basically the terminology of provision and a liability has to be understood first of all. So whenever I say a liability, it is virtually certain. It is virtually certain. That amount is certain to be realized, to be paid. That is called as a liability. But when I talk about a provision, it is an obligation which has emerged, but the amount is only estimated. I don't know the exact amount of the liability, but I'm estimating it. Then you create a provision for it. Whenever I talk about a liability or a provision, these are called as obligations. Any obligation which arises to an enterprise can arise due to three reasons. Three reasons why there is an obligation which emerges to an enterprise. First one, it's a legal obligation, an obligation created by law. Payment of bonus created by law. Payment of taxation is created by law. So these are legal obligations which are emerging out of a law. Next one, contractual obligation, an obligation arising due to a contract. I gave you a contract to complete the construction of a building within 12 months. If you exceed beyond 12 months, then the construction company is supposed to pay a penalty of a certain price. These obligations arising to a construction company are not legal obligations, but they are contractual obligations. Third is called as your constructive obligation. What is a constructive obligation? Constructive obligations normally emerge due to industry's best practices. For example, you go to a McDonald's showroom, okay, or McDonald's outlet. You ordered for a Coke, okay. He gave you in that big jar a Coke. While you're picking up the tray, the Coke fell down. You looked at him, he immediately filled one more Coke and he gave it to you. He can very well say, sir, I've already given you the Coke. It was your responsibility to take it to the table. When you spilled it, it is your obligation and it is not mine. So if you want one more Coke, you will have to pay me again. Now, these kind of arguments are not done. That is industry's best practice because you want to keep your customers very happy. There is a problem regarding my mobile phone. I go to the showroom, I give the mobile phone, he'll immediately make sure that the service is done. Let's say my phone is not switching on, he'll do some here and there, something, he'll switch it on and he'll say, sir, the mobile is still working. These kind of services, after sale services, are customary. They are industry's best practices or the practices which I have been following since my past. I have today got that credibility because of the kind of service which I create. So these are constructive obligations. Your obligation for dismantling an asset is also a constructive obligation. If I install a particular AC in my house and when I'm leaving the place, I'll have to remove the AC. So my installation of the AC has given rise to an obligation to dismantle the AC at a later point of time. These are called as constructive obligations. These are not obligations created by law. Neither these obligations are created by a contract. These are customary business practices or these are practices in the best interest of the customer. So these are past practices which I have been following. I'm following even now, which is resulting in an obligation today. These are called as constructive obligations. So there are three types of obligations which can arise: legal, contract, constructive. Legal obligation, contractual obligation, constructive obligation. Legal obligations, contractual obligations are also legal obligations is what he believed. So as per law or regulating statute, when you create, constructive obligation is a commitment which I create or it is a customary business practice. These are obligations which emerge. Out of these obligations, let us understand provisions, contingent assets and contingent liabilities. Any obligation results in an outflow of enterprise resources. Enterprise resources in the form of any part being replaced or sometimes in the form of labor or sometimes in the form of cash. Whenever there's an outflow of enterprise resources, you need to measure what is the degree of certainty. What is the certainty with which the obligation actually should be discharged or repaid? if it is a present obligation or is it a possible obligation. Someone has filed a case against me, defamation case of using his patent, okay, or patent infringement case. So such patent infringement case which is filed upon me is a possible obligation, because if he wins the case, then possibly I'll have to pay a certain amount. That is called as a possible obligation. What is the present obligation? I know I have to pay. I know I have to pay. So in the present obligation also, sometimes an obligation might be virtually certain to happen. What is virtually certain? An employee has rendered the service during the month of March. At the end of March, I am assessing whether this obligation is a present obligation or not. Yes, it is a present obligation. How certain is it that you have to pay the amount? I've already utilized that fellow's service. So obviously it is virtually certain that I have to pay the amount. So it is such obligations which are present obligations which are certain, virtually certain to occur. Then in such case, I'll say it is virtually certain if the amount and the timing are determinable. If I know what is the amount which I have to pay and at what time I have to pay, then I can say that it is virtually certain, for which I will recognize a liability. So when I say it is a liability to us, a liability is a present obligation which is virtually certain. But let's say it is not virtually certain, but it is probable to arise. It is probable that I have to declare bonus. It is probable that there is a particular amount of tax which I have to pay. It is an obligation, yes. But is it certain? No, it is probable. My tax will be ascertained by my tax auditor at the time when the tax audit is due. As on today's date, I am measuring with reasonable certainty the amount which I am probable to pay towards tax. In such cases, I will recognize a provision, as long as you can measure and estimate reliably. If you cannot measure and estimate reliably, then such amount, instead of recognizing as a provision, I will disclose it as a contingent liability. Let's say today there is an obligation, but the obligation certainty to occur is remote. I am not expecting it to occur. There is a remote chance that it can occur. Then in such cases, I will not disclose a provision or a liability. In such cases, I'll only disclose a contingent liability. So if I ask you to define a liability, how will you define? A liability is a present obligation which results in an outflow of enterprise resources, and such outflow of enterprise resources is virtually certain. I know that this is the amount which I have to pay, and at this point of time I have to pay. It is virtually certain, so I recognize a liability. But what is a provision? A provision is appearing in this case where there is a present obligation which will probably result in an outflow of enterprise resources. That what do you mean by probable? More likely than not. It is more likely that I will have to pay the amount. I will have to pay the amount which is more likely to occur. If I can measure the amount which I am not supposed to pay reliably, then I will recognize the provision. But if I have to define a contingent liability, I can recognize that contingent liability, or I'll disclose a contingent liability in three situations. Number one, where the obligation which results in outflow of enterprise resources is possible, not probable. It is possible. Number two, there is a present obligation which results in an outflow of enterprise resources. But this obligation to arise is very remote chances of occurrence. In such cases, I will recognize a contingent liability. Third one, it's a present obligation which results in outflow of enterprise resources, but I could not measure the amount with reasonable certainty. A reliable estimate could not be made. In such cases, I will recognize a contingent liability. So to understand contingency and contingent liability, we need to first concentrate on the concept of what is a contingency. A contingency is a situation which may result in a gain or may result in a loss. It is a situation which might result in a gain or might result in a loss. It depends on the outcome of an uncertain future event. And such uncertain future event is not within the control of the enterprise. I'm saying it is a situation which results in a gain or a loss depending upon the outcome of an uncertain future event. Such uncertain future event is not within the control of the enterprise. Give me an example here. Let's say there is a case of patent infringement which was filed by my competitor in my court. So in the court of law, it's just a case which is filed. If he wins the case, it will result in a loss. But the winning of his case is a future event which is uncertain. Depending upon the outcome of that uncertain future event, it might result in a loss to the enterprise. And the outcome of that future event is not in my control. It is within the judge's control or the court control. The court will decide what is the outcome of the future event. In such cases, I'll call it as a contingent loss. What is a contingent gain? Other way. I filed a patent infringement case. If I win the case, it results in a gain. So a gain which results from an outcome or the winning of an uncertain future event. And I cannot control that event, but unfortunately, it is within the control of the court or the judge sitting out there. Therefore, it might result in a contingent asset. So these are contingent assets and contingent liabilities. Clear? Remember, guys, whenever I have a situation of a contingent liability, this is how I'll have to look at it. A contingent liability is either a possible obligation or a present obligation. In case it is a present obligation where the future outflow is not probable or there is a remote chance of occurrence, or the future outflow is probable but it cannot be measured reliably. This is my definition of contingent liability, which I already discussed. In such case, if it is a contingent liability, then I should not recognize that contingent liability in my books of accounts. It is not a liability to be recognized, but instead it should be disclosed in footnotes. What is a footnote? How is it different from notes to accounts? Guys, footnote to balance sheet has much more greater emphasis than a notes to accounts. Notes to accounts run into pages and pages. People might read, might not read. But there will be a larger focus on my financial statements drafted in the form of balance sheets and P&L. So right below the balance sheet, when I present a contingent liability, this is the most prominent disclosure compared to my disclosure in my notes to accounts. Therefore, contingent liabilities should have a prominent disclosure as a footnote and should not be disclosed in my notes to accounts. Clear? If it is a contingent asset, that means it results in a future gain resulting from an outcome of an uncertain future event. In such case, if it is virtually certain to occur, it is virtually certain that definitely there will be some gain. In such cases, I'll recognize an asset. But if it is probable, and I'm not saying that it is compulsory that it will come up, but there is a chance that I might get a gain because of an outcome of a future event. In such cases, my disclosure is not in the footnote. Contingent liability footnote. Contingent asset, not footnote. Notes to accounts, no. He says report of board of directors. That means even in my notes to accounts also, this cannot be disclosed. If I talk about prominence of disclosure, most prominent disclosure is footnote. Second, notes to accounts. Third is board of directors report. Very rarely do people read board of directors report and auditors report. Therefore, contingent asset being recognized or being disclosed in board of directors report gives it the least significance. It's a contingent asset, but it is not probable. I put a patent infringement case on someone else. It might result in a gain if the court rules it in my favor. But the chances of that result is very remote. Therefore, in such situation, I should not recognize, I should not disclose. No requirement to disclose, no requirement to recognize. Clear? What is a provision? It's a present obligation arising from a past event. It results in a future outflow of enterprise resources, and such outflow can be reliably measured. And reliable measurement requires the best estimate of the management. So therefore, the management should consider all risks and uncertainties in trying to give out the best estimate in measuring the amount of provision. If the provision is payable within 12 months or it will crystallize into a liability which is due within 12 months, then no discounting is necessary. But if the amount under the provision is payable beyond 12 months, then I have to discount it. Then I'll have to discount and recognize the provision, just like we have done in the case of provision for dismantling. It was beyond 12 months, so I've discounted it and I presented the provision in my financial statements. Clear? Now that we are done with the concept of contingent liability, contingent assets, and provisions, we come across a very interesting discussion called as executory contracts. What are executory contracts? Let's say, for example, I enter into a contract to supply 100 units of a particular material A. And in consideration, for every unit, he pays me 1000 rupees. For 100 units, the contract value is 100 into 1000, 1 lakh. I supplied 50 units. He already paid me 50,000. These contracts are executory because both the parties to the contract have performed equal obligation. I did not supply 1 unit. He did not pay me 1 rupee. No party to the contract have performed any of their obligations. In both these situations, I'll call them as executory contracts. The party or the customer has already paid me an advance of 10,000 rupees. Not executory because the customer has already performed his part of obligation. My part of obligation is still pending. I supplied 20 units, billed 20,000, but the amount is not yet received. I did my part of obligation. He is supposed to do his part of obligation, not execute. So executory contracts only emerge when both the parties to the contract have not performed any of their obligations or both the parties to the contract have performed equal obligation. Now, why do we talk about executory contracts? Because Ind AS 37 excludes executory contracts unless they are onerous in nature. Ind AS 37 excludes executory contracts unless they are onerous in nature. What do you mean by this onerous nature? Any contract is said to be onerous if it results in an expected future loss to the enterprise. I'll tell you. I have entered into a contract to supply 100 units of material X for 1000 rupees per item. Contract value 1 lakh. The purchase price of each unit of material X after its production is 1500 rupees. That means what? Executory. I did not supply, he did not pay. But the contract as such will result in an expected loss to the enterprise. Because for me to produce material X, it is costing me 1500, but I am eligible to collect only 1000 rupees from the customer. Such contracts are executory in nature, but they are onerous in nature. Clear? So where I am talking about onerous contract, it is covered under Ind AS 37, even though such contracts are executory in nature. In any other sense, executory contracts are excluded from the scope of Ind AS 37. So Ind AS 37 excludes executory contracts unless they are onerous in nature. What is an onerous contract? An onerous contract is where a cost incurred to meet the contractual obligation exceeds the benefit arising from the contract. The cost incurred to meet the obligation is 1500 per unit. Benefit I am expecting to collect from the customer is only 1000. It results in a future loss. So therefore, if cost expected to meet the obligation is exceeding the benefit arising from the contract, it results in an expected future loss. Such expected future losses should be recognized immediately applying your conservatism concept. And such contracts are called as onerous contracts. Such contracts are called as onerous contracts. Clear? And that will bring us to the discussion on Ind AS 37, dealing with provisions, contingent assets, and contingent liabilities. Yes, guys, the next set of Ind AS that we'll be discussing is about Ind AS 12. Ind AS 12 is a direct comparable standard to AS 22, which also deals with accounting for taxes on income, while Ind AS 12 talks about income tax. Now, apart from the fact that both the standards will deal with a similar concept of accounting for taxes in the form of current tax and deferred tax, nothing else in the standards are similar. The reason is your AS 22 earlier under IGAP or your Indian GAAP was basically following an income approach, which is income approach basically means the net profit as per your P&L has certain adjustments before you get into taxable income as per income tax. The difference between both of them is explained in the form of Ind AS 12 and what is the accounting effect of it. But when we come to the concept of Ind AS 12 instead of AS 22, Ind AS 12 talks about balance sheet approach, where they compare two figures that is called as carrying value in your financial statements compared with the tax base, which is a calculation as per Ind AS 12. So significantly, the basis of calculation itself has changed. Therefore, you need to understand that apart from the fact that they are dealing with the same concept of income tax, they have a significantly different approaches towards computation of deferred tax as well as current tax. Clear? Now, to begin with this standard, first of all, what is the significance of this standard? Remember, your accounting income is nothing but your net profit as per P&L is not equal to your taxable income. Your taxable income is a computation as per your PGBP chapter, right? What do you say? Net profit as per P&L minus depreciation debited as per P&L plus depreciation debited to P&L minus depreciation under section 32 of Income Tax Act. Certain expenditure debited to P&L not supposed to be deducted for tax purposes. Certain incomes credited to P&L not considered for tax purposes. So many adjustments were done before we arrived at taxable income as per PGBP chapter. So therefore, I can come to a conclusion that your accounting income is significantly different from taxable income. Since your accounting income is different from taxable income, your tax on accounting income is also not equal to your tax on taxable income. Your tax on accounting income is called as tax expense. Your tax on accounting income is called as tax expense. Your tax on taxable income, which is your obligation to pay tax, is called as current tax. Current tax is the amount of tax which we pay to the department or which we pay during a particular financial year. Clear? So that means there is a difference between the tax expense and current tax. The difference between both accounting income, tax expense and current tax is given as deferred tax. So deferred tax is a difference between current tax and tax expense. In simple sense, he gives a formula like this. Tax expense is equal to current tax plus or minus deferred tax. If your current tax is greater than your tax expense, then it should be minus deferred tax. A minus figure signifies a current deferred tax asset. If your current tax is less than tax expense, then tax expense is equal to current tax plus deferred tax. Whenever I have a plus deferred tax, it is always a deferred tax liability. Clear? So this is where the concept of deferred tax and current tax emerge. Tax levied, the standard deals with taxes on income. Such taxes on income could either be levied in India or could be levied outside India. Taxable income is not equal to accounting income. Your tax on taxable income is also not equal to tax on accounting income. So current tax is not equal to tax expense. Tax expense is debited to P&L, while current tax is your provision for tax which is paid to the department. So I can give a formula as Current tax expense is equal to current tax plus or minus deferred tax. Whenever it is a plus symbol, it signifies deferred tax liability, and whenever it is a minus symbol, it signifies deferred tax asset. This is your underlying principle of why the standard emerges. Underlying principle. From here, we'll start discussing what is current tax, what is deferred tax, but understand that this underlying principle is the crux of the standard. Why does this standard even is required? Is because of this particular slide which I played right now. Clear? What is current tax? Current tax is a tax payable or receivable in respect of taxable income or tax losses during a particular reporting period. So current tax is something which is derived as per the prevailing tax laws. So in India, the prevailing tax law is Income Tax Act 1961. According to Income Tax 1961, whatever is the tax payable or a tax refund in respect of taxable income, that is nothing but your taxable profits or tax losses during a period, is called as current tax. Remember, current tax is always measured as per prevailing tax laws. In India, the prevailing tax law is Income Tax Act 1961. So according to Income Tax 1961, any tax payable or receivable in respect of taxable income and losses during the period should be considered as current tax. Clear? A current tax can be reported either as an asset or a liability depending upon the tax paid and tax payable. If the amount payable as per the department or as per your Income Tax Act is less than the amount of tax already paid in the form of advance tax or TDS, you report it as an asset. If your amount of advance tax or TDS is less than the amount payable as per Income Tax Act, you report it as a liability. So current tax can either be reported as an asset or can be reported as a liability. So generally we have an asset, these current tax reported in the form of provision for tax. Provision for tax is a current tax item. It is a tax payable or receivable on taxable income and tax losses computed as per prevailing tax laws. Clear? I measure current tax, which is current tax asset or a liability, based on tax expected to be recovered from the department or tax expected to be paid to the tax authorities using a tax rate which is enacted or substantively enacted on reporting date. What do you mean by tax rates which are enacted or substantively enacted? Guys, let's say, for example, the finance commission or the finance ministry has given me has called upon a particular press conference, and they said the current tax is being reduced from 30% to 22%. This is what happened earlier, right? To 25%, let's say 5% cut in current tax. In such cases, let's say it happened in March, but as on 31st March, the law is not yet enacted for. Then in such cases, since the announcement is already made, though the tax rate is not enacted, I can say that it is substantively enacted because it was already declared in the press conference. It is only the government order which was pending. So these are future tax rates which are virtually certain to apply. If not today, I will get the GO tomorrow. But they are virtually certain to apply since the appropriate authority of the government has already declared on cutting the tax rate. So therefore, your current tax should always be measured using tax rates which are enacted or substantively enacted on a reporting date. How do I present this concept of current tax? Current tax should be presented in the statement of P&L as well as in balance sheet. In the statement of P&L, I'll have to report tax expense as a combination of current tax and deferred tax. This is what we have seen here. The tax expense is debited to P&L. What is tax expense? Current tax plus or minus deferred tax. So the current tax should be presented in the face of P&L or for the impact of all the items which are debited or credited in the P&L. However, certain items which are presented in the OCI or certain items which are presented in statement of changes in equity, I will recognize current tax within OCI or within other equity. Clear? Current tax asset and liability should be presented under current assets and current liabilities based on their nature, and should always be non-financial in nature. They are not financial assets and financial liability. They should always be presented as non-financial assets and non-financial liabilities. Clear? So I'm saying for all the items which are debited and credited in P&L, the amount of current tax should be presented in the statement of P&L. For certain items which are not recognized in P&L but are recognized in OCI, then I will recognize the current tax on each item of OCI independently. For certain effect which is given in statement of changes in equity directly, not reported in either P&L or OCI, current tax also should be reported only in other equity. Clear? Now comes the concept of deferred tax. So remember guys, we don't have significant discussion on current tax. If you observe, we only said current tax is tax payable as per the prevailing statute. We just said that there is current tax asset or current tax liability, depending upon whether the tax payable is greater or less than the tax already paid in the form of advance tax or TDS. And we said we measure it based on either tax rates which are applied or substantively applied on reporting date. That's all we discussed. Why are we not discussing further on current tax? We are not discussing any further on current tax because determination of current tax is based on the prevailing statute. Prevailing statute, Income Tax Act 1961, is voluminous enough to decide how to calculate current tax. Ind AS 12 need not tell you how to calculate current tax. Ind AS 12 will just say calculate current tax as per prevailing statute, prevailing Income Tax Act 1961. It doesn't have to specify each and every provision of Income Tax Act 1961 all over again. That is the reason why our discussion on current tax is only limited to understanding what is current tax and how do I measure current tax. That is sufficient for us. We don't have any further discussion on current tax because current tax is explained as per your Income Tax Act 1961. Clear? Then comes the concept of what is deferred tax. Yes, guys. So let's come to the concept of deferred tax because this is.
Right, sir, please unmute yourself.
Yeah, 1 second. Yes, guys. So now we come to the concept of deferred tax. What is deferred tax and what is the significance of this concept? Remember, just like we said, current tax is determined as per the prevailing provisions of Income Tax Act 1961. I cannot leave deferred tax just like that because deferred tax has to be defined under Ind AS 12 because deferred tax is not as per any other statute. Deferred tax is to be considered or calculated as per Ind AS 12 itself. So we will have to go with the stepwise approach of determining deferred tax. First of all, what is deferred tax? Deferred tax is a future tax consequence. I'm saying deferred tax is a future tax consequence. For example, let's say there's a provision for bonus to employees which was provided. If the payment of bonus is not made within the current reporting period before the due date of filing your returns under 139(1), then such amount of provision for bonus is not allowed as deduction. But what can happen? It can give rise to a future deduction to bonus whenever it is paid. That means my future amount of tax payable will reduce. This is called as future tax consequence. A scientific research expenditure, an asset acquired for scientific research, can be completely 100% depreciated in the same year as per section 35 of your Income Tax Act. But similar deduction is not available as far as your accounting approach is concerned. According to our accounting approach, we will continue to depreciate the asset on a straight line basis or a WDV basis. Let's say straight line basis. So what happened? Your entire amount of deduction for tax payment has been allowed in the same year in which you purchased the asset. In future, no additional depreciation is allowed on that asset. But as far as your accounting approach is concerned, you keep on charging depreciation. So what will happen? Your accounting income will be less than the amount of taxable income. Therefore, you will pay a greater tax or higher tax in the future. Therefore, this is called as future tax consequence. A future tax consequence can either result in a higher tax liability or a reduction in tax liability. It arises due to recovery of the carrying value of the asset or settlement of a liability in future. I'm saying the future tax consequence arises either due to recovery of carrying value of an asset or settlement of a liability in future. Such future tax consequence can either increase the tax liability or can reduce the tax liability. Any increase in tax liability will be recognized as a deferred tax asset. Sorry, should be recognized as a deferred tax liability, guys. I'm sorry for that. Guys, whenever there is an additional liability in future which will result in a higher tax payment, it should be recognized as a deferred tax liability. I think I wrote it exactly reverse. Please try to rectify that. A future tax consequence resulting in a higher tax liability in future will result in deferred tax liability. Whenever there is a future tax consequence of savings in tax or a reduction of tax liability, then it is a benefit to the enterprise. Such benefit will be recognized as deferred tax asset. Clear? Increase in future tax liability is deferred tax liability. Decrease in future tax liability is deferred tax asset. This is, in short, the concept of deferred tax. How do I identify this deferred tax? My determination of deferred tax involves 8 different steps. First, to identify the carrying value of assets and liabilities. Second, to calculate the tax base of these items of assets and liabilities. Whatever assets and liabilities carrying value you identified in step 1, I will calculate their corresponding tax base. Think about a bare Excel sheet. Okay. First column, carrying value of assets and liabilities. That is the book value as it appears in your balance sheet. Second column is tax base. We identify the tax base of every corresponding item of asset and liability. The difference between 1 and 2. The difference between the carrying value and the tax base, which we calculated in step 1 and step 2, is called as temporary difference. Is called as temporary difference. AS22 language is timing difference. You don't use the word timing difference here. We use the word temporary difference. Step 4, we classify the temporary differences. We call these temporary differences as taxable temporary differences or deductible temporary differences in step 4. Finally, step 5, we measure the amount of deferred tax. Your measurement of deferred tax should be determined based on a tax rate. So your step 6 is your tax rate. Then you come into recognition and presentation of deferred tax in your financial statements. I'll repeat. First, start with identifying the carrying values. Corresponding to these carrying values, I have to identify tax base. Comparing 1 and 2, I will get temporary differences. These temporary differences should be classified. Then you determine a tax rate and try to measure what is the amount of deferred tax. After you determine the amount of tax rate and deferred tax, recognize the deferred tax asset or liability and present the deferred tax asset or liability in your financial statements. This is my stepwise approach as far as your determination of deferred tax is concerned. Clear? Let's try to break down each step and understand. First step, I will not explain any further because first step is only about carrying value of assets and liabilities, which is nothing but your book values. After depreciation, after impairment, whatever value of asset and liability is appearing in the balance sheet, the same value will be considered as step 1, carrying value of asset and liability. Step 2 onwards, we will have to take up the discussion. What is computation of tax base? My computation of tax base can be broken down into 3 parts. Tax base of assets, tax base of liabilities. For all those assets and liabilities where under step 1 you identified carrying value, we have to find out their corresponding tax base of assets and liabilities. But there are also tax base of items for which there is no carrying value in the balance sheet. There is no carrying value in the balance sheet, but there is a tax base for these items. So this third one is a very peculiar nature. Very peculiar in nature because that item is not there in the balance sheet only. When you presented your balance sheets of assets and liabilities, there is no such item in the assets and liabilities in the balance sheet. But there is a tax base for such item. We will discuss about this concept separately. But first think about whenever in your step 1 where we have taken carrying value of assets and liabilities, tax base is the corresponding value of assets and liabilities has to be identified in step 2. How do I determine tax base of assets and tax base of liabilities? First, start with tax base of an asset. A tax base of an asset is an amount which is deducted for tax purposes against taxable economic benefits arising from the recovery of carrying value of the asset. I'll repeat. I said an amount that will be deducted for tax purposes against taxable economic benefits arising from the recovery of carrying value of asset. What does this mean? Let's say, put it like this. If for suppose I have an inventory which is valued at 2 lakhs at cost in my books of accounts. How do I recover the value from inventory? By sale of inventory. I sold the inventory at 2,50,000 rupees. What is the amount of economic benefit derived from sale? 2,50,000. What is the amount of tax which I have to pay on that? 2,50,000 minus 2 lakhs. So therefore 2 lakhs is reduced from the value of 2,50,000. That 2 lakhs is called as tax base. The amount that will be deducted for tax purposes against taxable economic benefits arising from the recovery of carrying value of an asset. Clear? So I'm saying the amount that can be deducted for tax purposes against the taxable economic benefits arising from the recovery of carrying value of the asset is called as a tax base of an asset. Now my question is, economic benefits arising from carrying value of an asset, from recovery of carrying value of the asset, is it always taxable? Let's say I have a debtor. Amount collected from a debtor, economic benefits arising from the recovery of a debtor, is it taxable? No. I have an advances given to let's say my employee. The employee has repaid the advance which I gave. The repaid advance, does it become a taxable economic benefit? No. It is just an economic benefit which is not subjected to tax. So whenever I have a cash at bank, it is recovered by withdrawal from bank. I withdrew from bank, does it become taxable in my hands? No. So not all economic benefits arising from recovery of carrying value are taxable. If economic benefits derived from the carrying value of an asset are not taxable, then your tax base is equal to carrying value. Then your tax base and your carrying value are same. If your tax base and carrying value are same, then the temporary differences identified in step 3 are 0. Then 0. So debtor, bill received, cash in hand, cash at bank, advances, all these tax bases are equal to carrying value. My step 3 temporary differences are 0 in this case. What is the tax base of an asset? The amount that shall be deducted for tax purposes against the taxable economic benefits arising from the recovery of carrying value of an asset. Therefore, if I am saying that the economic benefits derived from the carrying value of an asset are not taxable, tax base should be considered as equal to the carrying value of the asset. I've given the example of finished goods. Cost is 75,000. On sale, you will recover 1 lakh, which is taxable economic benefits derived from recovery of carrying value of the asset. This taxable income is equal to 1 lakh economic benefit derived from sale of asset minus 75,000, which is cost of the asset. So 75,000 is deducted for tax purposes, which should be considered as tax base of an asset. Clear? How do I determine tax base of a liability? A tax base of a liability is equal to carrying value of the liability minus amount deductible for tax purposes in future. I'm saying carrying value of the liability minus amount deductible for tax purposes in future. Let's say provision for bonus to employee. That provision for bonus to employee, let's say, is unpaid on the date of filing your income tax return. Upon last date of filing your income tax return, the amount of bonus is still unpaid. Therefore, the amount cannot be allowed as deduction in the current year, but is eligible for deduction in the subsequent year. In such case, carrying value of liability minus the amount deductible for tax purposes in future is the entire amount of bonus, which when paid will be allowed as deduction. Therefore, the tax base of such liability is considered as zero if it is not paid within the due date of filing the return. What if the amount is already paid off? Before the filing of income tax return, due date of filing your income tax return, the amount of bonus has been paid. What is the amount deductible in future? In future, nothing is allowed as deduction because the entire deduction is allowed in the current reporting period itself. In such case, carrying value of bonus minus zero, therefore tax base of liability is equal to carrying value of the liability. Remember, if settlement of a liability is not deductible for tax purposes, paying a liability is not deductible for tax purposes, creditors, loans, bills payable, bank overdraft. If I repay loan, no tax deduction. If I pay my creditor, no tax deduction. If I pay my outstanding expenses, no tax deduction. In such cases, tax base is equal to carrying value of liability. That means your temporary differences will become zero whenever settlement of a liability is not deductible for tax purposes in future. Look at the example of bonus which I have given you. Subjected to 43B of Income Tax Act, if it is paid within due date of filing your income tax return, then your tax base is equal to carrying value. Temporary difference is zero. If it is not paid within the due date, then the tax base is equal to zero. Therefore, it results in a temporary difference. Tax base of items where there is no carrying value. I'll give you an example. I'll tell you. Let's say I have preliminary expenses. According to your Income Tax Act, your preliminary expenses are allocated to P&L over 5 years period. But according to your accounting knowledge, you can eliminate the preliminary expenses against securities premium if available. So let's say they were adjusted against securities premium for your accounting purposes. There is no carrying value of preliminary expenses existing in the balance sheet anymore. But is there a tax base? Yes. Because this amount will give a tax deduction in future or reduces the tax liability in future. Therefore, there is a tax base for that item. Certain items are charged off to P&L or adjusted to reserves of accounting purposes. As against, for tax purposes, they are deferred and amortized. In such cases, where you have a tax base, you have to determine the tax base, even though there is no carrying value of the item. So carrying value is zero, but a tax base should be identified. It results in temporary difference as per step 3. Preliminary expenses, I have given you the example. Accounting treatment, charge it off to P&L or adjusted against free reserves or securities premium. But for tax treatment, it should be deferred and amortized over 5 years period. So therefore, in certain cases, you will find that the items have no carrying value, but they do have a tax base. Circumstances where a tax base cannot be measured reliably. Sometimes a land and building can have economic benefits derived from the use of the asset, or can be derived from the sale of the asset, or can be derived from rent of the premises. If I am deriving rental income, then income is chargeable under the head of house property. If I am deriving income by use of the asset, then I will deduct amount in the form of depreciation. If I am selling the asset, then it should be under capital gains. Now, how should I determine a tax base when the asset by itself can be used for multiple purposes? In such cases, the tax base should be based on the entity's expectation of recovery of economic benefits from the asset or from the settlement of liability. How do you expect to recover the benefit from the asset? I expect to recover the benefit from the asset from the sale of the asset. Then tax base should be computed based on what would be the tax deductible amount when they sell the asset. Let's say I expect to derive income from the asset from use of the asset. In such cases, the tax base should be based on the WDV or written down value as per income tax purpose. So this way, it should be the tax base on such items should be computed based on the entity's expectation to derive benefits from the use of the particular asset. So this is the second step that we have covered. The second step is regarding computation of tax base. What is the tax base of an asset? Amount deductible for tax purposes against the taxable economic benefit arising from the recovery of the carrying value of the asset. Tax base of a liability is equal to carrying value then minus amount deductible for tax purposes in future. Sometimes there might not be a carrying value, but we still have to determine the tax base of an asset. Sometimes you may not be able to identify the tax base because the asset can be deriving income in multiple ways. You can derive income from a property from rent, from sale, or from use. In such cases, tax base should be measured based on or should be identified based on the expected use of the enterprise. Clear? These are the four parts that we have discussed: tax base of an asset, tax base of a liability, tax base where there is no carrying value, circumstances where tax base cannot be reliably measured. And that will bring us to the end of discussion on step 2. What is your step 1? Carrying value. Step 2, computation of tax base. Once we got these two steps, we in Excel sheet think about an Excel. Carrying values were placed. Beside the tax base is identified and placed. Third step is identifying or determining temporary differences. How do you determine temporary differences? Carrying value minus tax base. Yes, guys. So now let's look at step 3 then. Step 3 is about determining temporary differences by comparing your step 1 and step 2. So what is a temporary difference and how is it different from timing difference? Temporary difference computation is very simple. Compare step 1 and step 2. you will get temporary differences. Step 1 minus step 2. Temporary differences are different from timing differences which are mentioned under AS12. Sorry, AS22. Or in AS 12 only talks about temporary differences. Temporary difference includes timing differences. What is a timing difference? Let me tell you. A bonus to employees which is created as a provision, if it is unpaid until the due date of filing your income tax return, it is eligible for deduction in the subsequent year. For your accounting purposes, I have already given a provision in the P&L. So my accounting income is already low in the current year, but my taxable income is high because the deduction is not allowed in the current year. This difference which arises due to accounting income and taxable income due to provision of bonus will be allowed as deduction for tax purposes in subsequent year when the amount is paid. So what will happen in the next year? When the provision of bonus is paid, then automatically my taxable income will reduce in the next year. But my accounting income, again, I don't allow provision for bonus because that provision of bonus has already been provided in the previous year. So in the next year, the accounting income will be higher, taxable income will be lower. So therefore, in such cases where you come across, you will understand that a difference between accounting income and taxable income which arose in the current year will reverse in the subsequent year. Such cases, you call them as timing differences. Depreciation, classic example of timing difference. Because depreciation should be calculated to the extent of the carrying value of the asset. Now, your rate of depreciation might be different for accounting purposes, might be different for tax purposes. Because tax purposes, it is block of assets basis, we have a particular percentage. But as far as accounting purpose is concerned, schedule 2 depreciation gives you useful life and residual value. So the depreciation as per tax purpose is different and accounting purpose is different. But ultimately, how much can you depreciate? Maximum my depreciation will be to the extent of the value of the asset. Therefore, such kind of difference in depreciation is a timing difference which can either increase the accounting income or taxable income in 1 year, but compensate it in the subsequent years. Clear? But I'm saying temporary differences can also be there, include other than timing differences as well. What are these? Let's say there is a revaluation of an asset. There is an upward revaluation of asset. What happened due to upward revaluation? The carrying value of asset according to your accounting records has increased. When your value of the asset in accounting records has increased, subsequent depreciation is also higher. But such revaluation is not allowed for tax purposes. So tax will still be providing the same amount of depreciation as it was providing earlier. Therefore, it can result in a difference as far as your revalued portion of asset is concerned. It can result in a difference between the carrying value and the tax base, which is not a timing difference because it did not appear in 1 year and did not disappear in the subsequent year. Clear? These are called as temporary differences other than timing differences. Sometimes under a business combination under Ind AS 103, assets and liabilities from the transferor company will be acquired at fair value. But however, for tax purposes, these assets and liabilities should still be considered at carrying values as it was in the books of transferor. Therefore, in such cases also there can be a difference which arises between a tax base and a carrying value. So these are not timing differences, but these are temporary differences. So the meaning here, what I wanted to convey was temporary differences include timing differences, but are a much more larger ambit than just timing differences. It could emerge also due to revaluation or business combination, giving rise to a temporary difference instead of a timing difference only. Clear? Now let's go to step 4, where I classify my temporary differences. I classify temporary differences into 2 types: taxable temporary difference, deductible temporary difference. What is a taxable temporary difference? A taxable temporary difference results in a taxable amount in determination in increase in the taxable amount in determination of tax payable. It results in higher tax payable in the future period. Deductible temporary differences means they result in reduction They result in reduction of tax payable in future periods. Taxable temporary differences gives rise to an extra obligation of tax payment in future. Deductible temporary differences give a tax saving in future. Taxable temporary differences which result in higher tax payable in future will give rise to a deferred tax liability. Why liability? Because it is increasing my tax liability in future. Deductible temporary differences, they reduce tax liability. They save tax liability in future. They create a benefit to the organization in future. Since they are creating a benefit of tax saving to the organization in future, it results in a deferred tax asset. Clear? Remember, whenever I'm talking about an asset whose carrying value is less than the tax base, an asset whose carrying value is less than tax base. What is tax base? Amount deductible for tax purposes against taxable economic benefits arising from the recovery of carrying value of this. So if the amount deductible for tax purposes is more than the carrying value, then you will get a tax saving in future. Since there is a tax saving in future, then these are called as deductible temporary differences. These are called as deductible temporary differences. Guys, reverse I have written asset, if the tax base is more, then it is deductible. Liability, if your tax base is more, it is taxable. Exact reverse I have written. Please make sure that you correct it. If your tax base is greater for an asset than its carrying value, it results in a greater deduction in future. If it gives a greater deduction in future, then it is a reduced tax payable in future or a tax saving in future. Since it is a tax saving in future, it is a deductible temporary difference. For a liability, it results in a taxable temporary difference. Clear? Exact vice versa. If your tax base is less for an asset compared to its carrying value, that means the amount deductible for tax purpose is less. If amount deductible for tax purpose is less, it results in higher tax liability in future. When it results in higher tax liability in future, then it should be a taxable temporary difference. Exact reverse even here. This should be a taxable temporary difference for an asset and deductible temporary difference for a liability. If your carrying value is exactly equal to your tax base, there is no temporary difference. There is no deductible or taxable temporary differences which arise. Clear? How do I measure deferred tax? Deferred tax should be measured as your tax rate multiplied by temporary differences which we measured in step 3. Step 3 temporary differences are nothing but carrying value minus tax base. This carrying value minus tax base called as temporary difference. If I multiply it with the tax rate, it gives me a measurement of deferred tax. What is tax rate? Determination of tax rate for computation of deferred tax. It is a reliable estimate. What is a deferred tax? Future tax consequence. For what is the tax rate applicable for measuring deferred tax? Since it is a future tax consequence, it should be a future tax rate. I don't know future tax rate, sir. How do I know? Am I predicting what is a future tax rate? Can I read what is going through the finance manager's mind? Not possible. That's why he says it should be a reliable estimate of future tax rate in the year in which these temporary differences are expected to reverse. The year in which I expect these temporary differences to reverse. Let's say there's a scientific research expenditure, an asset which was acquired. According to the useful life, it has a 10 years useful life, 10 years depreciation I will charge. Tax purposes, 100% is allowed as deduction in the same year. So it results in a temporary difference, and such temporary difference will reverse over 10 years period. At the end of the 10th year, what is the tax rate? I don't know. I cannot determine. Reliable estimate of future tax rate I cannot make. Then what is the tax rate I should take? Since the future tax rate cannot be determined with reasonable certainty, use tax rates which are enacted or substantively enacted on balance sheet date. The same rate which I applied for current tax in measuring current tax, the same rate I will apply even for measurement of deferred tax. Sometimes there could appear a situation where slab rate of tax exists. We don't have slab rate of tax because we are talking about companies. But if there is a slab rate of tax which exists, that means for an individual when the Ind AS becomes applicable, as on today's date it is still not applicable, but if it becomes applicable, if there is a slab rate of tax, then I will use the formula of average rate of tax to determine the tax rate as per step 6. What is average rate of tax? Average rate of tax is equal to total estimated tax divided by total estimated taxable income into 100. That is called as average rate of tax. Recognition of deferred tax. Guys, taxable temporary differences should be recognized as deferred tax liability. Deductible temporary differences should be recognized as deferred tax asset. Taxable temporary differences recognized as deferred tax liability have no restriction as per the standard. There is no restriction. But for deductible temporary differences, which are recognized as deferred tax asset, I should test for prudence. What is this test for prudence? Why should I restrict the recognition of deferred tax asset? Why such similar restriction is not allowed for deferred tax liability? Because deferred tax liability means you are debiting the P&L. When you debit a P&L, there is no restriction. You can debit the P&L as and when you want. You can create a provision whenever you want. But when I credit the P&L, conservatism concept will come off in picture. Because it is an income, future deduction of tax liability. Future reduction of tax liability today is called as deferred tax asset. Future reduction of tax liability. Who told you tomorrow that I'll have a tax liability first of all? What if future tax liability was 0? From where will you get deduction of tax liability or reduction of tax liability? From where did you get a deductible temporary difference? Why will I get a gain? How can it benefit the organization? Tax liability itself is 0. What reduction? What furthermore reduction is possible? So that's why we say always test for prudence. For us to recognize a deferred tax asset, we have to test for prudence, but there is no such test for deferred tax liability. You can happily recognize deferred tax liability for every taxable temporary difference. When it comes to deductible temporary differences, I'll have to apply this check for prudence and I'll have to estimate or I'll have to check whether it is passing the test of prudence before I recognize a deferred tax asset. What is this check for prudence? Check for prudence in recognition of deferred tax asset means I will recognize a deferred tax asset only if there is a possibility of future taxable income against which these deductible temporary differences can be adjusted or realized. That means what? I should be certain that tomorrow I will have future tax liability. Against the tax liability, I will reduce this deferred tax asset. Got it? I will have sufficient taxable income in future against which your deductible temporary differences can be adjusted or realized. Remember guys, carried forward business loss, unabsorbed depreciation. What do these two have significance? They will reduce future tax liability. Whenever I have a tax liability in future, these carried forward business losses and unabsorbed depreciation can be adjusted. Therefore, it will reduce my tax liability in future. Since it is reducing tax liability in future, it should be recognized as deferred tax asset. But what is your check for prudence saying? You should have a reasonable certainty that the enterprise will make sufficient taxable profit in future. Guys, remember, why do you get carried forward business loss or unabsorbed depreciation? Carried forward business loss, that means the entity made loss. Unabsorbed depreciation, your profit is not even sufficient to absorb the depreciation, man. That's why you got unabsorbed depreciation. Now, how will you establish reasonable certainty of future profits? Reasonable certainty of future profits is not possible. Therefore, it is very difficult for us to measure a deferred tax asset in case of carried forward business losses and unabsorbed depreciation. Sometimes you do measure. Take a look at current COVID situation. COVID situation has significantly affected my operations for the financial year 2020-21. As a result of which, in 2020-21, I have a business loss as per your income tax. This business loss can be carried forward for 8 more years. I am assessing whether I can recognize a deferred tax asset or no. And now I realize at over the past so many years, I have been always reporting taxable profit. Current year, my tax loss is only due to corona crisis. Had this corona situation had not been there, I wouldn't have made this loss. Therefore, since vaccinations are already in progress, 2021-22, I expect to make future taxable gain. Reasonable certainty is there? Yes. Because all my past years I have been making profit, only 1 year loss. So it is reasonably certain that I will reverse and I will start getting your taxable gains or taxable income in future, against which this carried forward business loss can be adjusted. In such cases, you can recognize a deferred tax asset. Let's say full past profits are loss, carried forward business loss today. Can I recognize deferred tax asset? Not possible. Because there is no reasonable certainty that I will make a future gain, that I will have a sufficient taxable profits in future. Since you cannot have a reasonable certainty of sufficient taxable profit in future, you cannot recognize a deferred tax asset for such kind of deductible temporary differences. So no deferred tax asset should generally be recognized for unabsorbed depreciation and carried forward business loss. But that one example which I gave you, all year profit, current year loss due to COVID, no problem, you can still recognize a deferred tax asset if you can establish a check for prudence. That means you can prove that there will be sufficient taxable profits in future, against which the amount of deferred tax can be adjusted. Clear? Your presentation of deferred tax is exactly the same as presentation of current tax. There is no difference. In P&L, I will present deferred tax for the items which are presented either to the debit or credit of P&L. For the items which are not recognized in P&L but are recognized in OCI or in statement of changes in equity, I'll present deferred tax individually for each item in OCI and statement of changes in equity. In balance sheet, these should be presented as either presented under current or non-current, depending on when they are expected to reverse. If they are expected to reverse in next 12 months, I'll classify them as current. If they are expected to reverse beyond 12 months, I'll classify them as non-current. Clear? But remember, they should only be classified as non-financial. They are not financial in nature. Just like your current tax, even your deferred tax also is non-financial in nature. Let's come across some typical situations, guys. Share-based payment to employees. Ind AS 102 applies. According to your Ind AS 102, expenditure on share-based payments should be recognized over the period of vesting on a straight line basis. On a straight line basis, I will recognize in the P&L over the period of vesting. But according to your tax purposes in measurement of taxable income, it is only allowed as deduction when the option is exercised by the employee. Therefore, 100% there is a timing difference which arises. You are creating a provision in accounting records. You are not creating the provision in tax records. Therefore, how do I calculate tax base? Carrying value of the liability minus amount deductible for tax purpose in future. Carrying value of liability I can calculate, because carrying value of liability is the value which is already existing in my books to the extent of the provision which I already created. What is the amount deductible for tax purpose? The amount deductible for tax purpose should be computed based on the estimated number of employees who are expected to exercise. So therefore, tax base should be measured based on market price per share on each reporting date. Market price per share on each reporting date. So let's say I have 100 employees. The market price is 100. They can exercise it at 60. Fair value is 40. 2 years vesting period. So every year 20. 100 employees. So 2000. 2000 first year, 2000 second year, I debit it. But let's say when I'm talking about tax base, it is carrying value of the liability minus amount deductible for tax purpose in future. What is the amount deductible for tax purpose in future? To the extent it will be, to the extent the options will be exercised by the employee. I'm expecting 80 employees to exercise the option, and the current market price on today's date is 98. So basically 60 minus 98 is 38 rupees. I will recognize that difference as a tax base. This is regarding share-based payments of employees where a typical situation emerges. What is this concept of carrying backward of losses? Have you ever come across this concept of carrying backward of losses? In India, this is not there. But let's say carrying backward of losses is a simple situation like this. I had taxable income in current year. I paid tax. Future period when I make a loss, I can claim a refund of the tax paid for the previous years. India not available. But outside India, there are certain countries where carrying backward of losses is applicable. Therefore, in such cases, I can recognize a deferred tax asset if the enterprise has paid a tax liability in the current year, provided there is a reasonable certainty to believe that the enterprise will incur tax loss in future. Clear? So whenever there is a carrying backward of losses, I can recognize a deferred tax asset if I have paid tax in the current period, but I am expecting to have a tax loss in the future periods. In such cases, I can recognize deferred tax asset. India, not applicable. Not applicable. Withholding tax on dividends or corporate dividend tax, which recently got abolished. These cases, always remember, CDT should be always an adjustment in your statement of changes in equity. You don't recognize proposed dividend as a liability. Therefore, never recognize CDT also as a liability. CDT will directly be recognized as an adjustment from other equity. It will only be recognized when a valid resolution is passed in the AGM, and even if the valid resolution is passed, will never appear in the P&L. It should only be adjusted within equity. What is this indexation benefit on asset? Remember, whenever I have a fixed asset, let's say a land or a building, as years pass by from the date of acquisition, if it is not a depreciable asset, I'm restricting myself to land, let's say. If it is a depreciable asset, it will be a different logic, guys. Let's take land. Carrying value of the land is a particular cost. There's no revaluation which is done. As years progress by, the amount deductible for tax purposes in future. What is the amount deductible for tax purposes in future? Upon sale, I will have an increased cost or indexed cost which is adjusted. Therefore, if you take a logic like this, let's say the carrying value is 100, indexed cost is 200. Then in such cases, it results in a deductible temporary difference. What is the deductible temporary difference? The amount adjusted for tax purposes in future. Guys, I'm sorry guys, I should have actually reduced the index cost. Deductible temporary differences are 100, 120, 140, 154, 164, 172 and 180. Therefore, in this case, what is happening? I have an indexed cost. I'll have to recognize a deferred tax asset. Why deferred tax asset? Because your tax base is nothing but the indexed cost. Your carrying value is the same throughout. Your tax base keeps on increasing. So there is a temporary deductible temporary differences which will emerge because of that. So to that extent, deferred tax asset can be recognized. It can be recognized only if I expect that the land will be sold in near future. Let's say the land is being used as my factory premises. I have established a factory shed on the top of it, and I have been utilizing that land. Is it probable to generate economic benefits by sale of the land? No, going concern. I don't expect that land to be sold. Therefore, in such cases, I should not recognize a deferred tax asset. So look at what he's saying. Recognize deferred tax asset to the extent of indexation benefit available on certain assets. If the enterprise intends to generate future tax benefits from sale of the asset rather than from continuing use. So I will recognize deferred tax asset to the indexation benefit only if I expect to recover the carrying value of the asset from sale rather than from continuing use. If the enterprise intends to generate taxable economic benefits from continuing use of the asset rather than from sale of the asset, then the enterprise should not recognize deferred tax asset even though indexation benefit is available. Guys, deductible temporary differences should be a difference of indexed cost and carrying value. Carrying value and indexed cost is the tax base. That's it, guys. With that, we come to the end of discussion on this concept of Ind AS 12.